Hey, this is Ken Finnan, and it's my job to get you past the Series 65 and the Series 66. This might be the most boring video I ever do, but it's going to be a long. I was going to curse. You're not supposed to curse in the first 30 seconds of a YouTube video, or they demonetize your ass. We don't need that. This is going to be a long, boring video, but it's going to be very, very valuable. Everyone's telling me that this is going to be the key to passing the Series 65 or the Series 66. It's either going to be one really long video or a bunch of like other videos. I have to see. I will absolutely have to timestamp it because I'm going through a lot of stuff. And what am I going to do? And I'm just going to go down all the terms, and we're going to go through all the terms from various books and get everything. So this will be have a thing. So if you go, what is this? I got that. You just look it up, and there it is. And you get a little stupid video with me talking about it. Maybe I put some art around it. Who the hell knows? But let's get going. Okay, so we'll start with, we're in the letter A's, right? Accredited investor. So what is an accredited investor? Well, first of all, what can they do? They're allowed to buy on Regulation D. Okay, so accredited investors are kind of rich people. Remember, 1, 2, 3 accredited, 1 million net worth, 200 salary if you're single, 300 if they're miserable. I mean married. Okay, 1, 2, 3 accredited. They can buy on Reg D with impunity. You can have as many of them as you want. They're rich. And keep in mind, FINRA's job is to protect grandma, grandpa. So they put a lot of restrictions on retail people. So as they get richer and richer or more sophisticated, they get to, what's the best way to explain it? They are going to have less protections. Since there's less protections, they let them do more things. It's kind of a trade-off, like when you're raising a kid. When they're little, you're tight on them, and then toddler a little more, teenager, then adult, and that's what we're doing. So accredited investors are like the high teenagers, like almost an adult, because then we get qualified and quibs and institutions are even higher. So they let them do things. They let them buy on Reg D. Plus, I think they have less restrictions on the Reg A plus tier 2. But we're not there yet. We're going to get into it. So accredited investors are 1 million net worth, 200 salary, single, 300 if they're, I want to say miserable again, but married. Also, if you have an active Series 7, Series 65, or an 82. Now, a lot of people I see, and I'll do a separate video on this, want to just get this Series 65 to become accredited. Okay, you have to get the 65 and have it be associated with an IA. You can't just have the license. It has to be an active license. So again, that's accredited investor. Now, accumulation stage or accumulation unit. Accumulation stage or accumulation, we'll put them together. When you're buying into an annuity, a variable or fixed, you're putting money in. You're putting money in after taxes most of the time if it's non-qualified. So that's the accumulation phase or accumulation stage. And what are you buying? You're buying accumulation units. So when you put the stuff in, you're buying accumulation units, okay? And then they grow in value. Now, if you do a lump sum, you can buy a fixed number of units and then they grow in value. If you do a contract plan, you're paying over every year. You're putting $100 in, $200 a month, whatever it is. That you're actually going to be buying more and more units every time, which makes sense. Okay. The acid test. Okay, so there's a current ratio and then the acid test. The acid test is basically the current ratio without inventory because it's a more strict version of liquidity. So current ratio is current assets divided by current liabilities. That's liquidity. Even tighter is current assets without inventory over current liabilities. Now, anything current, I have videos on the current stuff. Current assets is anything like that you have or going to get in a year. Current liabilities is anything you owe in the next year or so. Inventory, the reason they take inventory out of the acid test, because it's very strict, is because they want to not count the inventory, because if it was liquid, it would have been sold already. Because you could have all these dresses, like say like women who maybe you buy dresses. I don't know if you do anymore, but we'll see. Like you're not going to buy, once spring comes, you're not buying spring dresses. You're buying the next one. So if they have dresses left over and there's $200-300 dresses in the spring, they're listed on the books as $200 dresses, but they're not going for that because no one's paying full price in the spring for spring stuff. Okay, so it's kind of like it's more fair to take that out and say, listen, we're getting rid of the inventory and then we're doing the liquidity. And we'll figure it out from there. So the acid test is a current ratio with current assets without inventory minus inventory taking it out. Okay. Now, An active management style. Okay, passive means like you're rebalancing and you're not trying to beat the market. You may be indexing or benchmarking, but then active is you're actually trying to identify inefficiencies or industries that are going to be going good, or you're going to do sector rotation or even asset allocation, where you're moving asset allocation. Let's go with sector rotation. You're moving stuff around for industries. Like during the upward cycle, you're going to be buying cyclical stocks, and during the downward, you're going to be doing defensive. You're actively trading to try to find inefficiencies and move the market, okay? And not move the market, but get a better price to beat the market. That's active. It also comes along with more cost because there's more commissions, and you're paying for an active manager to live in Greenwich, Connecticut and make a lot of money and not do a whole lot. Okay. Active 1933, the two acts. The active 1933 is the primary market, okay? The active 1933 is all about the primary market and new issues, or for non-exempt securities. It's for new issues, non-exempt securities. So it's going to say, oh, if you're going to issue shares, you have to register them with the SEC, file the registration statement. So it's a 20-day cooling off period, okay? A 20-day cooling off period. And then it's effective after that. They have rules what you can't do. You can't sell the issue. You can't take money. You can't take orders, stuff like that during the 20-day cooling off period. But you can get indications of interest, send out a red herring / preliminary prospectus, stuff like that. I have all videos on that. You should all understand that the Active 33 is for primary market. Boom. Active 1934. The Active 1934 is for everything else, for violations, for the secondary market. So I have an acronym called MISPERMS. I'll try to put it here or not. I'll just put a link to the video. MISPERMS. It covers margin, insiders, short sales. The SEC created the SEC. Funny, they created the SEC after the Active 33, but that's funny. P for proxy rules. That's voting by mail. E, all the exchanges and broker dealers, how to register with the SEC. Remember that. IAs register Active 40 if they're federal, and broker dealers register the Active 34 under the Active 34 with the SEC. But whose rules? R reports. That's like 8Ks, which are just like random reports by issuers. 10Qs are quarterlies. 10K is an annual report, and that one's audited. Then we have M, the last one, manipulation. That's like not churning, but marking the open, marking the close, pegging. Don't Google that. What else do we have in that? We have marking the open, marking the close, pegging. We can do, I guess, wash trades, wash sales, all the violations, all manipulation. And remember, they did put it in there that if the SEC decides something is manipulation or fraud, then it is, because they knew back then they didn't know everything that would go on, like Ponzi schemes and stuff like that. Then the last S is stabilization. That allows the underwriter to buy the shares during a new offering when it's at the POP price or lower, to hold the price until it gathers some interest. Okay, it's the only form of manipulation allowed. Okay, adjusted basis. This is basically cost basis. Okay, so we have cost basis, what you paid for something, and then it can be adjusted. Like maybe you buy more, or you sell some, or you do, like if it's a limited partnership, maybe you get a distribution, or maybe you get a return of principal. Adjusted basis is you have your cost basis, and then depending on how you do after that, it's going up or down. And then AGI, adjusted gross income. That's your gross income from all your sources, okay? That's adjusted gross income, and then you would do some things like deductions and stuff. Adjusted gross income is what you're going to be taxed on. Maybe you have IRA deductions, maybe you have distributions and stuff like that you're going to deduct from your income. But then once you do that, that's your AGI, your adjusted gross income, I'm stuttering, then that's what you'll pay taxes on. And there's nothing left in my Capital Advantage Tutoring Cup, okay? And it's funny, the one thing that I really like, I don't sell because my wife made it for me for Father's Day. Okay. The administrator. Okay. What's the administrator? The administrator is like the regulator for the state. Each state has their own regulator. It could be a person, it could be a team, whatever it is. They have jurisdiction over all securities trades and registrations of securities personnel and securities in the state. If it's federal and administrator kind of conflicting overlap, Fed takes precedence. But the administrator absolutely has jurisdiction in their state. They can investigate outside their state if there's jurisdiction. And remember, no regulator ever approves anything ever. So if you ever see, oh, the administrator approved, throw it out. It's no good. Okay, adoption. Oh, how cute. No, adoption is if, like, say I talk about your company. I say, oh, you, the viewer, was a great investment advisor, and I put it on Twitter or Facebook or something else. If you don't do anything, no problem. But if you retweet it, like it, share it, copy paste, put it on your website, something to, or direct attention to it, that's considered adoption. And then you kind of have to treat it as if it's a communication. Okay. So that's when a third party site endorses us. We're endorsed on a third party site, and we, the broker dealer or the IA, either like it, retweet it, refer to it, direct people to it, make light of it, not make attention to it. And that would be adoption. And then we have to follow certain rules because we are now part of it. As opposed, I'll talk about entanglement, even though it's not in the A's. Entanglement is when you're the broker dealer or IA actually involved in writing it. And that could be illegal or illegal, but entanglement is when somebody posts on a third party website and you help the person write it. They could go, oh, say this, say that, and put it over there, but we'll pretend it wasn't us. That's entanglement, and that's not a good thing. What's an ADR? An ADR is an American depository receipt that is absolutely a foreign security. So what happens is I'm a bank in the US and I have branches in, let's say, Switzerland. My branch in Switzerland buys a bunch of shares of Nestle, puts them in a package, and then sells that in the US. So this security, so all the securities are in this bucket, but you're buying this ADR. And this will go up and down based on what's happening to the stock in Switzerland. Now, what's cool is that there's an arbitrage sometimes that when the Swiss is closed and we're open, the stock may move on its own without that changing it. So sometimes there's a way to capture a little difference. But either way, it's a US security. You get dividends in US currency. They pay in the foreign, whatever it is, but the bank will convert it and you'll get paid in US currency. So ADRs are representative of foreign securities trading here. Okay, advertising. That's any kind of circular, any writing, any publication, anything else to help you determine whether you should make a buy or sell or use a certain service. So that's advertising is when you do anything that is to make someone help determine if they should make a purchase or a sale or something like that, like a recommendation a little bit. That's in advertising, and it has to follow either the state laws or the SEC or FINRA rules. Okay, agency basis. Okay, agency basis is if you're doing a trade on an agency basis, that means you're the middleman. Like you give me an order to buy 1,000 shares at 40. I find a seller for you, and much like a realtor with a house, I find a seller, I match him up. You buy from that person through me. I charge a commission, and we go on our way. That's agency. We charge a commission. All it is. Since we're here, that's remember ABC, agent, broker, commission. Now, the other side, principal side is principal dealer markup, PDM. Principal dealer markup, okay, is a principal order. If you get it acting as a principal, you're acting as a dealer, you're doing a markup. Okay, what does that mean? That means you're getting involved. You give me an order to buy 1,000 shares at 50. I go buy it and then turn around and sell it to you at like 50-50. So you give me an order to buy 1,000 shares at 50. I go buy it. I turn around and sell it to you at 50-50, and I charge you a markup. That would be a riskless principle because I'm not taking a chance. Or what if I'm not taking a chance because I'm not buying it until you give me the order, okay? By the way, I have to disclose that to you. Now, on the other side of principle is what if I already own the shares? You give me an order to buy stock at 50. I'll sell it to you at $50.50 and say I charge you a 50-cent markup. That's where I have risk because if the stock may go up or down while I own it. What's an agency cross transaction? An agency cross transaction is you give me an order to buy 10,000 shares of IBM at 50. You're going to beat up IBM. Then I go, wait a second, you know what? Johnny or whatever, I know they wanted to sell IBM. So I call them up and say, hey, I have a buyer. Do you want to sell it? And I go, understand, I'm doing both sides. I have to disclose this. I have to say, I have a buyer. Do you want to sell it? And they go, sure, they sell it. So I'm going to tell the buyer that I'm doing it internal. I'm going to cross it. So I basically take my buyer and my seller and cross them, and then I charge a commission on both sides. That's an agency cross transaction. There are principal cross transactions, not really testable. They can do that where I'm going to buy it from this person and sell it to that, and I charge a markup on both. Doesn't matter. But again, agency is where I take a buyer that came in, I find a seller, and boom. Or if the seller comes in, I find a buyer, and then I just cross both sides. It's kind of like if you go to buy a house and you call the realtor, and then the realtor goes, oh, I have a listing. One of my listings is the perfect house for you. So they sell you the house, and they have the buy and the sell listing. they get commissions on both sides. I think there's some loopholes to that, but that's the idea of it. What is an agent? An agent is an individual that works for a broker-dealer on the state level, okay? On the FINRA level, we call them registered reps, but on the state level, we call them agents. Agents, you have to take the 63 or the 65, 66. You work for a broker-dealer executing transactions. Remember, you're an individual. Agents are always individuals. They work for the broker-dealer executing transactions on behalf in securities on behalf of the broker-dealer. They may charge commissions or not. I worked on the stock exchange for 20 years. I never got a commission. It was bonuses. I got salary and bonuses based on how much money we made trading and how much business we generated. It wasn't a direct commission. We just got bonuses based on that. Now, agent. So what's not an agent, right? So that's an agent. Agent works for the broker-dealer. They register at the FINRA level and the state level, wherever they have a place of business. They have retail clients, whatever. Now, what's not an agent is if your client's on vacation, you don't have to register there. But the other one is if you work for an issuer, not the broker-dealer. If you're an agent and you work for the issuer, okay, you work for the issuer and you do exempt securities or exempt transactions for no commission, they're not going to make you register, okay? What's aggressive trading? That just means you're being speculative. Aggressive, you're trying to beat the market. That's all it is, okay? Okay, what's an all or none order? So let's talk about order types since we're in here. It's an O, but it's an A. All or none means, so let's start with the beginning. I give you an order to buy at the market, you just buy it at any price. If I give you an order to buy at a limit, I say, listen, buy 1,000 shares at 50. I'm going to do that price all the time. I give you 1,000 shares. I give you 1,000 shares to buy at 50. You are going to buy it at 50 or lower, 50 or better. If I give you an order to sell 1,000 at 50, you're going to sell it at 50 or higher. Okay, that's a regular limit order. And if I give you the order to buy 1,000 shares at 50 and you only buy 300, and then at the end of the day, I have nothing else, well, then we cancel the 7, I take the 3 because that's what it is. But what if I have to take the partial execution? I have to. Now, what if I don't want that? I can do an all or none. I go, look, buy 1,000 shares at 50, all or none, which means, one, it doesn't have standing in the book because it's a special kind of order. But I give you an order to buy 1,000 shares at 50 AON, all or none. That means if you don't buy all 1,000 in one shot, I don't want it. Now, you can leave it out there all day trying to do it. But it's an all or none, meaning I do all of it or I don't want any of it. So you can't buy like 200, 200, 200, 200, 200. You have to buy all 1,000 in one shot. But you can wait all day to do it. You buy all 1,000 in one shot or I won't accept it. So you don't do it. Another one, a version of that is an immediate or cancel, which means I want you to buy 1,000 shares at 50. Try to get as much as you can. You can buy 300, 400, 1,000, but then put it out there once and then cancel it right away. I don't want to be out there. That's an immediate or cancel. Another type is a fill or kill. A fill or kill is fill it or kill it. So it means it's a combination of an all or none and IOC. That means I give you 1,000 shares to buy fill or kill. You go out there right now, you try to buy 1,000 shares at 50. You will not buy anything less than 1,000 or you don't do it. And then if you don't do that, you cancel right away. They're specialized orders, kind of bratty. Okay. What's alpha? Okay. Alpha. So first you have to get alpha, you have to know beta. Beta is a volatility compared to the market, risk, whatever it is. So think of alpha as what you do better than expected. Okay. Positive alpha, you did better than expected. Negative alpha, you did worse than expected. So if you have let's just do this. So let's say you have a beta of 1.5, 1.5. That's a multiplier. You're going to multiply beta times the index. So if the index, I'm going to do easy numbers. The index is 10%. You have a beta 1.5. You're going to do 1.5 times the index. That means your portfolio is expected to do 15%. Fair, that's your expected return. But what if you actually do 17? You're expected to do 15, but you did 17. So that means you did 2 points better. That's 2 points of alpha. That's all alpha is. Alpha is what you do better, and it's kind of like non-systematic. It's basically what you're doing. It's what you're doing better than you expected after netting. Here's the thing. Some of the vendors like to talk about the risk-free rate and do that. I don't really care about that. I'm just saying alpha is you're doing better than expected and is compared to your expected return. AMT, alternative minimum tax. Okay, AMT is an alternative minimum tax. It's for when you have some sort of tax deduction product that is tax deductible, if you want to call about it. We'll talk about them, where they take away your deductions. The more you make in income, the less you're allowed to deduct. So certain revenue bonds, not all of them, certain revenue bonds, they take all the money you're getting that's tax-free. If you make too much money or if it's subject to AMT, they're going to say, you know what? You can't take all of that. say you made 50 grand from a revenue bond and you make a lot, and they go, you know what? Yeah, normally if it's a GO or you're a normal person, you don't have to pay taxes on that 50, but we're going to make you pay taxes on like half of that or all of it, whatever it is. But that's AMT, is just takes away your deductions, and it's only applicable to really revenue bonds, not GO, and limited partnerships. So if you see a tax preference item or the word excessive deductions or excessive write-offs, they might be subject to AMT, where the AMT will go, you know what? You can't take those deductions. You have to give it back. And that's where this thing called recapture, which you may or may not see. Recapture is not a good thing. Recapture is you take a deduction and the IRS goes, no, we want that back. We're not giving you that deduction. You got to pay taxes on that. Okay. If you anti-dilutive covenant. So if you do a convertible bond, now remember, so if you have a convertible bond and say it's going to turn into 50 shares, okay? And so that's great. That's awesome. Whatever percentage of the ownership, that's really freaking tiny, but it is a percentage that you can count on. But what happens is, if the company issues more shares, well, then you're still only getting the 50. So the anti-dilutive covenant adjusts your ratio up based on, so if you're normally going to get 50 shares and they do a 10% stock dividend or issue another 10. So if they do a 10% stock dividend or a stock split, they're going to adjust your ratio to accommodate for that. You won't have to do the math on these exams, but just understand that if you have an anti-dilutive covenant on your convertible bond, they're going to adjust the ratio or the number of shares you get to keep your percentage ownership. Arbitrage. What is arbitrage? Arbitrage is when you capture an inefficiency in the market in two different markets, not the same market, two different markets. So like, when I was back in the late 90s and early 2000s, it was less electronic. So if on the New York Stock Exchange, you saw IBM trading at $40, and you also saw it trading at $41 on the Pacific or the P Coast, okay? You're like, wow, I can make money. So you would buy the stock on the New York at $40, and at the exact same time, not a second later, exact same time, short the stock at 41 in the P Coast. And then when you would just use the shares you bought to cover your short, you'd make $1, lock it in, no risk. That's a type of arbitrage. Other ones are merger arbitrage. When one company's taken over another for stock, there'll be differences, and you buy one and short the other to capture it. Not math. You're not going to have to do that. That's called merger arbitrage, risk arbitrage. That's what I did when I first started. Then we have convertible arbitrage, where if you buy a bond and you notice that if you were to convert and it would be a profit, that means the common stock converted, the amount of shares you get when you convert the convertible bond, you get a certain amount of shares, right? We should know this by now. Whatever that's worth, okay? If that's more than what the bond that you can buy is worth, you can buy the bond and short the amount of stock at the same time, and then convert the bond and cover your short. Just remember, convertible arbitrage is for convertible bonds when it will be profitable to convert. Arithmetic mean is just basically average. You take all your numbers, you add them up and divide. Say if you have 5 numbers, you add them all up and then you divide by 5. That's the arithmetic mean. That'll be tested if even maybe more than geometric mean. Geometric has a lot more parts to it, where it's like, well, how much traded at each number, and then you divide that and add it. That we always used to use that for volume weighted average price trades. But you won't have to know that. Just know if you see the word mean, it's average. And some exams make you decide between arithmetic and geometric. They're not going to. The real exam won't. Vendors do, because they're jerks. Okay, ask. Okay, what's the ask? So there's bid and ask. So we have the bid, which is where people are willing to buy, and the ask is where people are willing to sell. That's the bid ask that creates the inside market. Okay, the bid is where people are willing to buy. The ask is where people are willing to sell. If you want to buy stock, you have to pay. You have to buy it where people are willing to sell. So you pay the ask, and if you're going to sell, you're going to sell at the bid, because that's where people are willing to buy. Because you buy at the ask, you sell at the bid. Okay. And the difference is the spread of the inside market. Okay, so let's talk about, it's not really, it's an A, but if you want to give somebody a gift of securities, really nice, feel free to send them to me. I'll give you my Venmo, whatever. If you want to give me something, if you give me a non-assessable security, then it's a gift. It's fine. Because a non-assessable security means you give it to me. It's like giving me shares of Tesla. They'll never ask me for more money. But an assessable security means they can assess you and ask you to put more money in. I like to think limited partnerships are them. They don't say it's definitely, but I think, why wouldn't they be? Because if you buy a limited partnership they can always ask you for more money because it's a partner call. So a margin call, whatever you want to call it. I guess it's a partner call. So if I give you an accessible security, that is considered an offer and a sale, and it's subject to the jurisdiction. Even if I say, here's $20,000 worth of this accessible security, don't worry about paying me, whatever. The fact that the issuer could ask you for more money means it's accessible, and that's considered an offer and a sale and subject to the jurisdiction of the administrator of the state. Okay. What is an asset? Basically, it's basically something that a corporation or a person owns. Okay. An asset is what you own. And there's two types. There's current assets, which is like stuff you own like now, cash, or going to get in a year. And then there's fixed assets like equipment, buildings, long-term shit like that. Okay. Asset allocation. All you're doing is dividing it up, but you're dividing your portfolio up between like stocks, bonds, cash, shit like that. Okay. You're allocating a certain percentage of a portfolio to certain asset classes. That's all it is. Now, we talked about this before. A 10K is audited, is basically the issuer issuing audited financial statements. What does that mean? Audited means it's audited by a CPA or an auditing firm. And advisors have to do that. If you have custody, they have to do an annual surprise audit where their financials are going to be audited and they have to submit them. Okay, that's the A's. Let's go to B. So, well, I'm going to throw in here. So that's the A's. Well, let's jump into the B's for a second. So a back end load. Well, we have to know. So mutual funds have front end loads. Class A should be in the A's, right? Class A is a front end load. It's probably in the F's. Like Rader or O'Reilly filing system. So A is an A shares is a front end load. B is what they call a back end loan or a CDSC, contingent deferred sales charge. So A is a front end load. B is a back end loan, contingent deferred sales charge. What does that mean? That means that you pay when you leave, when you redeem the shares, okay? You don't pay anything when you come into the fund. And the longer you stay, so it deferred, that's the contingent deferred. The deferred means you pay when you leave, and the contingent means the longer you stay, the lower it gets. That's why it's called the contingent deferred or a back end. It's good for long term. A lot of places don't do them anymore. A is good for long term, a lot of money because they have break points, which I'm sure we'll get to. And then C shares, since we're here, they don't really pay a sales charge, so they can't be called a no load because they usually have a very high 12B1 fee. A no load fund has no sales charge, but a very low 12B1 fee, under 0.25% or 25 basis points. Okay, what's a balanced fund? A balanced fund is basically, they always have all portions. It's basically going to be, like it doesn't have to be 33% bonds, 30%, 33% preferred, 33% common. Okay, and they're going to give both income and growth. They're going to give both income and growth, but they kind of are safer or they're diversified because they have all three: stocks, preferreds, bonds. That's a balanced fund. Okay, let's talk about balance of payments and balance of trade. Okay, balance of payment is like basically how much money is going out versus coming in. It's for the most part exports and imports, right? So if we, you know what? Here, I think I have a way of doing it. So, okay, good. So let's say, so this is the upside, this is the surplus. The more we export, remember, the more we export, the more money we're getting, okay? So if we bring in money, if we bring in more money and we export more goods, people are buying our stuff, so we're getting cash. And if we're importing, that means we're buying other people's stuff, and then our money's going out. So what happens is that, let's say the dollar rises. So just hear me out on this, okay? So the dollar rises, that means it's harder for people to buy our stuff because it's more expensive. So if that happens, we're going to go more toward this way. As the dollar rises, we're going to go down, okay? We're going to be importing more because our dollar will buy more stuff, so we'll buy more things. Always money runs downhill. So here, now, as the dollar starts dropping, it's going to get lower. So this is right now. So if we look at this, what I've done so far is that our deficit is increasing. So our deficit, our balance of trade is going negative. It's going to be deficit, and it's going down. Now, and that's because the dollar's rising, we're importing more, we're spending more money. But as the dollar maybe starts dropping, our deficit's going to get closer to zero. And because we're going to get more and more closer to exporting. And then if the dollar really goes down, we're going to be exporting more and more and more. So the more the dollar drops, the more we go up, okay? We start exporting more, and that means we have more money coming in. So I always say, do we want a strong dollar or a weak dollar? We say we want a strong dollar, but we actually want a weak dollar, because if we have a weak dollar, people can buy our stuff more. So you have more exports. So all the foreign money is coming here. So this way we have a surplus on our balance of payments versus a deficit. So we'd like a surplus. And look, it's not this. It's like if depending on what, maybe corn's here and then wheat is here. And then it all depends on what we do. As a general rule, I think we're still on the importing more than exporting. But we'd love to be on the exporting more than importing because then money's coming in. Like with oil, if it's like we were importing more and then we were exporting more and now we're importing again. So it goes all over the place. And the problem is it costs us money and that hurts. Now, exporting is good because it helps our farmers, our producers, all that stuff. They can sell their stuff to bigger and bigger markets. And that's the thing. So like if you have a weaker dollar, right? So if your dollar's weaker, if you stay inside the country, you'll never freaking know. Like if you're in the middle of Mississippi and you've never left the state, whether the dollar's strong or weak doesn't matter to you on a day-to-day basis. But if you're a farmer, a weak dollar means there's more people buying your stuff maybe from other countries. So that's the balance of paid, balance of treatment. Okay. The balance sheet is basically just a financial condition. It's like a snapshot. It's a snapshot of the financial condition of the company. It has assets and liabilities on it. That's it. Assets and liabilities, and it's supposed to sort of balance out, right? Income statement is not that. Income statement is more about cash flows and money in, money out. So gross sales, gross income, that's going to be on the cash flow statement or the income statement. They're different things, but they kind of do the same. Balance sheet is about assets and liabilities. And again, some guy who's probably a CFA is, wait, you shouldn't say that. I'm talking about test world, not real world. A bank. So there's a bank and a bank holding company. So a bank is where you put your money. That's a bank and they're exempt from everything. Remember, under NASA and the states, banks are pretty much fucking ghosts. Okay. Nobody knows what they are. No, it's not that they don't know what they are. They just have no regulations. They have their own regulations. They're pretty much ghosts. They're not issuers. They're not broker dealers. They're not IAs. They're exempt from all that shit or excluded, whatever you want to call it. Now, bank holding companies are none of that. Okay. They're really exempt, but I should have said excluded. I'm just rambling. Bank holding companies are none of that. A bank holding company is literally just a company that owns a bank. That's all it is. It's a company that owns a bank. They're not exempt. So like think of like JP Morgan, okay? JP Morgan owns JP Morgan Securities and Chase. Chase is the bank. Chase, if they issued bonds, would be exempt. JP Morgan would not. Now, JP Morgan is exempt because it's trading on the exchange, but if they didn't, they would have to register anything they issued because they're not exempt. Bank holding companies are not exempt. Okay. Basis, just remember the word basis freaking means yield to maturity. Okay. Basis means yield to maturity. Now, the next one is basis points. Remember, 100 basis points. I'll put it on here. I've been doing this for years. Other people use it, but it's fine. I don't care. I'm ready to share the wealth. 100 basis points equals $10 equals 1% equals 1 point. Okay, on a bond. So if you earn 200 basis points or 200 bips, you're in 2% or you're $20 a bond. There you go. 100 basis points equals $10 equals 1% equals 1 point. Boom. Onward we go. Okay. Okay. Bearish and bullish. I guess we can talk about that. So bearish means you think it's going down. A bear market means it's going down. Again, it usually means it's down 20%, but don't worry about that. They're not going to ask you what is officially a bear market because a bear market is when the market has dropped 20%. Okay. Bear just means down. Bull means up, right? Okay. Bear down, bull up. It's like bulls gore up, bears swipe down. Whatever, however we remember it. Remember, you can make money either way, as a bull or as a bear. It's not like bears lose money and bulls make money. You can be bullish and make money, or you can be bearish and make money. And let's see. So if you're bearish, short stock, buy puts, sell calls, credit call spreads, debit put spreads, stuff like that. Inverse ETFs. If you're bullish, you buy regular ETFs, you buy calls, you buy stock, you do debit call spreads, credit put spreads, buy calls, sell puts. All those things are bullish. Okay. What's benchmarking? Okay. Benchmarking is when your portfolio is going to be benchmarked to an index. It's low cost. It's usually very passive because all you're doing is matching to a benchmark or an index, and you're just sitting on that. Okay. Indexing, all the same thing in general. Very passive, and you only kind of rebalance once a quarter. So if something gets out of skew or the index rebalances, you're going to rebalance too. You're not very active. The costs are lower than an active strategy. Black Scholes, just know that it's the way they It's the way they measure options for the risk. Okay, it's how they price options. That's all you have to know. Black-Scholes, you're just pricing options. Okay. Blue sky laws. Okay, what's a blue sky law? So blue sky laws are the state laws. That's all they are. It's basically registering a security, a broker-dealer, an agent, IR with the state. That's all they are. Blue sky laws are just about registering with the state. Okay. Okay, my favorite word, bona fide or bona fide, depending who you are, it just means real, okay? It means it's actually going to happen. It's genuine, authentic. It's actually going to happen. It's the thing, okay? So a bona fide offer is a real offer. A bona fide trade is a real trade. Bona fide market making activity is real market making activity. It's not like fake to pretend something. It's authentic. It's real. Okay, what's a bond? A bond is a form of debt issued by a corporation, by an issuer who is a corporation, a municipality, or a government, and it's a debt where you lend them money and they pay you back over time, and you get an interest, either interest every 6 months, or at the end if it's a zero coupon. Or those are really two choices. What's a bond fund? Now here's the thing. So an income fund isn't. So this is where people get confused. An income fund isn't going to be bonds. It doesn't have to be. Okay, but a bond fund will be corporates, munis, treasuries. Okay, so a bond fund is going to be looking for stable income that's pretty freaking safe. Corporates, munis, treasuries. Bond ratings, we know these, right? So the higher the rating, the better the company, right? So AAA is the top, then AA, then A, then triple B. Now triple B is the lowest investment grade. Now if it's Moody's, it's BAA instead of triple B. They use A instead of saying like S&P is AA. Why don't I just do it this way, right? It's just stupid. This is S&P. This is Moody's. Why is Moody different? Because he's fucking Moody. Okay. So these are all investment grade, BA and lower. So it would be B down here and then B. These are all speculative or junk or high yield. This line is big. Okay. This line between them, and that's why I make the space, is big. Because literally almost anyone can buy this. A lot of institutions and banks and stuff can't buy speculative. Okay. Let's talk about the bond yield. So we have coupon is just the annual stated interest rate. If you buy a 5% bond, a regular bond is paying $50 a year. That's nominal stated interest coupon. They all mean the same thing. Current yield, we should know this. Current yield is what you're earning based on what you spent. So if you think about it, there's a current. Current is electricity. What do they have in their amps? AMP. So it's AMP, annual over market price. Current yield is annual over market price. The other yields are the basis, which is yield to maturity, which you'll never have to figure out, and yield to call, which again, you won't have to figure out. But again, if it's a discount bond, it's coupon, current, yield to maturity, yield to call. That's on a discount. That's the lowest high. Coupon's the lowest, then current, then yield to maturity, then yield to call. And if it's I'm going to break my arm, I'll do it this way. If it's a premium, it's going to be coupon up here, then current, then yield to maturity, yield to call. Remember, yield to call is always on the end. A lot of people flip them. Yield to call is always on the end. Remember that. Okay, book value. It's basically the net worth of each share, right? So book value is like, think of the tangible assets of a company, the furniture, the trucks, the buildings, the equipment, all that stuff is that, and they divide that up by the number of shares. That's the book value per share. So the book value of the company is like the liquidation value. It's what it's all the tangible assets are worth. And that's the book value. Book value per share is that divided by the number of outstanding shares. And then price to book is the market price divided by that number. Okay. That works. And a high price to book or even a high price to earnings means it's a growth company. Low means it's a value. Okay. Breadth of the market. Okay. So the breadth of the market is just this. We look at how many shares are up or down in the day, not how much, how many. So we look at how many shares are up on the day versus how many are down. Okay. So like if you ever look on CNBC, they have the heat map. Like the other day, it was all red. Like maybe today it was all green. But if you look at it, if the market's down big, you may look at it and you have like, say there's 500 stocks, 498 of them are red. So that's the breadth of the market showing you that it's up or down, how deep it is. Because look, there were some years when the tech stocks were so up that even the market was mostly down. Those like 10 names were bringing it up. Okay. Like you'd see a big market, you'd see mostly red, but the market was up because those stocks who were very big would pull the market up, even though everything was down. So that's what you look at, the breadth of the market. It's to say, okay, the market's down. Is it like half red, half green? Is it all green? Is it all red? You get an idea of how strong this. Okay, the brochure. So what's a brochure? The brochure is a Form ADV, Part 2. Okay, Part 2A. So ADV Part 1 is what you file with the register, with the either the administrator or the SEC, whatever it is. That's the facts, like, what the name is, who the principals are, what kind of customers you have, how much money you have under management, all that crap. It's the facts, where you're registered, shit like that. Part 2 is the disclosure docs. Okay, that's the disclosures where you disclose everything. So that's called the brochure, or ADV Part 2A. Okay, ADV Part 2A is the disclosures for the firm. If they have any conflicts of interest, how they manage the money, how they get the fees, any kind of past problems, all that shit. But that's Part 2A. Now the brochure supplement is 2B. Okay, 2B or not 2B. So I'll put a Caesar thing here, right? So 2B or not 2B. Oh my God, I can't believe I said that. The 2B is the brochure supplement. That's like for you or your team. So you may have a team, and it'll be like the 2B will be like, oh, John he went to Oxford, blah blah blah, and Mary went to UPenn, and someone went to Stanford, or someone went to Stockton, whatever it is. Those are all the different. It's all their education and their conflicts and how they do the money and their expertise and all that. It's the disclosures for you. So 2A is for the firm. 2B, see, I should do the Pomodoro method and have that phone in another room, right? 2B is the brochure supplement. Now, both of them have to be delivered at or prior to the signing of the contract. That's the rule. That's the brochure rule. The brochure rule is they both have to be at or prior to the signing of the contract. But the state also adds in, hey, that's fine. But if you don't give it to them 48 hours before they sign the contract, the customer gets 5 days to back out, a free look. Okay. So again, the brochure rule is always deliver at or prior to the signing of the contract. Okay. But the state adds in the old, we want it 48 hours ahead of time. But if you don't, it's not a big deal. But if you don't do it, then you got to give them 5 days out. That's all it is. That's probably like 4 questions on the exam. Okay. What's a broker? Well, let's say broker dealer. We'll start with that. A broker dealer is a firm or a person, right? It's always a person, but it's always a firm that executes transactions for themselves or others. They register with the SEC, FINRA, and any state they do business in. If they don't have an office or retail clients, then they don't have to register. Remember, no office, no retail, no register. No office, no retail, no register. Okay. That is a broker dealer. It's a firm, as opposed to an IA that gives advice. It's not here. It's wrong letters. But the IA, and I'll get to it, investment advisor is a firm that gives advice as a business for compensation. Ooh, ABC, advice, business, compensation. Okay. And they rather register either the state or the SEC, never both. Okay. So a broker dealer registers with SEC, FINRA, and any state they do business in, and they are a firm. A broker dealer is always a firm, and they execute. So always remember, broker dealers execute transactions, they collect commissions, markup, markdowns, and some fees. IAs, they give advice and they charge a fees for the advice. We already talked about bull market. Okay, business cycles. These are the 4 cycles, right? So we have expansion, peak, contraction, trough. Okay, so expansion is when the GDP is rising, we have inflation, and the Fed is tightening during that to slow it down. Then we have peak, which is like it's coming up and it's going to start dropping. That's when everything's still going up. We may have disinflation, which means it's still going up, but it's starting to drop. Okay, it's going up, but not as fast. Oh, my jaws, I guess I'm talking too much. Now, just what I do. Okay, so now, and then what happened is right during that, the Fed will start loosening a little bit because they want it to go down. They don't want it to go down. They just want it to go down hard. They know it's going to happen. So they kind of they want a soft landing, right? So what's going to happen is going to start lowering rates and loosening. So during expansion, they sell treasuries and raise rates. That's monetary policy. And that's going to tighten and slow it down. And then once it starts going and they fuck it up and they make it go down, they're going to go, whoa, we got to help out. So they're going to lower rates and buy treasuries. So they're going to buy treasuries from the banks and lower the rates to make it easier to borrow. So it goes expansion, peak, contraction. And if it's a long contraction, it's a recession. And then it goes to a trough. Now, what's the definition of a recession? Well, it's 2 consecutive quarters of negative GDP. Although this year they go, well, that's not really true. But we go by that. Or you can say my neighbor's out of a job. What's the definition of a depression? Well, that's 6 quarters or 18 months of negative GDP growth, or I'm out of a job. So recession, my joke, I didn't make it up. I stole it. A recession is my neighbor's out of a job. A depression is I'm out of a job. Ha, 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 ha. Business risk is non-systematic. Okay. Non-systematic risk is business risk that you invest in a company. It just sucks. How do you get rid of that? You get rid of it by diversifying. Okay. Business risk, you just get rid of it by diversifying. And how do you do that? You buy mutual fund immediately, really quick. You buy ETFs, mutual funds, closed-end funds, ETNs not really, but similar. Okay, so you have trust. We have some sort of trust. I'm going to just do an order. Bypass trust is this. I'm married. I have a lot of money. Oof, please. Okay. So let's say I have a lot of money. I set up a bypass trust. So what happens when I die, all the money is in a trust to go to my wife, tax-free. And she can use the money, or he, whatever, they can use the money anyway, according to the trust rules, but the money's for them. But when she dies, the money goes to the children or the financial beneficiary. So a bypass trust is this. I have money, I set up a trust. When I die, my spouse gets it. They manage it, they're the trustee. And then when she dies, then the money goes to the children. And usually, if they do it right, it's tax-free. So that's what a bypass trust is. Okay, we're on to the C's now. Let's go. We're going in order, alphabetical order. Okay, I just did a video on this. Calendar year versus fiscal. A calendar year ends on December 31st. A fiscal year ends whenever they want. Like the government does, October 1st it starts. I think charities do July 1st. It doesn't matter. It's just a year. Fiscal is a year other, any 12-month period other than the calendar year. Okay. A call. What's a call? So there's a couple things. A call is an option to buy stock. Okay, we got that. A call is also when a company calls back their bonds or their preferreds. They buy them back from you. Call is always about buying. So if you buy a call, an option, you have the right to buy stock or whatever. If a company calls that they're buying the bonds or the preferred back. Okay, we have bonds, callable bond. That's a bond that is callable, which means the company can buy it back, as opposed to a non-callable bond, which is one that they can't call it back. They can buy it in the market if you're willing to sell it to them, but they can't buy it. They can't take it from you. A non-callable. Callable, they can. A non-callable would have a lower coupon, which is more attractive to the investor. Callable preferred, literally the same thing. It's a preferred that is callable. So again, we have bonds and preferreds. They're both callable and non-callable. When I get to that, I'm probably not going to talk about it. The call date, that's literally the date that they can start calling the bonds back. So if they say, oh, say a bond's issued in 2023, wow, and it's callable in 2028, that means the first time they can call it, that's the first date when they can start calling it. That's listed in the prospectus. Call feature, call provision, same thing. They're basically the ability to call the bonds back. That's what a call provision or call feature is the method or the allowance of the issuer to buy the bond back from you. And they'll say it's not callable for the first 5 years. That's also called call protection. Call protection is the number of years that the issuer can't buy it back. So you're sort of protected from being called. That's most attractive when interest rates are dropping, because normally issuers will buy the bond back when rates are dropping, because then they can buy it back at a cheaper rate. They can buy it back and then issue a new bond at a lower rate and save money. What's call risk? Well, when interest rates drop, the risk that the company will buy the bond back. And why is that bad for you? That is bad for you because if you're the investor and they call it back, they usually do that when rates are lower. So you get your money back. You're like, yeah, I got my money back. And then when you go to reinvest it, everything's at a lower rate. So you would actually have to find a riskier bond to match the rate you were getting before. So that's not a good thing. What's capital appreciation? That's literally growth, an increase in what you own. If you buy something at 40 and it goes to 50, that's capital appreciation. What's a capital asset? A capital asset is basically something you can touch, like property, and it's for long term, like equipment or a building or something. That's a capital asset as opposed to a current asset, which is for a year or less. Okay. CAPM, capital asset pricing model. CAPM is basically trying to determine the relationship between risk and reward. Systematic risk and reward. Are you getting enough return for the risk you're taking? To get this reward, you need this risk. To have this risk, you better get this reward. So it's all about the relationship between risk, systematic risk, and reward. Capital gain, that's actually a realized appreciation. So if you buy stock at 50 and you sell it, you have to have a gain, a cost basis, and a proceeds. You have to have a buy and a sell. So capital appreciation, capital gain is when you realize the capital appreciation, okay? Capital gain is when you buy stock, it goes up, and then you sell it for a gain. Or if you're short stock and it drops, and you buy it for a gain, and it's a taxable event, okay? Capital gain is when you have a buy and a sell, or a sell and a buy, and you actually realize the gain. Capitalization, that's basically all of what the company's worth. You add up the debt, the stock, and everything else, all their cash and everything, and that gives you the capitalization, what it's worth. Okay, so capitalization ratio is dividing its debt by all its capitalization, the bonds, the stocks, all the other surpluses, cash, and all that. So it's debt divided by the capitalization. It's to determine, we do the capitalization ratio to determine whether the company is over leveraged or under leveraged. So if you have the debt capitalization ratio, if you have more debt, if you have a very high capitalization ratio, that means you have a lot of debt and you might be over leveraged. What's a capital loss? That's the opposite of a capital gain. A capital gain is when you sell stock or something for more than you bought it for, you have a gain that's taxable. A capital loss is when you sell something for less than you bought it for and you realize a loss. And actually, you get to write that off your taxes, right? Good stuff. Now, capital losses, you can use capital losses to offset all capital gains, but you can only use $3,000 of capital losses to offset your income. Then you can carry forward the rest to the next year. Okay, so we have capital market and then we have money market. So capital market is like long-term debt and equities, anything over a year, and then money markets are under a year. Technically, I think 13 months kind of works, but anything over a year is a capital market. Money markets is anything a year or less or really short term. Capital stock is all of the corporation's equity, preferred and common. Boom. But they're listed at par. So it's not the actual market value, it's the par value. You remember, so par value on common stock is $1, on preferred is 100. So it's all the common and preferred based on their par value, not on the market value. So capital surplus, paid in capital, paid in surplus all mean the same thing. Capital surplus, paid in capital, paid in surplus all mean the same thing. Those are all what you sell the stock for over par. Now, common is usually $1. So if you do an IPO with the stock at $20, it's $19 of capital surplus, paid in capital, paid in surplus. Capping, what's capping? It's manipulation. It's way to keep the stock down. So there's capping, pegging, all that stuff. Again, don't Google pegging, please. Don't do it. Don't do it. Stop right there. Don't do it. You're going to hate me. Okay. Capping is when you're selling something or doing something to push the price down so it doesn't go over a price. A lot of times it's to either make your P&L look good or to prevent an option from being exercised or to force an option to be exercised. Pegging is when you buy and sell to make it close at a certain price. Remember, capping is keeping it down. Pegging is trying to get it to go up. You're going to buy or sell to get it closed at a certain price. Very similar to capping, just it's both buying and selling. What's a cash account? A cash account, as opposed to a margin account, a cash account is where you pay 100% for everything. So there's really two types of accounts. There are other little nuances, but for the most part, we have cash accounts where you pay 100% for all your stock and everything. You can't short in it. You can do some options in it, but you can't really short or use, you're not borrowing. And then there's a margin account. A margin account is when you borrow against it. You take on, you had a debit balance, you can short in it, you're borrowing money to buy stock. So I have a margin account that before I had $2,000 in it, I can only do cash transactions, pay for everything. Once I had $2,000 in equity in the account, I could start borrowing against it up to 50% of the value of the stock. What's a cash dividend? A cash dividend is when the company pays its profits in the form of cash. So there's cash dividend, there's stock dividend, and then there's product. Okay, so they can give you, like Gillette can give you razors. I'd be pissed. But like I said, that's when I was a kid. I bought Playboy stock, hoping it never happened. Okay, although the annual report was pretty cool. It's only annual report with a picture of a woman in lingerie. Okay, so again, cash dividend is when you get paid cash, usually quarterly. They announce it. That's where the DERP, declaration, X, record, payable, right? Declaration a day. They announce it. They announce and they name the record day. That's the day you have to be an owner of record. The day before that is the X day. That's the day if you buy it on the X day, you don't get the dividend. Remember, X dividend, ex-girlfriend, ex-boyfriend, ex-wife, X dividend without. Then P, DERP, declaration, X, record, then payable. Payable is the date that they actually pay the dividend. What's a cash equivalent? It's something that can be readily turned into cash. T-bills, CDs, money markets, and stuff like that, money market funds and stuff. Cash equivalents are anything that can be turned easily, very, very quickly into cash. Like I always joke that technically you could walk into a bank with $100,000 worth of T-bills and be out of there in 5 minutes or so with $100,000 in cash. It's just that liquid. Okay. Cash flow. That's what the company gets minus any money paid out. So if we bring in money, but we pay out. So if you bring in $100,000, but we pay out $30,000 in expenses, our cash flow is $70,000. It's basically net income plus depreciation or depletion. Okay. So net income is how much we get. So we bring in 100, we spend 30, we have 70. Then any kind of depreciation or depletion we come out, That's going to take out of that. Good. A cease and desist order. That's what an administrator can do when it appears that a person is going to commit a violation or did. You send a notice and say, please stop what you're doing. It actually has no bite, right? So if they just go, screw you, I'm going to keep doing it. Then what would happen is then the administrator, who really can't do anything, they threaten you and shake their hands at you and say, stop that, you young whippersnapper. They would say that, but they can't do anything. Well, it just got blurry, right? So I'm moving too much, it got blurry. So then they would go to the court and have the court issue an injunction so they'd be enjoined, which then has bite of the court as legal ramifications. So a CD is where you deposit money with a bank or in a security for a set amount of time, and it pays you interest. They can be short-term, they can be long-term. The short-term ones probably pay at the end. They might pay you. But the whole point of a CD is it's very safe, usually very short-term, and it's usually a money market under a year. Over a year, it's obviously not. And if it's over a year, it can pay income. If they do a market CD or like a negotiable CD, there are other feats. We're not going heavy into that here. I'm just saying what a CD is. It's a short term. Basically, you put money with a bank and you get it back at the end of the term. You can then reinvest it and buy new ones if you want, whatever. Short term debt. What is a chartist? That's like a technical trader. They look at charts, trends, patterns. They're looking at charts to determine like the 200-day moving average, support, resistance. That's a technical trader. They use the movements of the stock to determine where it's going next. Obviously, efficient market theory doesn't believe any of that shit, okay? We'll get to that. So the point is, a chartist is a technical trader who looks at charts and tries to predict the next movement based on that. You look at support, resistance, breakouts, all that stuff, okay? What's a Chinese wall? So a Chinese wall is known as an information barrier. A lot of times big companies, like they have to have some sort of Chinese wall. And it's not racist because it's basically based on the fact that the Great Wall of China surrounds, was supposed to, is invincible. You can't get through it. So they just called it that. You're on either side of the wall. Like investment banking can't be with research. They have to have a Chinese information barrier so they can't talk to each other. It prevents the spread of inside information. So an information barrier or Chinese wall is there between different departments to keep them separated so they can't share information or have conflicts of interest. A lot of times they'll have these information barriers between small departments, even if they don't have to, so that if I get an order in this and you're on the other side of the wall and you get an order in that, we don't have to worry about front running or anything like that because we're separate. Like if I get an order from a customer to buy and you're on the other side of the wall and far enough away from me, you can buy stock without worrying about being front running, because you don't know about it. What's churning? Churning is excessive trading, okay? Churning is when you excessively trade an account. You need this, or it's either excessive or unsuitable, whatever it is. Remember, they look at stuff to determine if you're churning. They look at like what the character of the account. Is the person rich? What's the rich? What's the objectives? What they do not look at is gain or loss. Gain or loss has nothing to do with whether you're churned or not. You can make money and they can still be, they can still be considered a churning even if they make money. Closed-end investment company. What is it? So we have open-end and closed-end. An open-end is a mutual fund. I think an open-end is a mutual fund. You buy it at NAV plus a sales charge. It trades once a day. They constantly issue, you should know this by now, a closed-end fund. It issues shares one time. They issue the shares, and then it's on the exchange. And if you want to buy shares of it, remember, they're both closed and open-end are actively managed by a rich portfolio manager. He or she lives in Greenwich and makes way too much, or Hamptons. They make a lot of money. They're an investment advisor managing the portfolio, which means they have to be federally covered advisor. But the closed-end fund issues shares one time, and then if you want to buy them, you have to buy them on the market based on supply and demand. You buy at the ask, you sell at the bid, and they charge you a commission or markup, mark down. You can short them. You can buy them on margin. All that stuff you can't do with a mutual fund. Open-end, issue shares constantly. You buy at NAV plus a sales charge. It's priced at the end of the day. No margin. Okay, so we have opening sale, opening purchase, whatever it is, opening and closing. So if you have an option or even any position, if you create a position, it's an opening. So if you buy an option for the first time, that's an opening buy. If you short an option for the first time, that's an opening sale. So if you do an opening buy to create an option, how do you get rid of it? You have to sell it. That's a closing sale. So an opening buy followed by a closing sale. Jumping down on the other side. So if we short an option for the first time, doesn't matter call or put, that's an opening sale, and that's followed by a closing purchase. So it's always going to be opening, then closing, and then it's either buy, then sell, or sell, then buy. That's the way it works. And closing means get rid of it. Okay, what's a coincidence? So the indicators, right? So we have three types of indicators. We have leading, lagging, and coincident. We put them all together. A leading indicator, it's like the stock market. It tells you where we're going to be in the next 6 to 12 months. I explain that all the time. Everyone was trying to figure out, not everyone, people who didn't know. Sounds like I'm an elitist, but I'm not. They didn't know, why was the stock market ripping up during the pandemic? Because they weren't thinking about now, it's predicting the future when they think the vaccine will be out and all that stuff will be out of it. So that's why the stock market was ripping up, because it's a leading indicator. A coincidence is telling us where we are, like employment, personal income, industrial production. Those are all coincident. That's telling us where we are. Then we have lagging, telling us where we were. That's like in corporate profits. They reported at the end of the year in a 10K, right? So leading is telling us where we were. Coincident is telling us where we are. Lagging is telling where we were. Let's say that. Leading is telling us where we're going. Coincident is telling us where we are. Lagging is telling us where we were. Okay, good. What's collateral? Collateral, like when you borrow money, you have to put up collateral. Okay, it's not collateral damage, it's collateral. Okay, so collateral is when you put up something to borrow. So if I went to go borrow $50,000, they say we need some collateral. I put my 2 or 3 cars on there as collateral that if I don't pay it, they pay me out. They sell that. Okay, they sell that out from under me. Okay, so what's a CMO? A CMO is a mortgage-backed security. You should know this, some of this by now, if you've taken this exam. But a mortgage-backed security, or a CMO, is big picture. When you buy a house, you pay a mortgage, you're paying into the mortgage. The bank who you're paying the mortgage to is getting an income. They sell that to someone else who's now getting the income. And what they do is they put a bunch of mortgages in a pool, and then somebody buys pieces of this. I can probably put the video up here to explain it. But I'll put a link in the description. What is a CMO? So a CMO is a mortgage-backed security. It has prepayment risk, it has extension risk, because if rates drop, people refinance their mortgages, and all of a sudden your income stream drops, and you're getting monthly income. Remember that you're getting monthly income. Okay, a collateral trust bond. Let's talk about secured bonds. Okay, we have unsecured bonds, which are debentures. Unsecured corporate bonds are debentures. Then we have secured bonds. We have 3 types that we think about. We have mortgage bonds, which are they're not mortgage-backed securities. They're mortgage bonds. They're just backed by property. So if I default on the bond, they sell the property to pay the investors, the creditors. Then we have an equipment trust certificate, which is basically we issue a bond and we use like trains, planes, a fleet of cars, boats as collateral, equipment as tractors as collateral for the bond. And if we default, they sell that, and hopefully that's enough to pay for it. Then we have a collateral trust certificate where I'm a company, I have a portfolio of securities or something. I'm going to use that as collateral for the bond. And if I default, they sell that. Hopefully it's still around and get that. Okay. Commercial paper. What's commercial paper? It's a short-term unsecured. It's a short-term unsecured bond. It's 270 days or less. It's issued at a discount, like a financial company would say, oh, we need money for the next 9 months. So they'll issue a commercial paper for like, $1 million, $999,000, and then they'll pay back $1 million at the end or something like that. So it's short-term, unsecured, promissory note. We promise to pay you. It's 270 or less, so then it's exempt. Now, it's exempt from federal, but to be exempt from state also, it has to be 270 days or less, top 3 credit rating agencies, and it has to be a minimum denomination of 50 grand. That means you cannot buy a $30,000 commercial paper. It's 50 grand, so it keeps the retail people out. So what's a commission? Okay, so commission, or let's go along with that. So commission is, remember, ABC, agent, broker, commission. A commission is when you act as an agent and you charge a commission for doing a trade. So if I do a trade for you, I'm the middleman, I'm acting as an agent, I'm going to charge you a commission. You buy stock at 50, you bought it at 50, I find a seller for you, I don't do it myself, I charge a commission on top of it. Much like if you go to buy a house, the agent's going to charge you a commission on top of the price of the house. As opposed to a markup, markdown is when you act as a principal. So if you give me an order to buy stock at 50, I'm going to sell it to you out of my own portfolio, out of my own inventory. I'm going to sell it to you, and I'm going to charge you a markup. You give me an order to buy stock at 50, I'm going to sell it to you at 50 and a quarter. That's a principal, okay? Principal transactions. Remember, ABC, agent, broker, commission, and then PDM, principal, dealer, markup. What's common stock? That's basically just the ownership of the company. That's the one you see on there on CNBC and stuff like that. It's the lowest form of ownership you own stock, you buy it, you can buy shares. If you buy all the shares of a company, you're actually the owner. It's just basically the ownership of the company. It's a form of equity. It's the lowest one. It's the last to be paid, but it does have the highest risk and highest reward because it moves with this company. If the company does well, it goes up. Hopefully, the company goes down, it goes down. So we have two types of trust. We have a complex trust and a simple. A complex trust means that you set up the trust. We have it, I'll talk about trust later in general, but a trust is like an account that you set up that you put your money in. Let's go through it. So it's either revocable or irrevocable first. So an irrevocable trust is you set it up, you're the grantor, you name a trustee, you name your beneficiaries, could even be you for all of them, and you put the money in. And if it's irrevocable, once you put the money in, it's up to the trustee to decide where the money goes. You can't take it back, but it is not taxable to you anymore. It's not in your estate. It's just on the trust end. Then we have a revocable one, same thing, but you put the money in, but it's still yours. You can take it back anytime you want. But remember, so you put the money in. If it's irrevocable or revocable, the trustee is going to manage it for the beneficiary or the beneficiaries as a whole, not just one or the other. If there's more than one beneficiary, they manage it as a whole. So that's revocable versus irrevocable. Revocable, you can take it back, you can revoke it, or irrevocable, once it's in there, you never touch it again. Now, the other part of it is there's a complex and simple. Complex trust means that if you put money in and it earns, you can either decide to pay it out based on the rules or let it build. You don't have to do anything. A simple trust, all of the growth has to be distributed every year. So a complex, it can hold it and let it grow. A simple trust, all the earnings, not the corpus, not the body, not the principal, but the earnings of the trust have to be distributed each year. Okay, so let's think about back to the mutual funds. Conduit theory. Okay. Conduit theory is the fact that if you have a mutual fund, they pass through the gains, and that's it. They pass through 90% of the gains. As long as a mutual fund passes through 90% of the gains, you, the investor, are going to get the money that's never been taxed yet, and then you're going to pay taxes on it. The reason that's a big deal is it's like a corporation. A corporation, they earn money, they pay taxes on it, and then they pay you, so it's double tax because it's taxed on their end and then on yours. So in a corporation, the IRS pretty much takes like 70% of the money. It's crazy. And they still don't have enough. Okay, so conduit theory means it's flow through, like a conduit. I don't have a pipe, but like if you went through here, the money goes through the conduit, goes right through the mutual fund and right to you, 90% of it at least. Okay, what's a confirmation? A confirmation is basically after you do a trade, you have to get a confirm, usually by completion of the trade, which is settlement, that lists, like, in general, not good the whole thing, but what you bought or sold, how many shares, what it cost you, whether what the commissions were, the net prices, if it's a bond, whether it's callable or not. It's going to give you the yield to maturity or the yield to call. It'll give you maybe the exchange where it's executed on. It'll give you the date, but it doesn't have to give you the time, but it does have to tell you that it's available. It'll have your account number and it'll have the name of the firm and all that on there. It's a confirm. Okay, it's a confirmation. Okay, so what's a constant dollar plan? It's basically a formula of you're investing in a portfolio and you're keeping a fixed dollar amount of each asset class, not a ratio, a fixed dollar amount. So what happens is if it goes too high or low, they have to either add or subtract. So they're keeping it at $1, not a percentage, they're keeping it at $1, like 30 million in this or 2 million in that. And that's, if it gets too high, they'll rebalance it, sell it to bring it back to that. Or if it's too low, they'll buy more to bring it up to that. They always want to keep it at a fixed dollar. Literally have no idea why someone would do that, but whatever. Okay. A constant ratio plan is basically the same thing, but everything's on a ratio, like percentages. Okay, 30% this, 30% that, 20% this. It's always going to be that. And then every quarter or so, they'll rebalance it if it gets out of whack and bring it back to those ratios. That's sort of passive. That's a type of passive management. Okay, what's the CPI? Consumer Price Index. It's the measure of inflation. Right now, we all know that if it's 2023 and you're watching this, we know inflation's been crazy. CPI is a consumer price index. It measures inflation. Okay, consumption is basically the purchase and use of goods by households. It's it's not so much eating, but it's buying and using services and goods. Okay, contraction. Okay, so we have the four business cycles: expansion, peak, contraction, trough. So contraction is when it's dropping. Expansion is when the GDP is rising. Things are getting better. I might have done this already. Things are getting better. That's when the Federal Reserve will tighten. And then we get to peak. That's where top, it's going up, it's still slowing down. That's where disinflation happens. What's disinflation? That's when we still have inflation, but it's less. It's going up. Like it was 8%, 7%, 6%. It's still going up, but at a less rate. That's kind of what we have now. So everyone's like, oh, inflation's better. No, it's still going up at a ridiculous rate. It's just not going up as fast. Okay, that's so contraction is when it's dropping. I got on a diatribe, right? Whatever they're called, a rant. So expansion, peak, contraction. Contraction is when the GDP is dropping, the economy is getting worse. A long one turns into a recession. And during that time, the Treasury will loosen the economy. They will buy treasuries from the bank to inject money, and they will lower rates to make it easier to borrow. What's a control person? A control person is a partner, officer, director, the pods, or a 10% owner of more than 10%. I shouldn't say 10%. So someone who is more than 10% or a pod, partner, officer, director, they usually have, if it's for an investment company, it's usually they own more than 25% of the vote. I think the same thing for broker dealers. By the way, also, the spouse of a control person is an affiliate or control person. No, they have the rules that if the control person of a public company and they want to sell their shares, they have to follow the 144 rules. They can sell the greater of 1% of the assets, 1% of the outstanding, the 4 weeks trading volume, 4 times a year. Wow, 144. Greater of 1% of the greater of 1% of the outstanding shares, 4 weeks trading volume, 4 times a year, which is every 90 days, kind of built into the price. Control security. It's basically shares. I've never really heard someone talk about it that way, but a control stock is owned by control people, so they have to follow the 144 rules. Okay. Conversion parity. So convertibles. Let's talk about convertibles. So convertibles are securities that turn into common stock. Okay. I don't think on the 65 or 66 you have to do the math, but we have videos on that. So convertible bonds or preferreds or convertible securities are securities that turn into common stock. So they will have a conversion ratio, which is how many shares you get. They will have a conversion price, which is at what price it gets converted at, which is just a number to figure out the ratio. And then the ratio will tell you how many shares you get. And then you're going to multiply that ratio. We should all know how to do this. You're going to use that ratio, multiply it times the common stock price, multiply the ratio times the common stock price to get what the parity is, the conversion parity. And then if that number, so think about it this way, I buy a bond, it turns into common stock. If the amount of shares that I could turn into is worth more than the bond, I would convert the bond into the stock because they get a discount. If the value of the stock is less than the value of the bond that's trading at, I would not convert because I'd be losing money. So convertible bond is a bond that's convertible. Convertible preferred is a preferred that's convertible. Bonds pay income every 6 months. It's a debt. Preferreds paid quarterly, and it's an equity. Okay, convexity. Don't have to go crazy on it. It's probably a wrong answer. But remember that we know that duration is how volatile a bond is, right? So the problem is the difference between an 8-year bond and a 10-year bond and a 12-year bond. We know that the 10-year and the 12-year bond move more, but it's not a straight line. So it's kind of curved, okay? So like maybe the 10 moves a lot more. It's not exactly equal. Like if you have a 6-year, an 8-year, and a 10-year bond, they're not exactly the amount. So like the 8-year may move 3 times as fast as a 6, and then 10 may move 4 times as fast as the 8. So it's not, and that's what convexity measures. Basically the curvature of the speed at which things move. Again, you don't have to do the math. No, I always say this one. Duration is how much a bond moves. Convexity is how fast it moves. I don't think it's exact, but it's kind of showing you the difference between the two. Okay, cooling off period, right? The cooling off period is what? When we issue a stock for the first time under the Act of 33, we'll file a registration statement, and then we start a 20-day cooling off period. That 20-day cooling off period, the 20-day cooling off period, we can't sell the bonds, we can't sell the stock, we can get indications of interest, we can set out a red herring, we can even register it in the various states, blue sky. We can't sell it, take money or anything, but we can do that during the 20-day cooling off period. At the end of the cooling off period, the SEC declares it effective. They don't approve, never fucking approve. Remember, no regulator ever approves anything ever. So they just declare it effective. They say, hey, we didn't find anything wrong with it. It's not a big deal. Okay, a corporate account or a partnership account. A corporate account is a corporate account. You have to have certain documents. You have to have the articles of incorporation or the charter, and you have to have a name of someone. Okay, you have to have a name of someone who can place orders, what they call an authorized representative or authorized trader or authorized individual who can place orders for the corporation because it's not an individual. Now, if it's a partnership, it's not a joint account, it's a partnership. It's for a partnership, and you need probably the signature of the GP and the partnership agreement. What's a corporate bond? A corporate bond is a bond, debt issued by a corporation. So remember, a bond is when the investor lends money to an issuer. So corporate bonds are issued by corporates. Then we have munis and we have treasuries. They all have their own things. Corporates, fully taxable, like Tesla would issue a bond. And muni is like a city or state issuing a bond. And normally, if you buy it in the same state you live on, it's tax-free. The interest at least is. And then treasuries, they're issued by the federal government. The thing about them is they have no default risk, pretty much, except for what's going on now with the debt ceiling. There's no default risk. But so corporates, you pay tax on every level. Munis, you don't pay federal, but you might pay state unless you buy it in your own state. And treasuries, you pay federal tax, but not state tax. What's a corporation? It's one of the types of setting up. So we have different types. We have sole prop, which is just like one person. Okay, just one person setting up. You have no limitation of the risk. You have unlimited risk. It's super free. Like when I first started teaching, I did a sole prop because it didn't matter. I didn't have risk or anything. Now I'm doing other projects, so I have to create something else. So a sole prop is just me alone. You can't really transfer it. There's no continuity of life. When I die, it's over. Then I can go up to an LLC. An LLC is a limited liability corporation, company, whatever you want to call it. They can have as many members as you want, but it has limited liability. Like if you're a member, you can only be sued up. You can only lose what you put in unless you're committing crimes. You have one member, you can have a single member LLC or hundreds. Okay. They pass through the gains and losses. That's the thing about the next three things I talk about. They pass through the gains and the losses. What does that mean? That means we get the money, the partners get the money, not the corporation or the company. And they also get losses. They don't owe the money. They get a piece of paper. That's a write-off. So LLCs, partnerships, and S corps all pass through. So that's an LLC. A partnership, there's two types. There's a general partnership, which is just partners. General partners, they get together. It can be verbal. We run a business, but if it just says partnership, it doesn't mean limited. If it just says partnership, that means that they have unlimited risk and they can all run the company, but the partnership. If it's a limited partnership, we have limited partners that just put money in. No, they can only lose what they put in, but they can't run it. And then general partners of the GPs and LPs. They have a GP who runs it and an LP who just drops the cash. LPs can only lose what they put in. GPs can take on unlimited liability. They're also paid last, okay? But if they just say limited partnership, it's an LP GP thing. You have to have one of each. If they just say the word partnership, it means general partnership, which means everyone has unlimited risk and everyone can be involved. Keep that in mind. An S Corp is a corporation with up to 100 investors, 100 shares, I should say. There's a lot of nuances to that, but it's fine. 100 shares. All the shareholders have limited loss. They can only lose what they put in, and it does pass through gains and losses like the other two. Then we have the C Corp. Basically, every company you've ever heard of is a C corporation. They do not pass through. It's the most expensive. It's the best way to raise a lot of money. You can have an unlimited number of shares pretty much, and you can just authorize them, you issue them, they're outstanding, all that crap. As they get paid, the actual corporation pays taxes at the corporate rate, and then they pay dividends, and then you pay taxes. So the problem with the corporation is it's double tax, but the good part is it's the best way to raise a lot of money. Okay, correlation. Correlation is how two assets run with each other. So a correlation of one means they go up together, down together, don't move together, all the same. You don't want that. You don't want positively correlated. It goes 1 to -1. 1 means they're perfectly correlated the same way. 0 means they're not correlated. And then -1 means they go opposite the same amount together. Okay. You want non-correlated. You want this because they want diversification. You want this to go up and this not. You do not want them to go together because good is good, but bad is really bad. You don't want them negative correlation because how can you make money if they both go the same amount the opposite ways? So you want non-correlated assets. They have nothing to do with each other. That's perfect correlation. Okay. So perfect correlation is when they move together. I guess perfect negative, pure negative is -1. They move exactly opposite. What you want is non-correlated, so they have nothing to do with each other. Good. Okay. I think we talked about this already. Cost basis is what you paid for something. Cost basis is what you paid. You bought it 20. They have adjusted cost basis, like if you put more money in or you get payouts and stuff like that. But cost basis is what you pay. Proceeds is what you sell it for. And the difference is your capital gain or loss. Okay. Coupon yield, it's like, so if you coupon, nominal, stated, and interest mean the same thing. Coupon, nominal, stated, and interest all mean the same thing. It's the coupon rate. So if you buy a 5% bond, it's paying 5% of par. If par is 1,000, it's paying 5% of 1,000. It's $50. The coupon never changes. Remember that. Once a bond is set or a preferred is set with a coupon, that's it. Covered securities, those are federal covered securities. That's like, for the most part, munis are a little bit if they're a certain way, but we're not going to talk about that. We will. So mutual funds are covered, New York Stock Exchange listing, shares sold to qualified purchasers which is 5 million or more. Reg D 506C is federally covered, and munis issued in another state. So munis are always exempt. But if you buy a municipal bond in your state, it's exempt because of the USA state law. But if you buy a muni bond issued in another state, it's still exempt, but because of federal law. That's why it's a federal covered security. Okay, what's credit risk? It's the same as default risk. Credit risk and default risk are the same. That if you buy a bond that's not a treasury, you have credit or default risk. It's a risk that they won't pay you. How do we measure that? We have the credit ratings. AAA, AA, triple B. Those are the best. Did I do this already? I feel like I did, but whatever. So then we have Moody's is little a. AA. I've done this already. I've done this a million times. The bond ratings. So we measure credit or default risk by the bond ratings. The higher it is, the less risk we have. AAA is the best. They have hardly any default risk. Anything below triple B is speculative or junk. They have higher credit or default risk. So what's a credit spread? Okay, so that's on this test. A credit spread is basically when you have a buy and a call. You have two calls, you buy one, sell the other, and the sell call is more expensive than the buy call. So you're bringing in money, or if it's two puts, buy and sell a put, the sell is more expensive. But I don't think that's what we're talking about here. We're talking about a credit spread, which is the difference between yields in two securities. So like if we look at, that's the interest rates, that's the years. So we have a bond, that's treasuries, the shorter term, lower rate, higher term. Then we have corporates, okay? So these two, so the spread here, this corporates will always be higher than the treasuries, always, because these have no risk, these have risk, default risk. So what happens is people measure the difference. And if it gets narrower, okay, that means oh my God, I can't speak. The economy is getting better because people are buying the corporates, forcing the price up and the yield down, and they're selling the treasuries, putting the price down and the yield up. So getting closer together means economy is getting better. But if they're getting wider apart, that means they're running to safety. They're selling the corporates and buying the treasuries. So that's a sign of a bad economy. So if you see the yield or credit spread widening, that's a sign of a bad economy. If it's narrowing, it's a sign of a good economy. Okay, then there's different types of preferreds, right? So we have regular preferred. It's a preferred stock that pays you every quarter. Boom, boom, boom. And it's consistent. It's like a fixed income. They don't have to pay. They're supposed to pay. But what if we miss a year, right? So if we miss a year or two, it's fine. I mean, it's not a big deal. There's nothing you can do about it. But they made it so we don't owe you the money, right? So if I buy a 5% preferred and you don't pay me in 2020 and it's now 2021, there's literally nothing I can do. I can yell at you and say, please pay me, but you don't have to. Unless it's cumulative preferred. Cumulative preferred means that even if they miss the previous 3 or 4 years, before they can pay anything to the common, they have to make up all the past payments. So if they miss my payment in 2019, 2020, and 2021, in 2022, they got to pay me. If they want to start catching up and pay the common, they got to make up all those past years. That's cumulative preferred. Participating preferred means you have a normal coupon 4%. You should know the basics, right? So normal 4% preferred is paying 4%. But if the company has a good year, like say we have a really good year, they'll give you a little bit more that quarter or that year. So you have 4%, maybe it bumps up to 5%. You get an extra % or 2, and then it goes back down to the original when they have a good year. So you get to participate in the earnings growth of a company if they do well. Okay, so the cumulative, and then we have participating. Cumulative, you pay the past dividends. Participating, you get to participate in the earnings, so they give you a little bonus if they have a good year. Okay, current assets. Current assets are assets that we have, cash and other assets that were expected we can convert into cash or get within the next 12 months. Okay, so basically, cash, accounts receivable, inventory, and prepaid expenses. That's all stuff that we're going to get back. The reason prepaid expenses are, so let's say I pay the rent over the next 4 months. I prepay that. I'm getting that service over the next 4 months. I'm getting the rent. I get to stay. That's why. Current liabilities are what we owe. We owe that in a year. That's current liabilities, accrued wages payable, current part of long-term debt. So if we have a bond and we pay, we owe that money, what we owe in this year with interest payments, that would be considered a current liability. And remember, so current ratio is current assets divided by current liabilities. Quick ratio is current assets not including inventory divided by current liabilities. And working capital is current assets minus current liabilities. Current market value is really just what the stock is worth right now. CMV, they call it current market value. I did current ratio. Okay, current yield. Now let's see. So current ratio is the same as before. I just gave it to you. Okay, so current yield. Okay, current yield is basically what you're earning when you expend, when you buy a bond. So if you buy a 5% bond and you pay $900 for it, you're getting $50 because remember the coupon is always based on par. So if you buy a 5% bond, you're getting $50. If you paid $900 for it, you're still getting $50. So what's your return? You're going to do 50 divided by 900. You buy a 5% bond for 90 or 900. Okay. So you get the current yield. You're going to say, what's it? What am I earning? So remember, as my one friend said, he said, current yield is like electricity. Electricity has amps. So you do annual divided by market price. So you're going to do annual divided by market price to get your yield. Let's do it. 50, which is what we're getting, divided by 900. That gives me 5.5%. So this is my current yield I'm earning. Even though I'm getting 5%, I only paid, I put a comma there. I'm an idiot, right? Okay, I only paid $900 for it. So there you go. So I'm earning, my yield is, it's a little bit more than that, but it's my current yield is 5.55555%. I'm not writing that out. So that's the whole point here, is that a current yield is going to be what you're personally earning based on this. This is paying you $50. So whether you pay $800 or $10,000 for this bond, or say $1,200 for the bond, you're still getting $50. What you're earning, what your ratio is, what your current yield is, this divided by that. So it's annual divided by the current market price, not the original market price, the current market price. A custodial account, I can never say that. A custodial account is basically where a custodian is on behalf of someone else. Usually it's a minor, like an UTMA account or a UGMA or a UTMA account. That's a custodian account, custodial, where your job is, you have a fiduciary responsibility for someone like a minor or even somebody that's incapacitated. Usually it's a minor account. The custodian is an institution or a person that is in charge of that kind of account. That's one thing. The other type, a custodian, that's a custodian. But the other type of custodian is like a bank or a broker-dealer that's holding cash for a broker-dealer or an IA or a mutual fund or something like that. Custodian is actually holding cash and securities on behalf of someone. You can't just be Joe and do it. It has to be a real broker-dealer, bank, something like that. What's custody? Okay, so custody is having control. It's not getting the kids, right? Okay, but it's having control or of an asset. So if you have like full discretion, that's custody. Okay, if you're named the trustee in an account, that's custody. If you accept a check and don't forward or return it within 3 days, that's custody. They figure you're holding the money. If you accept prepaid fees of $500 or more for 6 months, or prepaid fees 6 months before you do the advisory service of $500 or more, that's custody. Those are all things that are custody. If you have an omnibus account where you're the advisor and you're the advisor, you have an account with a broker dealer, one account in your name as the advisor, and you have a bunch of accounts with people with money with you, you have custody because you're controlling it. If you, the advisor, send statements to the clients instead of the broker dealer, that's custody. And there's a lot of rules on that. So if you have custody, you have to notify the administrator. You have to put up a surety bond unless your net cap or net worth is high enough. You have to send your financials. You have to get audited financials, a surprise audit, unannounced. You have to send you have to let everyone know, okay? And then you have to send a quarterly statement to your clients telling them where their money is. That's custody. There's a couple more things, but you have to notify everyone that you're having, okay? What's a customer? Anyone who opens an account with a broker dealer. Okay, it could be an individual or a person. It can't be. Broker dealers are not customers, which is interesting. Okay, the statement. So what do you have? The customer statement. That's what we send out quarterly. There's no monthly. A lot of firms do it, but there's no requirement to send a monthly statement. even the whole act, we have activity, it's monthly, that's not a thing. So statements are quarterly. You send a quarterly statement, it lists how much you have, what you've done in the last quarter, well, just a statement on everything you did. And it's going to tell you what you've done. And sometimes they ask questions about fraud. Like sometimes brokers, when they had a bad month or something for their clients, they would send a fake statement. Totally legal, that's fraud. They should be in jail for that. But that's a sign of fraud. If all of a sudden you get if your statement doesn't match what your com firms and what you expect, you reach out to them and you have to say, listen, what's going on? Okay, cyclical industry. A cyclical industry is basically, it's an industry that moves with the cycles, like retail stuff. I think fashion, like automotive, things like that. When the economy is going well, they do well. And when the economy is doing bad, they don't do so well. That's the opposite of defensive. Okay. So like defensive is like, that's like cigarettes, alcohol, food, shit like that. Those are all like, they're pretty steady. Utilities, they're steady. They're not going to do great in a good economy or bad in a bad economy. They're just like staples. People always need to take drugs, pharmaceutical. They always need to eat. They like to drink alcohol. They like to smoke. And they need to see, which is utility. Okay. Those are all defensive securities that never really go. Okay. So that's A through C. I'll try to do the rest of the alphabet over the next couple of days. I'd like to get one big fucking video, put it up there, and have one massive video that you can just tap into what you're not. I'm going to put like timestamps for the letters, not for each one, because I'll have too many. I'm going to put timestamps for all the letters. Thank you very much. And hopefully right now it'll go right into D without having a break, but who knows? I'm fucking lazy and I'm tired and it's 2 o'clock in the morning. So this is going to be one really long fucking video. Seriously, this could be 5-6 hours long. Who the hell knows? And I'm not breaking it up. I'm going to do a massive one. Put it out there. Watch what you want. I'll put timestamps for the letters. So now it's what letter? It's time for a little D in your life. Everyone needs a little D in their life. Well, I don't, but everyone needs a little D in their life. Okay, so what's a dark pool? A dark pool is basically, so think about this, it's an alternative trading system. So I want you to think about it like 2 ships passing in the night. So you put in, okay, so I want you to think of a dark pool or a dark liquidity or whatever you want to call it as a way of doing orders without anyone knowing who you are. It's like an ECN or an alternative trading system, which ECNs are, where you don't know who puts the order in. So you may put an order in and get executed and go, wait, there was no offer there, but it could happen because there's dark liquidity. But a dark pool is where you put your money in and you put your order in, and then somebody else puts an order in, and if they kind of match up, they get executed. Other than that, nobody knows what happens. Okay, so let's think of like ECNs, dark pools, fourth market, stuff like that. Dark pools are like, it's like you put a range. I'm stuttering because it's a hard thing to explain, right? I mean, I see it in my head, but it's hard to get it out there. So a dark pool is like you put an order in and another institution puts an order in. And if they happen to match up where they can execute, they will, but nobody knows who the other side of the trade is. So let's say Jeffries in the 90s, Jeffries ran one, and they would do, it's more sophisticated now, but this explains it. So like 11, 12, 1, 2, and 3, they would say, okay, everyone who wants to put their order in, put them in the box, in this black box, okay? And then if you put them in there at the exact, and it would print anything that would crisscross. So like say there was 50,000 to buy at 40, and there was 50,000 to sell at 40, then that would mean a buyer and seller would match up, and all of a sudden you'd see a print for 50,000 shares because it would match up, but they would not know it was there. So here's the problem. You put into, 10,000 shares to buy at 40, somebody comes in at 41.01 to sell. Well, you're not going to execute because there's a difference here, but you'll never know it was there. So that's the whole point of a dark pool, is that you're staying anonymous. You don't know who the orders are. And it's a good way, like if you're in a stock a lot, like say you're Goldman and you're buying a ton of shit. Well, people start realizing that. And when they see you walk in, trying to fix this out again, right? When they see you, maybe it's just I'm crooked. Maybe I'll just do that. If they see you in there buying, they go, whoa, you know what? Goldman's a buyer. I could probably get a couple extra pennies out of them. So they'll jack their price up a little bit and go, let's see if Goldman comes to me. But if you do it in a dark pool, nobody knows who the buyer is or the seller is. Again, I've gone way too deep, more than you'll ever need to know, but it's a way for institutions to stay anonymous while doing orders. Okay, let's talk about orders since we're here. So day orders is day orders. There's GTC orders. Those are the two we're going to talk about. So a day order is an order for the day. 99% of orders are day orders. You place an order to buy 1,000 shares at 50, I automatically assume it's a day order, which means it expires at 4 p.m. 3 p.m. if you live in the Midwest, right? Okay, or I guess 1 p.m. if you live on the Pacific Coast. Okay, so now The order ends at 4 o'clock. Okay, that's a day order. Boom. If you have discretion, you can extend them and change them. But if you don't have discretion, like you don't have full power of attorney, and I give you a not held order, it only lasts until 4. You can't carry it to the next day. So day orders mean you place an order. I automatically assume it gets canceled at 4 p.m. automatically. Whatever you did, and you have to accept it. A GTC order is good till cancel. Now they have days that are not testable, where they actually have to renew them. But a GTC order is good till cancel. That means I'm giving you the order. I put GTC on it very rarely, and it stays. It goes day by day by day, and it stays there. And the reason you do that is because I want you to think when you have an order book, it's always first come, first serve. So if you go in to buy a share at 40, and I do, and you're a half a second ahead of me, a millisecond, if you want to say, ahead of me, you will get completely done before I buy anything. It's kind of like when you go to buy concert tickets from Taylor Swift, right? The people ahead of you get to buy all they want before you get even in. Okay, so there's a problem there, but every day it resets. So you put an order in, 99% are day orders. So if you put an order in at 10 a.m. and I put in at 10:01, I'm behind you. But if I set it as GTC and we don't execute, yours cancels it for my stays, and the next morning I'm already probably in the front of the book. I'm in the front of the line. So that's what a GTC order does. It stays there over time. You would not do a market order, because market order is like any price, there's no price limit. So a market order, you would not do GTC because you're pretty much going to be executed the same day. Okay, we talked about principal versus dealer. Remember, so ABC, agent broker commission, and then dealer, principal dealer markup. Like it. Debenture. What is a debenture? It's an unsecured corporate bond. Unsecured corporate bond. And a lot of it, yeah, that works. So it's an unsecured corporate bond. Okay, what's a debit spread? A debit spread is a call or put spread where the amount of money you pay for is more than what you receive. So I'll show both. So let's say we have a spread is going to be buy a 50 call. I hate when this happens. Buy a 50 call at 7 and sell a 60 call at 4. Okay, so in this case, I've spent 7 and brought in 4. So I have a debit of 3. And here's a little trick here. If you want to know bullish or bearish, find the dominant option. So since this is the dominant option with the bigger premium, that defines the spread. If whatever this is, so this is bullish, so is the spread. And buy means debit, sell means credit. So if the dominant is a buy, that's a debit spread. So this is a debit, it's a bullish spread because this is bullish. Now, let's change this up and make this it has to go this way. You can't just willy-nilly it, okay? I'm going to change that we'll change that to 14, okay? So now this would be a credit spread because the sell has a bigger premium. So this, since selling a call would be bearish, this can work on puts and calls too, both put spreads and call spreads. So if you sell this, if this is the bigger premium, that's a sell. So then that's a credit. And in this case, since selling a call is bearish, the spread is bearish. So this is a bear spread also. Okay, a debt security is any kind of time as opposed, really, what do we have? We have equity of debt. That's kind of it, right? So equity is when you have ownership. It's common and preferred. And debt is when you borrow money. So debt is when the company borrows money from the investors. So debt is when the company borrows money from the investors. So it's like, even if it's a government, so the entity does. So commercial papers, short-term debt, bonds, debentures, munis are debt, T-bills, T-notes, T-bonds, tips, and strips. Those are all forms of debt. Those are all types of debt, and it just means you owe the money to someone. You borrowed the money versus giving that ownership. Like if you ever watch Shark Tank, like they want, I want $20,000 for 10% of my company or something like that. And then maybe Kevin O'Leary, Mr. Wonderful, comes in and says, well, how about this? How about instead of you giving up equity, I give you a loan and I get a royalty, blah, blah, blah. But I give you a loan and you pay me back and I get my money back and they make interest on it. That's debt. Sometimes you'll hear him pitch and go, look, you don't want to give up equity. So let me lend you the money. I'll help you out. And then I'll take a much smaller piece of the equity. Because remember, equity is ownership. That's why if you watch on Shark Tank, they're always fighting over like the littlest bit. Because the more equity you have, the more control you have. Debt to equity will absolutely freaking show up in these exams. Debt to equity is how much debt we have versus how much equity we have. That's literally it. How much equity, okay? Basically, we'll call it stockholders' equity, but it's really total assets minus total liabilities. That's the shareholders' equity. And then you do the debt by that, not the market value, just the amount of debt. Because if I borrow $1 million at like 4% and rates go down, that debt's going to go up in value, market value, but it doesn't matter to me. I only owe the million. So remember, debt to equity is how much debt we have versus how much equity we have, or shareholders' equity, stockholders, whatever you want to call it. And that is, and anything, a 1-to-1 means same debt, same equity. More than 1-to-1, you're more leveraged. Leverage means borrow, right? So the more you borrow, the more leverage you are, the higher the debt to equity goes. And in some industries, it's fine. In some industries, that's not good to be that high. Default. What is default? It just don't fucking pay you, right? Like if you lent me money, your biggest risk could be that I would freaking default. Hey, so that's the risk. Okay, so the risk is that default risk, credit risk, same thing, and that we know how we measure it. So default risk is that I just won't freaking pay you, the interest or the principal. Okay, what are defensive industries? Okay, defensive industries are like the staples. I think we talked about them in the business cycles. They do fine all the time. They're always steady. So even in a bad economy, they're good to buy. Okay. In a good economy, they're probably not the thing to do because you'll underperform, but they'll probably overperform. Not doing, they're steady on, but the market's shitting or the economy's shitting. They're going to march on. And what's that? That's like pharmaceuticals, utilities, alcohol, food. I always forget the fifth one. It's just really, it's tobacco. So everyone needs to drink. Everyone needs to smoke. Everyone takes drugs. Everyone needs to see, and everyone needs to eat. Okay, good. Those are staples. Defensive securities. Do not confuse that with defense industry, which is like weapons of war. Boeing, Lockheed, Pratt and Whitney, the ones who make bombs and fighter jets and ships. Okay. Okay, what's defensive? So if you're a defensive investment strategy, that means you're being very conservative and you're trying to minimize your risk, okay? Basically, you're putting a lot of this stuff in bonds and cash. Like if you think you're worried, the older you get, the more defensive you get. You know, I always say the best defense is a good offense, right? Or the best offense is a good defense. But I don't like doing defensive. I mean, I'm a moron. I probably should be more conservative, but everything is in equity. Despite me being 50-something years old, I should be in 50-50, but fuck it. I'm all equity all the time. So defensive is going to be you're very conservative. You're trying to minimize your risk. Remember, whenever you minimize risk, we've talked about Cap and stuff. If you minimize risk, you're giving up return. That's just a pair off. That absolutely has to be the way it is. Okay, a deficiency notice. Okay, this is a deficiency notice. A deficiency notice is when the SEC says, hey, there's something wrong. Okay, you have a registration statement, you file it, you have the 20-day review, and they come back and say, hey, something's wrong. Or if you register with the SEC as an investment advisor, anytime you do something and they go, wait, something's missing, there's a deficiency notice. Okay, they're just saying, hey, fix it. It's not a crime. You're not getting in trouble. Just fix the damn thing. That's all. Something's wrong. You missed a signature. The numbers don't work out. You're missing something. You did it wrong. Like when I first registered, when I first tried to create a Form ADV Part 2 for investment advisors, federal covered, they had just changed the rules. It used to be bullet point. Then it became narrative. They wanted to do it as a narrative. And every time I sent it in, I mean, I'd never done it before. I sent it in. Then they came back with a deficiency notice saying, no, it has to be this. I did that. And they go, no, another deficiency notice has to be that. I became really good friends with this person. So, because we kept talking every other day until he goes, you need a table of contents and you need a glossary, all that crap. So there was a lot of rules on it, which are not testable. I'm just explaining that a deficiency notice isn't a big thing. It's just, they're saying, hey, you got to fix something. Okay, so let's talk about this. Defined benefit versus defined contribution, okay? Defined benefit plan means that you know it's a retirement plan, qualified. You know what you're going to get. Defined benefit, you know what you're going to get, like a pension. Like they go, look, if you work here for 20 years, you're going to get this at the end, okay? That's what you're going to get. We're going to pay you 20% of your salary, this much money a month. Like my buddy who's an iron worker, he worked with me on the stock exchange. And then when we all left, he went to do this. He's probably making more money now than all of us. But they told him for every year you work, when you retire, we'll pay you $200 a month. So if he does 20 years, he'll get $4,000 a month for the rest of his life. Okay. And that's great. That's a nice, you can move anywhere other in the world and never have to worry about money ever because they will pay him for life. They're defining his benefit. Does he care what they're putting in now for him? Does not give a shit. Doesn't care, and it goes in pre-tax. Defined contribution, that's like what we're doing, right? 401k, stuff like that. where you know what's going in. Technically, a KEO is, an HR10 is one, but we're going to go with the whole theory here. Defined contribution, you know what's going in. We know what we're putting in. We know what they're putting in. Maybe it doesn't matter if you know, like what they're going to do over the next 3 years. You just know right now how much they put in. The question is, if you have a 401k, you put money in, do you know what it's going to be? Look, if you're like 22 years old and you drop 18 grand or 10 grand into a 401k, do you know how much it's going to be when you're 70? You have no idea. So you're defining the contribution, but the benefit, the ending result, you don't know. But again, defined contribution is better for younger people because they have the time to have that shit grow. Defined benefit is for older people like me. I'm an old fuck. I think I want to go to a job at my town. They pay they don't pay great. Maybe they pay 70, 80 grand. I mean, some people are getting well over 100. They pay that, but if you work there for at least 5 years, they pay you 30% of your salary for the rest of your life. So it's like, wow, I could put in 5 years, make no money, and then have a nice little nut that this way I can never have to worry about that. So as an older person, that would work for me. But as a younger person, you'd miss out. Okay. So younger you are, defined contribution is better. Older you are, defined benefit is better. What's deflation? So let's see. So inflation is a rising of prices. Price, consumer goods, CPI, we know how to measure that. That's going up. We're dealing with it now in 22, 23. Now, moving on. If it goes up, if it's going up 9%, 9%, 9%, and then it starts going up 7 or 6%, still going up, that's called disinflation, not deflation. Don't let the news trick you into this. If the inflation's still going up but slower, it's called disinflation, not deflation. Deflation doesn't actually happen. Maybe it happened in 2009 for like a day, but deflation, when prices drop, actually get lower. Like you buy eggs, the big one, gold, right? You buy eggs today at $2 a dozen, and then tomorrow it's $1.90. It's actually cheaper. That doesn't really happen, okay? So these prices are not dropping. They're just, so even if we get inflation back under control, these prices are here, okay? So it's just going to happen. It's just, they're not going to rise as fast anymore. So don't expect prices to drop because that's deflation and the shit does not happen. Why would you give that up? Like, I'm not going to lower my rates, okay? Okay, delta, it's a Greek, okay? The Greeks, okay, so the delta is a measure of how much an option will move compared to the underlying asset. So if you have a delta of 40, okay, delta of 40, for every dollar the stock moves up or down, the option will move 40 cents, 40%. Delta is a percentage. So if you have a delta of 80, for every dollar the stock moves or the underlying moves, you'll move 80 cents, 80%. So think of delta as a percentage. If it's a 30%, a 30 delta, it means it's going to move 30% of the underlying asset in the same direction. And what I mean by moving, in case I didn't say it, the premium will move because the strike price doesn't change. So if you have a 40 call at 3, if I can do the math here, and it says a delta of 40 and the stock goes up $1, then you will now have a 40 call at 340 because it'll move 40 cents compared to the dollar. That's delta. Again, theory. Okay, supply and demand, right? So there's supply is what the actual stuff we have, and then we have demand. Demand, this is how we determine. So if you see a lot of demand, prices go up. That causes inflation, although we really know the government causes inflation. That's been known. I'm not just shitting on the current administration. It always happens. So demand is how much people want. Supply is how much people have. If there's more demand than supply, prices go up. If there's more supply than demand, prices may go down. Even though I just said a second ago that it doesn't happen. But on an interim basis, commodities, it's supply and demand. The more demand, the prices go up. The more supply, prices go down. Okay, so if you ever see the thing about M1 and all that shit, so a demand deposit account is something where you can just walk in and take your money out at any time, like a checking account, okay? So a demand deposit is like a checking account, savings account, okay? Because you can take your money out anytime you want and convert it into cash. Okay, so depreciation and depletion. So depreciation is when you have a man-made thing, okay? Man-made thing, and over time it gets worth less and less and less. So you get to depreciate it. One of the greatest write-offs in the world. I have 2 cars that were used for business. I have to travel and all that stuff, and carry stuff around. So I write them. The fact that my car every year is worth less and less, I get to write that off and lower my taxes. Write-off means it's a loss, a tax loss. I get to lower my income, okay? That's depreciation. Depletion is when you use something. Not crops. Definitely not crops because they grow back. Lumber, gold, oil, coal, gas. Once you use something, you can't use it again. So it's being depleted. So they actually let you write off the fact that you can't use it again. So if you have 100 barrels of oil and you sell one, you get to write off on your taxes the value of 1 barrel of oil. That's depletion. So remember, depreciation is for man-made shit. Depletion is for God-made shit, okay? So natural resources, God-made stuff is depletion. Actual things is depreciation. Buildings, cars, tangible shit, okay? What's a depression? I think we did this, so I don't have to go into it. Depression is what I feel at night. No, I know I'm totally fine. I'm actually surprisingly happy. As much as angry I seem all the time, I'm actually pretty happy. So depression is a long recession, right? So when you have 18 straight months of negative GDP or 6 straight quarters of GDP, negative GDP, that's a depression. We haven't had one since the 30s. Okay. So what's a derivative? Derivatives, right? It's an asset. It's a thing that is based on something else. So it's a product. It's a security. Hopefully, sometimes not always. That is based on another underlying asset. So like an option, a put or a call. That's values based on the stock. Okay, futures and forwards are not securities, but their value is based on the commodity that it's tracking, or the index, or the stock, or whatever it is. So like warrants, rights, options, futures, forwards are all considered derivatives. I still think a CMO is a derivative, but who the hell knows? Okay, dilution. What the hell is dilution? Dilution is when you dilute something, right? So like say you have a glass, say I have this and I pour a bunch of ice in it. It's fine at first, but eventually gets diluted. Okay, I have a drinking problem. Now, too bad it's not alcohol. I don't drink alcohol. That's the thing. Okay. Used to think I would. So dilution, back on my tangent. Dilution is when you lower the potency, right? So let's say you're a 10% owner of stock, okay? And then the company issues another 100,000 shares. If they didn't give you the right to buy more shares to keep your ownership, called a preemptive right, you would be diluted because let's say 1 million shares outstanding, you own 100,000 shares. You're a 10% owner. If we issue another not a stock split, a stock dividend, that doesn't do shit. But if we issue another 1 million shares and we didn't give you the right to buy another 100,000, you'd now be a 5% owner because you own 100,000 shares out of 2 million. So dilution is where your ownership is diluted down to less. Okay, I think if you watch the Facebook movie, whatever social, whatever that was called, Zuckerberg did it to the CFO. They didn't like him, so they just diluted him. They said, "Oh, you're a 5% owner. Now you're a 0.00001% owner," because of the way they did it. Okay, so directed brokerage is where you decide as the customer where to send what brokerage account you want you to send your order to go to. So if you're an IA and I'm an experienced customer and I say, listen, I want you to send the order through TD, I'm directing it where to go. That's all. Okay, what's a discount bond? A discount bond is a bond. So we have bonds issued at par 1,000. If rates go up after it's issued, the price will go down because it's less attractive. So that's a discount bond. If you issue a bond at 5% and rates go to 7%, your shit doesn't look as attractive, so the price will drop. So we have a discount. And then the other side is if you issue a 5% bond and rates drop, then your bond looks better, so it becomes a premium. So remember, a discount bond is when the price is below par, and a premium bond is when it's above par. I mean, it's straight up forward. That's straightforward. Okay, what's the discount rate? The discount rate, I think we talked about these. We have 4 rates: prime rate, broker loan rate, discount, Fed funds. Prime rate is the rate that the banks lend to their best customers. It's the highest rate. Then the broker loan rate is what banks lend to broker dealers for margin. That's a broker loan, that's lower. Then we have the discount rate. That's lower even still. And that's what you see in the news with the Federal Reserve is raising or dropping. That's what the Federal Reserve, that's the rate that Federal Reserve charges banks and some broker dealers for overnight lending. Then the Fed funds rate is the lowest. It's the most volatile. It moves every day. It's an average of all the rates that all of the, if you watch my Pomodoro method video, I should have this in another room, but it's the rates where banks and broker dealers lend to each other overnight lending. That's the lowest rate. It is very volatile. Power of attorney and discretion, pretty much they are the same thing. There's 2 limits. There's limited and full, and there's variations in between. But basically, discretion is saying, hey, I'm going to let you, the advisor or investment advisor rep or the agent, make decisions on what I buy, how much, and buy or sell on my behalf. You don't have to ask me every time. Regular accounts, you, the advisor, can do trades, but you have to ask me first and say, I want to do this. That's solicited. You can do that. But if it's a discretion or power of attorney, you can actually make decisions. So in power of attorney, you can choose everything. If you don't have power of attorney, the only thing you can choose is the time and the price. That means I have to choose buy, sell, the amount, and the asset. Okay. So that's the 3 A's: the amount, the asset, and the action. Okay. If you only choose time and price, you don't need discretion or power of attorney. If you choose anything more than time and price, like if you choose buy or sell or the amount or even the security, no matter what, even if I call you up and say, hey, buy a bunch of bank stocks, you're choosing the bank, so you would need power of attorney. Now, let's go on that. So if it's an agent on the broker-dealer side, you have to have it in writing, in hand, before you do anything. You can't say, oh, it's in the mail. As on the IA side, you're allowed to actually have verbal discretion for 10 days, and then it must be followed in writing. Let's say the question comes, they give you verbal power of attorney, and on the 10th or 11th day, you get nothing, okay? You don't get the paperwork. Your discretion ends that day. On the 10th day, it's done. You can't do any more discretion. You don't go back and bust the old trades, but you are going to do, that is where you're going to draw the line. Now, let's talk about this a little bit. There's full and limited, right? Limited means you can do any suitable trade, but you can't really pay bills and stuff like that. And that's not custody. You may have to put a surety bond, but you don't have, it's not custody. The next step up is full power of attorney, and there's gradations of that. But let's start at the top. So full power of attorney means you can do any suitable trade, plus write checks, withdraw money, pay bills for the benefit of the client. You can't pay for your trip to Rio, but it is what it is. So that's full power of attorney. You can pay bills and do the money. So if you can touch the cash or withdraw your own fees without checking with the client first, that's full power of attorney. That's custody. And we know the rules on custody because I did them in about maybe half an hour. Okay, so if you do something wrong, you may have to disgorge your commissions, which just means give them up. Just give them back. Disgorge means give back. We love the big words. Okay, disposable income, that's basically what you can spend on. You can just spend, like you have savings, you have your bills, whatever left over is disposable income, which means you can spend it on crap. Okay, so now distributable net income, that's basically what the beneficiaries receive from a trust that would be taxable to the beneficiaries. So you pay them, they get the money, they have to pay taxes on. Diversification is modern portfolio theory anyway. So diversification is instead of buying one security, you buy a bunch of securities and spread it out to reduce your non-systematic risk. You can almost get rid of it by having that. You can lower your system. Now, you can't really lower your systematic. Books try to say you can, but it doesn't matter. It doesn't matter if you're across the board owning everything. The market drops, the market fucking drops. Okay. We'll be back. Take a break. I have a student. So what's a diversified fund? You might see over the course of this, my beard may grow. I may get fatter. Who knows? Who knows how long this is going to take? So a diversified fund is a mutual fund. Usually it's in common stock and stuff. Here's it. Remember 75, 5, 10. 75, 5, 10. 75, 5, 10. 75% of the assets have to be invested somewhere of the fund, have to be invested somehow. No more than 5% of the fund's assets can be in any one security. So if you have a $100 million fund, 75 million at least has to be invested. No more than 5 million can have any one asset. And you can't own more than 10% of the voting stock. Because if you own more than 10%, you become control, and then you can't really sell this shit. So if you want to be called a diversified fund, I'm going to be fixing this damn hat. If you want to call it a diversified fund, 75, 5, 10. 75% invested, no more than 5% of the fund's assets in any one security, and you can't own more than 10% of the voting stock of any company. What's a dividend? A dividend is when the corporation, we have all videos on this, you should know this, but dividends are when you own common stock or preferred, you're going to get paid a part of the profits. Remember, dividends are up to the board of directors. They're not guaranteed in any way, shape, or form. Even on preferreds, they're not guaranteed. The board of directors has to approve it every single time. One day I'll fix out why I'm itching. And remember, the order is declaration X record payable. So it's declaration date, then you got the X date, which is the day before the record date. Then you have payable. Remember, DERP, DERP. And remember, on the X day, the actual price of the stock will drop by the amount of the dividend to offset the fact that you're not getting it. Because remember, X means without, ex-boyfriend, ex-girlfriend, ex-dividend, all without. Okay. Dividend discount model. Okay, so we know what DCF is, right? Discounted cash flow is taking all the future cash flows, discounting them back based on a discount rate, and coming up with present value. That's for bonds and projects. For common stock, it's dividend discount model. There's dividend discount model, which is taking all the future dividends and bringing them back to find the present value. But that one isn't the best one because it assumes that the dividend's not changing. That's a dividend discount model. Then we have the dividend growth model, which is saying, oh yeah, we're going to do the same thing, take all the future dividends, discount them back to today's dollars, but we're going to assume that the dividend's growing over time. Only for stocks that actually pay a consistent dividend. So like a Tesla, a Google, it wouldn't work for. But a company that actually pays a dividend consistently, that would be valuable for. If you are the dividend exclusion rule, right? So the exclusion, whatever it is, if you are how it's taxable, right? So if you have a dividend, it's taxable at ordinary income, unless it's qualified, and then you get taxed at the lower tax bracket, which means you've held it for 60 days before and after the X day. Then they drop your rate down to 15 to 20%. But here's the kicker. And here we go, the rest of the D's. I hope it works. If you like what I'm doing, shoot me a like, shoot me a share, let other people know about it. Don't forget to subscribe, and don't forget my membership videos. They will help you. Sunday nights are all about learning. If you're a corporation and you own common stock of a company or preferred and you're getting dividends, you will only pay tax on 50% of it. Okay. So that's a dividend exclusion rule. If you are a corporation and you own 20% or less of, I guess under 20, I don't know the number, you can look it up. Under 20%, you only pay tax on 50% of the dividend, which is great. So you get $100,000 dividend, 50 of it comes off the table. You only pay tax on the 50. Great reason for cross ownership. If you own more than 20%, 25%, 20% of the company, then you only pay tax on 35%, even more. And I think if you're over 90%, I think there's another number where it even goes even higher, but not testable. They're not going to do the numbers. Just know that corporations benefit greatly from buying stocks that pay dividends. Dividends per share is really just how much dividends we get per share. If you look on a stock, you're going to look, if you ever look on TD or Schwab, wherever you have an account, and you look, it says dividends per share. That's how much you're getting paid per share. So let's say we have $1 million, we're paying out $1 million. We have 500,000 shares. We're paying out $1 million in dividends. It's $2 a share. So easy, not a big deal. Now, the dividend payout ratio. The dividend payout ratio is basically measuring how much we're paying in dividends divided by what we make. Okay, so basically, you're going to do the dividends divided by earnings per share. So it's the annual per share dividend divided by the earnings per share. Or you could take the entire dividends, what they pay, and divide it by the value of the company. Okay, the equity. You can do that. The one you're going to get is the dividend payout ratio is the per share dividend divided by the earnings per share. Now, what's a DRIP? I'm a DRIP. People are DRIPs. Okay. A DRIP is a dividend reinvestment program. So what happens is you can go, well, they have it now. Most of the broker dealers let it happen, but you used to be the way you would buy shares with the company directly, and they would set up a DRIP, a DRP, but it's a dividend reinvestment program. What happens is, as they pay dividends, they automatically reinvest the dividends for you. And you're like, well, why do I care? One, no commissions, which a lot of places don't do anyway. But two, you get partial shares. So if you want to, I don't even know, if you get a $5 dividend and it's $100 stock, you'll get 5% of the shares. You can't do that on your own. The broker dealers do it now. A lot of them do. Schwab does, and I think TD does now. A couple of them do. Well, a lot. But the companies used to let you reinvest. So the thing is, if you get that money, so you're getting the cash and then it's being reinvested automatically, it's considered you got the money. So you're going to get the share, get the money. You're not going to see it. It's going to get the cash, and it's going to automatically buy a percentage or a portion of the new shares, fractional. And that is taxable to you, even though it's reinvested. But where it isn't, see, that's the one way where they get the cash. The other one is where they just distribute the actual fractional shares to you. So the DRIP can go one of two ways. Either you get the cash, well, they're paying you cash and you buy dividends. You don't get to keep the money, but you are taxed on it. The other way is they just give you the stock, the extra stock that your dividend would have gotten. Then that one isn't taxable up until you sell it, because you're just getting more shares yet, and it's not a taxable event. Kind of like how a stock dividend is not taxable in the moment, but a cash dividend is. Now, dividend yield is basically the same as current yield. Okay, dividend yield and current yield are the same thing. You take the annual AMP, right? AMP. Annual over market price. So you're going to take the annual dividend and divide it by the market price. Again, the annual dividend and divide it by the market price. Current yield. What's dollar cost averaging? Okay. So dollar cost averaging is when you invest the same amount of money every time period. So what happens is you get a lower cost per share. It's the only way to kind of like beat market timing. So because if I buy stocks, I'll buy Tesla at the high and sell it at its low. It's literally my life. Okay. So that's timing risk. Dollar cost averaging takes away timing risk. Let's see if we can do it. Okay, so let's say you're going to invest $1,000 every month, and this is a really volatile stock, but it is what it is. You can invest $1,000 a month each month. So this is dollar cost averaging, same amount every time. Okay. So if you buy put $1,000 at $50 a share, you're going to buy 20 shares. $1,000 at $20 a share, 50, on and on and on. So this is how many shares you're going to buy, and let's do the average. So we're going to add them up. So we spent $4,000. We know that. Okay. So $4,000. That's what we spent. We know that because it's 4 years, 4 months, or whatever it is, at 1,000 each. So we add this for 70, 80, 180 shares. So that's 180 shares you bought. So we do the little calculation, come up with our average price. 1,000 divided by 180 equals, that's going to be, so that works out to be 4,000 divided by 180, works out to be $22.22 a share. So that's our average, 22.22. Okay. Because you bought a lot of shares down here and all that. Okay. So now that's our average cost. But if we did this the other way, where we said, okay, what's the average price of the stock? Okay. So if you just set the average price of the stock over that same time, is going to be 50 plus 20 plus 100 plus 10, $10. That's going to give us 180 divided by 4 weeks. That's going to give us $45. Okay. So the average price of the stock is 45, but because we did dollar cost averaging, we came in a lot lower, less than half. Because what happens is when it's lower, you're loading up, and when it's higher, you're buying less. Okay. Not on purpose. It's just you're putting in 1,000 each time. And by doing that, you have better timing. You should have a lower price. Your cost should be lower than the average price. And in this case, it's a lot. Well, it's also a very volatile stock. I mean, this is kind of crazy that we can go this back, but I wanted to be extreme. Okay, so let's talk about the donor versus the giftee, right? So you're allowed to give up to $16,000, whatever the number is. I think it's 16. It keeps changing every year, right? You can give $16,000 a year to as many people as you want, and that's gift tax exclusion. As long as you give that or less, you can give it to 30 people or 100 people, but you can't give it to the same person more than once until the next year. If you do that, it's not taxable to the recipient. If you give more than that, say you give 20 grand and you don't use the lifetime gift exclusion, which allows you to give a shitload of money, the donor will have to pay taxes on the increased amount, on the amount above 16 grand. So if I give you 17,000, I the donor have to pay taxes on $1,000. Okay. Duration. Duration is basically bond sensitivity, right? So it's just think it's interest rate risk or volatility. And just remember, the long-term bonds have long duration, which kind of works, but that's not what it means really, right? So long-term bonds have more bond volatility, so they have more duration. Longer duration means more volatile. So long and low, baby, long and low. Long-term bonds and low coupon bonds have the most volatility, the most duration. It's kind of like when you're going to get your money back, okay? They express it in years, but I wouldn't worry about it. I just know that long duration, they're not going to make you do the math on it. Just know that long duration means it is very volatile. On to the E's. E. Okay, we got E. So first of all, earned income. What the hell is earned income? Earned income is what you actually earn. Yeah, of course, Ken. Don't be an idiot. Earned income is like salaries, commissions, wages, bonuses, royalties. You need earned income to put it in an IRA. So if you have passive income, like from a limited partnership, or investment income from dividends and trust fund baby shit, you can't open it up. You can open an IRA, but you can't put anything in it. You have to have earned income. My example is I have a friend who's a CEO of a broker dealer, and what happens is he it's an LLC. Now he changed it. He's CEO, and he gave himself a paycheck. But he goes, I can't put anything in my IRA. He said, because I have no earned income, everything's passive LLC income. So he changed it. He pays himself like 10 grand a year and just in salary on top of his partnership. So he can put money in an IRA. He has other options, but he really wanted an IRA personal that was outside of his business. So that's earned income. Earned income is what you earn from doing work. Salaries, commissions, wages, royalties, bonuses. Earnings momentum. That's like your earnings per share are rising. Like it goes to like 1 year it's 10%, then 12, then 15, then 17. It's increasing. So if your earnings per share is growing by 10% 1 year, and then 13% the next year, and then 15%, and then 18%, that's earnings momentum, and that's a good thing. So if it stays flat, it says flat. What's earnings per share? So this is easy, right? Okay, earnings per share. Look, think about this. We're kind of idiots, right? So we are idiots. So all these formulas, a lot of the formulas actually have the name of what it is in there, earnings per share. It's earnings divided by shares. Now it's going to be your net earnings. So it's earnings God forbid they do it. Earnings, you minus anything you pay to the dividends. Because if you want to think about it, it's earnings available to common per share. Earnings available to common per share. So it's earnings minus the preferred dividend divided by the number of outstanding shares. Outstanding, not authorized, not issued, outstanding shares, which is issued minus the treasury. Lots of math, but they're going to give you a lot of this stuff. They're not going to make you do 8 steps. So again, earnings per share. It's the amount of earnings divided by the outstanding shares. If they throw in the preferred dividend, just subtract it out and then do it. What's effective date? Effective date is the day that your registration becomes effective. So if you register a security, usually around the 20th day, the SEC or the administrator, that's not 20 days, but the SEC gives you the effective date. The administrator says, oh, you're effective. Remember, they're not approving it. They're not endorsing it. They're not saying, hey, you're good. They're not ascertaining the merits of the security or the person selling it. They're basically saying, hey, you filled out the paperwork, you're not a felon, and you paid the fee. You're good to go. You didn't lie on the application, or we don't see any lies. They're not endorsing you or passing on it, anything. Well, they are passing on it. They're just saying, hey, you filled out the paperwork, we couldn't see anything bad. You can sell your shit. We'll come after you later if we find out you lied. Okay, so we have marginal tax rate and effective tax rate. So marginal is your top tax bracket, right? So marginal is like if we do brackets here in this country. So if you're making like 50 grand a year, okay, you're actually paying like two or three different brackets. So I'm just show you. Okay, so let's say you make 50 grand. Your marginal tax bracket, let's see. So your marginal tax bracket is your top tax bracket. I know we're in the E's, but it kind of works with effective. So you're in the, right now, anything up to 11 grand is 10, anything up to 4. So let's walk it this way. The first 11 grand you make is taxed at 10%. The next, whatever that 33,000 you make is taxed at 12%. And anything above 44 grand up to 95,000 is taxed at 22%. Where you fall in your top tax bracket, that's your marginal, okay? That's the one you use to calculate what your tax after tax yield is and all that, because any money you make is on top of the 50. So if you make 50 grand, you're going to pay 10% on the first 11, 12% up to 44, and then you're going to pay 22% on 6K. So let's figure this out. So it's 6K, right? And remember, I rounded the 95 and the 40. There's like dollar amounts in between them, but it's about right. So let's say, so you're going to be 6K is going to be at 22%. 33%, 33K is going to be at 12%. And 11K is going to be at 10%. So I'm going to pause so we can do it, so we don't waste too much of your time, because I'm already nailing you for hours on this one. Okay, so we already know that your marginal tax bracket is your top tax bracket of 22. You're not paying 22 in the whole 50 or anything, even though you're in that bracket. So the first 11 grand you make is 10%. That's going to be $1,100. The next 33,000 you make, I hope I did the math right, is going to be 3960, 12% of that. And then the amount above 44 is 6 grand. You're going to pay 22% of that. So you're going to pay 1,300, 3960, and 1,100. That's 6,380 in total taxes. If you make 50 grand, you're going to pay 6,380 in total taxes, which is your effective tax rate of 12.7%. That's this. That's the blend of all this. This is when you do calculation for after tax yield. You're going to use the marginal, not the effective, because it doesn't work. Because remember, anything over 50, anything you make over 50 will be taxed at this higher rate. So it'll go up quicker. Okay. So that's marginal versus effective tax bracket. Efficient market theory. So let's talk about that. So efficient market theory, efficient market hypothesis theory is the belief that the market is efficient. What does that mean? The efficient market theory believes that the market is efficient and there are no inefficiencies, because traders try to find inefficiencies. Active traders try to find inefficiencies, like a stock is undervalued or something like that. Efficient market theory does not believe in it. So there are 3 types of efficient market theory, 3 theories. One is weak, semi-strong, and strong. The way I try to remember it is that weak is like, yeah, we sort of believe in it, but there are exceptions. Semi-strong is we mostly believe in it, but there is one way. And then strong believes it is absolutely efficient. You can't beat the market. I think they're wrong, but let's start. Weak believes that all historical prices are built in, and the only way to really beat the market is to do fundamental analysis. All of them believe technical doesn't work, okay? All of them believe technical does not work, okay? They believe, so only weak believes that you can gain an advantage, maybe by doing fundamental and finding like a diamond in the rough, looking at the balance sheets and finding an undervalued stock and buying it. Hopefully it'll catch up. That's weak. Semi-strong, they're pretty good believers. They believe all news is built into the price. So efficient market theory, semi-strong believes that all news is built into the price. Public news. So any kind of private information that's unknown or whatever, once it's published, the stock will quickly go to the price that reflects that new news. So there's two ways. One, if you are in possession of inside information or private info, maybe not even like, so yeah, let's say inside information, private, and you have that, you can actually beat the market. Or if you have a system that can actually read the market as it comes out faster than everyone else, bigger, faster, stronger, right? Then you might be able to capture it before it moves. Like, oh, when you saw like, oh, the Google was, if you, as soon as you saw Google had an antitrust thing against them, maybe you go, okay, let it drop and then we buy it. Or you go, sell short my stock now because it's going to drop. If you can make reactions better than everyone else or faster, then you can do it. That's semi-strong. Strong believes that, don't even try. Strong believes that people trade on insider private information. It's built into the price and the market is efficient. That the actual market reflects all public and private information. So again, weak is just all the prices, all historical prices are built in already, and you can only maybe beat the market with fundamental. Semi-strong believes that all public knowledge is built into the price, but any private information that comes out will move the price. And then strong believes that all public and private information is built in. So even when new news comes out, it shouldn't really affect it that much because it's already built into the price. That's efficient market theory. Okay, being enjoined or injunction. So let's say I'm an administrator and I think you're fucking up. You're doing some bad shit. So I'm going to issue a cease and desist. And you go, Ken, you're an idiot. I'm not going to listen to me. I really don't have a bite other than to maybe revoke your license and, suspend you. But I can't really do anything if you keep doing it. So I'm going to go, oh my God, I can't do this. So I will say, this jerk is not listening to me. I'll go, as the administrator, I'll go running to the court and go, please, can you help me? And they will issue an injunction. An injunction is being enjoined. Only a court can do an injunction. We can ask the court to do it, but the court has to do it. Just like arresting and putting for criminal, it only is the court. An injunction has legal bite behind it. If you ignore it, you have legal consequences. Okay, a couple of things. I think we talked about adoption, but and I think I mentioned entangled. So if you see a testimony or something or some sort of like, I love Ken Finnan post somewhere on a third party website, and I go, hey, look at that thing, they love me. Or if every time somebody talks about my name, I point to that and I repost it or something like that because I'm a narcissistic bastard, right? So if I do that, okay, that is called adopting. I am adopting their thing. I'm saying, hey, and that means I have to follow the rules. But if I'm behind the scenes helping them write it, that's entanglement, okay? And that's a little gray area, okay? That's basically, I have participated in the development of content on a third-party site, in which basically that's what I'm doing. So adoption is, hey, somebody liked me, I'm going to repost to it, relink it, whatever it is. If it's entanglement, that means I was involved in writing it, maybe behind the scenes, which would not be good. ESG, environmental, social, government, is basically looking at standards of how they handle the environment, social, and all governance. It's like kind of like, it's fine. It's like woke investing. Okay. Think of it that way. I'm not saying good or bad. I'm just saying that's the easy way to remember it. Equity, ownership in a company. That's how much you own. Like even on a margin account, it's what it's worth minus what you owe, right? If you have market value of 50 grand and you have a debit balance of 20, you have 30 grand in equity. Okay. Equity is considered ownership. The only way you have equity is if you buy common stock or preferreds in a company. Equity in a company. Equity financing is basically issuing common or preferred stocks to get money to pay for shit, as opposed to debt financing, which is issuing bonds. So there's equity financing, issuing common and preferred, giving up ownership, versus debt financing, Kevin O'Leary, and issuing debt to finance your shit. So a euro dollar is U.S. currency in a foreign bank. That sounds so stupid, right? But what it is like, say you're going to do a deal in, let's say Europe, it's not a country, in England, okay? You're going to do a deal in England and they want to be paid in dollars because why wouldn't you? Where the reserve currency, where the shit, all that crap. So if you want to do a deal in a foreign currency, in a foreign country, you're going to take your dollars and deposit them in the bank of Gringotts. See if you get that reference. And then you say, I don't change it into your stupid pound, keep it in dollars. That's a euro dollar, okay? Euro dollar is U.S. currency deposited in a foreign bank and left as U.S. currency. Then we have Eurodollar bonds. Eurodollar bonds are bonds issued by U.S. companies or so, and they're issued in another country, but they pay in U.S. currency. So it's like Apple issuing a bond in London, but it pays in dollars. We can't buy on it. It has to be foreigners, foreign residents. There's loopholes to that, but we'll leave it at that. So if so many people in London can buy an Apple bond, but it pays in dollars, they have currency risk. Listed securities exchange listed, they just trade on the exchange. They're the big boys. They're the biggest of the companies. They're not supposed to be say you're safer, but they're much more liquid. They have a lot more people ripping them apart and looking at them. They are, in a sense, safer. I mean, as far as disclosures go, because everyone's looking at them and trying to find any little mistake, as opposed to unlisted securities over the counter, which are a little riskier. What's an exchange privilege? That allows you to move, like say Fidelity, you have account, say you have a large cap at Fidelity, and you know what, I want to get into the mid cap. The exchange privilege is allowing you, the investor, to move some of your shares or all of them from the large cap to the mid cap without charging a sales charge. But if you do that and you sell it and you sold a large cap for more than you bought it at, you're going to pay taxes on that. Capital gains, whether it's long-term or short-term. So remember something, everything about a mutual fund is taxable. Everything about a mutual fund is taxable. Even if you get a dividend and you reinvest it, you're paying taxes on that shit. An ETF. An ETF is a packaged product like this, okay? Okay, they put a bunch of securities in it and it trades on the exchange. This trades on the exchange. It's an ETF, okay? We should know what this is. So an ETF is a packaged product. It's an investment company. It's under the Investment Company Act of 40. But here's the differences, okay? So like a mutual fund is actively traded. You can only see the top 5 holdings, and maybe at the end of the quarter you can see. The ETF is not actively managed. They kind of rebalance it. So they set a certain percentages of what they have in the fund, and you know what they are pretty much down to the percentage point. Now, it may change over time because stocks move, right? But at the end of every quarter, they rebalance it. So they're not actively managing it. They're not trying to beat the market. They're just indexing. So what it is you don't have an active manager. So the fees are lower, okay? So the fees are a lot lower because there's less stuff going on, less trading. You don't have to pay some arrogant manager where he or she lives in Connecticut or Hamptons and charges a lot of money. You just have a passive manager just every quarter rebalancing it to bring everything back. So let's say Apple goes crazy one quarter and it goes up faster than everyone else. Its percentage of the fund might be bigger than it should be. So they'll sell some of the Apple and buy the other securities to bring it back into not parity, but into the original percentage. Okay. What's an executor? An executor of an estate is basically the person who's controlling, their job is to handle an estate. What is estate? That means somebody died. Okay. Somebody died and you have somebody watching over the will and distributing the money and making sure they have a fiduciary responsibility to do what's right for everyone. Okay. They can't just be willy-nilly do what they want. They have rules that they have to follow in the will. They have to follow them in detail. What's an exempt reporting advisor? An exempt reporting advisor is an advisor that, depending on who their customers are, I guess, who they're advising, they may not have to register with the SEC, but they will have to report their financials. So if you're a private fund advisor, which is basically a hedge fund advisor, you don't have to register with the SEC until you get over 150 million. Then you do, okay? Or if you're a venture capitalist advisor, then it doesn't matter how much you have. You'll never have to register, but both do have to report their financials. Now, that means you're exempt on the state level and all that. But here's the thing. If you want an exemption, you have to be eligible to register. What I mean by that is that if this private fund advisor has its statutory disqualifications, something like that, that would bar it from registering, it can't be exempt. So if you want to be exempt from registering in a state, you had better be clean, because if you are, you have to be eligible to register. Because I've had people come to me, hey, I want to do business in a state and I don't want to have an office or anything. So I don't want to register. So I don't have to get my licenses. No, you like to be an exempt advisor or a rep, you got to register somewhere. The only one these two don't because of a special exemption, but again, if they go over 150 million, the private fund advisor does have to register with the SEC. Their idea is that, look, if you're advising a venture capitalist fund or a hedge fund or a private fund, you're not really dealing with retail. You're dealing with experts, and hopefully experts that know what they're doing and they can defend themselves. Okay, exempt security versus an exempt transaction. This is big. Exempt security is a security that will be exempt. Any federal government, U.S. or foreign, any muni, U.S. or Canada, the rest of them don't. Anything on an exchange, banks, utilities, insurance companies, commercial paper, mutual funds, investment companies, all these things are exempt. Reg D 506C. These are all exempt. The actual security is exempt. This, I'm talking state level, okay? On the federal level, it's a different list. But again, an exempt security means it never has to register at the state level, okay? Exempt security means it does not have to register ever because the issuer is exempt or the security is or whatever it is, as opposed to an exempt transaction. An exempt transaction is a security that would normally have to register. Like if I went public, I would have to register because it's a shitty tutoring company, right? But if there are ways that people can buy my shares without me having to register. So let's say I'm in Jersey, I register in Jersey under qualification. We know that, right? One state only. If somebody in New York wants to buy shares, not from me, usually not from the issuer, but wants to buy shares from someone else, there are exemptions available for the transaction to be exempt. Unsolicited non-issuer, selling to institutions, private placements, which is not a Reg D, okay? It's up to 10 retail and as many institutions as you want. Selling to my employees, selling to an underwriter, all pre-organization certificate. If someone dies and has my shares and the executor, we just went over that, has to sell the shares to make everyone happy. Or if there's bankruptcy, the sheriff or the trustee has to sell the shares to pay off the creditors. Those are, or if a pledgee, like say somebody borrows money and uses my shares as collateral, really fucking stupid, but say they do, then if they default and they sell the shares, then that's going to be an exempt transaction too. Basically, it's saying exempt security never has to register. An exempt transaction is for a security that would normally have to register, but because of the way we're doing it, we don't have to. Okay, exercise price and strike price mean the same thing. They will use both strike price and exercise price. So we have the strike price is like if it's a call, where they have the right to buy. And if it's a put, it's where they have the right to sell. That's all it is. Strike price and exercise price are the same damn thing. They may use either word. Okay, expense ratio is how much it costs. You won't have to do the math. You might have to do NAV math, but you don't have to do expense ratio. Expense ratio is how much it costs to run the fund as a percentage of what you have, okay? Basically, it's taking all the net out, it's taking all the expenses, dividing it by the funds, and that's the expense ratio. And we want it as low as possible, obviously. So like ETFs or index funds, UITs even have very low expense ratios, where mutual funds and closed-end funds that are actively managed have higher ones because they're trading and they're doing stuff. Okay, so that's the ease. Okay, new shirt. You can see it's grown in a little bit. It's been a few days. There's a long project for me. So now we're starting with the F word, not my F word, the letter F. I feel like I'm Sesame Street. This video is sponsored by the letter F. Okay. So again, what I'm going to do is I'm going to put the timestamp for the letter it starts, and then you guys can figure it out. I'll probably have someone make a list of what the order is. You can watch it, but you got to put maybe 40 minutes into find a letter. Okay. So face value. Face value is like of a bond, right? Par value of a bond. It could be 1,000, 5,000, 10,000, 100,000, whatever the face value is. That's like par value. Okay. We know on the bonds for calculations, we're going to use 1,000, but there are bonds that are 5,000, 10,000, 50,000, 100,000 par. So it's whatever they tell you. Just trust that they tell you. Also, remember, if you see 100 M, that's not 100 million, it's 100,000. Use Latin here. M, X, cum, all that stuff. Okay. Federal covered advisor. Now, a federal covered advisor is basically an advisor absolutely set up by NISMIA that is registered with the SEC. Okay. So a federal covered advisor, there's more to it. I have videos on that. But a federal covered advisor is an advisor that's registered with the SEC. One of them is going to be like that gives advice only on governments, on treasuries. Okay. Another one is if they give advice to mutual funds, boom, or investment companies, they're federal covered. Or if they have more than 100 million, they can register with the SEC under management. And if they have over 110 million, they have to register with the SEC. Those are all federal covered. I'm sure I missed a one or two, but that's what in general, a federal covered advisor is registered with the SEC under the Investment Advisors Act of 1940. Okay, federal covered securities. These are securities that are registered with the SEC. There's only a few of them. Well, there's not a few of them, but they start with, like, if you buy a muni in your own state, right? Well, that's not federally covered. It's exempt, but it's not federally covered. Okay, so federal covered securities are those going to be registered with the SEC under certain exemptions where they might have to notice file in the state. So we have anything on an exchange, national exchange, mutual funds, Reg D 506C, and anything sold to qualified purchasers, which is purchasers with more than 5 million. Those are all federal covered, and they pretty much have to notice file if they're selling shares in the state. Doesn't mean they have to register, they just have to notice file. Okay, so the insurances, right? So this FDIC and SIPC. So F and S we're putting together. If you have like my grandson can't say F yet, so he'd say SDIC and say SIPC. FDIC is a Federal Deposit Insurance Corporation. They are protecting if banks, you're protecting your deposits. If banks, not broker dealers, if a bank fails, goes out of business, they'll give you back your money. SIPC, I think it's 250. SIPC is for your broker dealers, Securities and Investor Protection Corporation, and they kind of regulate the broker dealers. So the broker dealers, because you have to file with them and shit like that. If a broker dealer fails, your accounts are covered up to 500 grand, of which, not in addition to, of which 250 can be cashed. So if you have 500,000 in your account and 300 is cash, they're going to only cover 250 in the cash and then whatever the rest, the 200 in securities. And securities, not futures, not forwards, not commodities, securities. So SIPC covers securities, and it's for accounts that are not street name. Oh yeah, street name. Sorry about that. That are in street name, which means you don't actually, you own them, but the broker dealer kind of owns them. But if you're in direct name or like UPMA or UGMA accounts, they're not covered. Now that sounds cruel, but the point is, if you own shares of IBM in street name, that means actually your broker dealer, say Schwab, owns them and you're the beneficial owner. So if Schwab goes out of business, then IBM will go, I don't know who you are. We see Schwab owns it, not you. So SIPC will pay you back. But if you have the shares in your own name under that system, DRS, direct registration system, where they're in your name and the broker dealer goes bankrupt, you don't care. You just call up IBM and go, look, my shares are held at Schwab. They're out of business. Can you just send me new certificates? And the transfer agent will do that because they know you, they recognize you. And that's why UPMA, UGMA, and direct registration system accounts, like in your own name, will not be covered because they don't need to. Fed funds is the amount that banks and lending institutions have greater than what they need. So if they need 10% of their net deposits in cash, anything they have over that is federal funds, and it can be withdrawn immediately. Fed funds rate is the rate that banks lend to each other. Again, Fed funds rate is the rate that the banks lend to each other. Federal Home Loan Bank is a government lending institution for savings and loan institutions. Freddie Mac, Federal Home Loan Mortgage Corporation, they're the ones who basically promotes. They handle so they have Federal Home Loan Mortgage Corporation, which is known as Freddie Mac. Freddie Mac is a corporation, government-sponsored entity. It's kind of government-y, right? And they handle the home mortgage-backed securities and the secondary market of it. Federal Intermediate Credit Bank is basically banks that provide short-term financing to farmers. Here's my thing. These ones, the Federal Intermediate Credit Bank, it's just a fucking mental block. I don't remember them at all. I seriously, I'll read this and then I'll move on and then I'll never remember it again. It's crazy. Fannie Mae does the same thing as Ginnie Mae, just a couple different things. Federal Open Market Committee, that's where that's the committee that decides, we're going to buy treasuries, we're going to sell treasuries. It's basically the Federal Reserve. So remember, FOMC is the open market ops. That's going to be, FOMC is a department of the Federal Reserve Board. They decide whether they're going to buy or sell treasuries. And then the Federal Reserve Board, it's a corrupt, bank. It's like our central bank. And they're the ones who handle the monetary policy. They have 4 tools, DORM, discount rate, open market ops, reserve, and margin. So they set Reg T. That's the money between broker dealers and customers. They do the reserve requirement, which is what banks have to have. They never touch those two. They do the open market ops, buying and selling treasuries to either tighten or loosen. And then they do the discount rate, which is the rate that they lend to banks. Remember, Fed funds rate is bank-to-bank overnight lending. Discount rate is the rate that the Federal Reserve lends to banks for overnight lending or up to 30 days. We know that because I've already talked about that. Okay, what's a fiduciary? A fiduciary is basically your job is to manage assets for another person, and you have to do them for the person's benefit. So IAs, trustees, IARs, trustees, IAs have guardians, custodians have a fiduciary obligation to do what's best for the client or the beneficiary. And if you're an executor of a will, you have to do what's best for the beneficiaries or the people being really sad someone died. We talked about orders. Okay, then there's prospectuses, right? There's final or statutory prospectus. That's the one that gets issued when you buy it, right? Before the effective day, I think we talked about this. You have the preliminary prospectus, as known as the red herring. Once it's effective, once you're effective, we're going to start sending out the final or statutory prospectus. What's the difference between the two? Well, the preliminary doesn't have a date or a final price. The statutory one does. So an order, okay. So an order is basically saying, a final order is just saying, hey, this is our decision. It's appealable, but it's our decision. FINRA or the SEC can do that. Okay, what's FINRA? FINRA is not a government. Remember that. FINRA is not the government. It's an SRO or a DEA, not that DEA. It's a designated examining authority or a self-regulatory organization. It's a member and it regulates broker-dealers, agents, and exchanges. That's it. It doesn't do IAs. It doesn't do IARs. And surprisingly, it doesn't do securities. So what's a firm quote? A firm quote is when you make an offer. You go, I'll buy your shares at 40 or I'll sell the shares at 40. It's a firm quote and you have to honor it. And the person on the other side can take that to the bank. I mean, you can't sit on it for 2 hours. But if I say, listen, I'll buy your shares at 40, I have to honor it. Or if I say I'll sell shares to at 38, I have to honor it. That's a firm quote. FIFO, first in, first out. That's so when you buy shares and sell them, right? So if you buy shares at different prices, like at 30, 35, and 40, and then you go to sell some of it, not all of it. If you sell all of it, it's easy. You just figure the numbers out. But if you buy 100 at 35, 100 at 40, 100 at 45, and then later you sell 100 shares, which ones do you choose? Well, you can choose, you can select which shares you want. Or if you don't mention a method, they do first in, first out, which means the first shares you bought, the ones at 35, are the ones you sold. And that's what the IRS requires. If you don't mention a method, they automatically go to FIFO, which kind of screws you over. Because remember, whatever the IRS does, it's to make money off of you, to tax you the most amount possible. So first in, first out means the first shares you bought, it'd be the first ones you sell. And again, if you do a regular account and you don't mention a method, they're going to do FIFO, which is going to give you the biggest tax rate. Since I'm here, let's talk about LIFO. LIFO is for non-qualified retirement accounts. So what happens is the last money in is the first out, which is better for you sometimes, but not in this case. If I put 20 grand into a non-qualified annuity, and it grows to 100, so I have 20 grand here, it grows to 100. If I start taking it out, they're going to start here, the last money, the growth, and it's going to work its way back. So if I put in 20 and it grows to 100, the first 80,000 comes out under LIFO would be taxable, and then the last 20 is going to be not taxable. So LIFO takes the last money and goes first and comes out first, last in, first out. Fiscal policy, that's basically the tax and spending policy set by the government. Okay, fiscal year, I said I did a video on this, popular or not. There's two types of years. Calendar year, which is January 1st to December 31st. That's our normal year. Then we have fiscal year. A fiscal year is any 12-month period. You can do October to September 30th. You can do July 1st to June 30th. You can do anything you want. A fiscal year doesn't have to be set. You set it. And the reason some companies set different ones is because they have different peak seasons or they have varying like demand levels for their stuff. So they want to take advantage of that, whatever reason. So a fiscal year can be anything other than the normal calendar year, but it is 12 months. What's a fixed annuity? A fixed annuity is not a security. Okay, we should know what an annuity is, but in a fixed annuity, you put money in, they're usually non-qualified, you put money in, it grows tax deferred at a fixed rate in the accumulation phase. And then once you get to the number that you want or the age, say you're 59 and a half, you can either withdraw it or take it out as an annuity where they pay you for life. There's different choices which you should know about or go watch on it. You pay out for life, but here's the thing with a fixed annuity. Once the payment's set, it never changes. So if you set it out and you're going to get $500 a month, that's what you're getting forever. And where's the problem with that? You have inflation risk. Okay. So if you get the same amount of money every month for, at first it's great. Oh, I got $500. And in like 10 years, like, wow, that doesn't even get into the movies. Okay. So you have purchasing power and inflation risk with a fixed annuity. You don't have that with a variable. A variable is very similar to a fixed, except for when a fix is invested in a general account, so you know what you're getting every month and it's not changing. The variable annuity is invested in a separate account or a sub account, and it's invested in the market. So when you put money in, it grows at a variable rate during the accumulation phase based on the return of your portfolio. And then when you get paid out, you can take the lump sum, all good. And remember, annuities, when you take them out, they're going to come out LIFO because they're non-qualified, and they don't step up cost basis, which I've talked about before. Now, on the annuity side, when you annuitize and get paid for life, again, different choices, your payout will change every month depending on how well your portfolio in the sub account does versus AIR. Okay, AIR is like an assumed interest rate that is just a benchmark. Okay, so that benchmark is here. Say it's 5%. If you do better than that, your payment goes up. If you do worse than that, your payment goes down. So your payments will go up and down along with the market. So while you don't have inflation risk, you do have market risk with a variable annuity. And that's, of course, it's in the V's, but kind of go them together. FV, whatever. Okay, so what's a fixed asset? That's like a physical property. That's like equipment, buildings, land. Those are long-term assets. They're not in the current assets. Fixed assets, boom, covered. Okay, so you know what a yield curve is, right? So we got the yield curve. Do it real quick and dirty, right? That's my favorite term. Boom. So we have different types of this is a positive yield curve, right? Okay. That means the shorter terms have lower yields, longer terms have higher. And then what happens is when the Federal Reserve starts raising rates, the short-term rates go up, and now we have a flat yield curve. That's flat, which means short and long are the same. And then what we have now is an inverted, okay? This is inverted. I covered all three. That means the Fed's raising rates, and then the short-term rates are higher than the long-term rates, which is not normal. That's an inverted curve. And then when the Fed starts lowering, we go back to flat, where they're the same. Then we go to positive again, and then we're back to normal. There we go. That's a yield curve in 30 seconds. What's a flow-through? Okay, so flow-through is like, well, there's two ways to do it. One, on mutual funds, it's called the conduit theory, where 90% of the money they make gets passed through to the investors, 90%. It's not truly a flow-through, but it's a conduit. But a flow-through is like a limited partnership, an LLC, a DPP, S-Corp. Every dime they make, other than expenses, gets passed through to the investors, okay? So instead of the corporation, almost like, see if I can make a stupid crude drawing of this. Let's see. There we go. There's the corporation. It's an evil-looking, mean investor, okay? So any money that comes in, okay, so let's do this. So any money that comes in, what's going to happen is they earn money into the corporation, it flows right through to the investor. Now what happens is when he gets in here, they take out the expenses, right? Boom. And then all of it flows right through the investor. So in reality, the pass-through the LLC, the limited partnership, the S Corp, actually at the end of the year has no money, okay? At the end of the year, they have a big old Zippo. That should help a little bit. That's a little idea of how it works, okay? Good. I like my little mean guy, okay. Okay, Fannie Mae, Freddie Mac, those are all government-sponsored entities. Are not backed by the government, supposedly, okay. Foreign currency, that's just what money from another country. We know that, okay? And so anytime you invest outside the country, you have currency or exchange risk, right? So if you buy something from Switzerland or that pays in krona, I guess what they use or whatever it is, and or London, then they pay pounds, and Germany they pay euros. Anytime you invest in there and you're getting paid that, you're worried that the valuations of the currencies will go up or down, and you'll lose money depending on what you're doing. Like you don't kind of like you're investing over there. You don't want their currency to drop because then it doesn't go back as much. Okay. Form D is for Reg D. Just remember that. So if you see the word Form D, it's about a Regulation D private placement on the federal level. What's a future and a forward? Okay, so futures and forwards. Okay, so futures and forwards they're not options, but they're like contracts. So let's say I'm a farmer. I look like a farmer, right? I can't do the work. My hands are too fucking soft. Say I'm a farmer and I have all this wheat I want to sell, but it's January and it's not pulled yet. I'm not pulling it out till May. Well, I'm worried that in May, the prices will drop. And I go, look, I can sell this at 50 cents right now, 50 cents a bushel, but I'm worried in May, everyone else will be selling their wheat too, and it's only going to be 30 cents. So what I'll do is I'll actually sell the wheat now. I'll say, I'm going to sell the wheat to you now, and I'm going to deliver in May. That's a future or a forward, okay? So if a farmer sells a future, they're locking in a sales price now, and they'll deliver in the future. They don't normally deliver, but they usually just offset it and buy it back. But so let's do it, baby. So let's say over here I have wheat. And right now in because it is January still. I mean, I post this on fucking March because it's going to take forever. Say in January, I can sell the wheat for 50 cents right now. Okay. I can sell it for 50 cents, but I know I'm not harvesting it till May. And I'm worried that it'll be lower. So I'm going to sell however, now remember, I'm going to sell however many I want. Okay. So if I have, say I have 20,000 bushels of wheat, and let's say each contract is worth 5,000, which is I think what they are. Each contract of future is worth 5,000 bushels of wheat. So I'm going to sell 4 bushels, 4 contracts, 4 May 50 futures. Okay. May 50 cents. Okay. Now that's covering my 20,000. So I'm hedged. So what happens is if come May, the wheat is at like 25 cents, what's going to happen is I go, oh, where I still get to sell it at 50 cents. So I'm happy. I normally won't do that. I could just deliver the wheat. But remember, if you do it through future, you might have to deliver it to a warehouse that's like 500 miles away or more because you have to send it to a warehouse to deliver. So instead, what you'll do is you'll just buy the future back for 25 cents. Okay. So you'll make 25 cents times 5,000, right? Because that's how many in the contract, and then times 4 contracts. Okay. Whatever that is. So what that's 1250 times 4. You're going to do 25 cents. This is how much you'll make. You're going to do 25 cents times 5,000 times 4. That's going to give you $5,000. So that means, how stupid am I? That's $5,000. Okay. You'll make profit of $5,000 by offsetting or buying back the future. And then you'll sell the wheat. Instead of selling it at 50 cents, you'll sell it at 25. So you make 5,000 less. Right? 5,000 less than you would have, but it's offset because look, so you sell the wheat, you could have sold the wheat 20,000 bushels at 50 cents, you made $10,000, but here you're only going to make $5,000, but you made $5,000. So you sell it for $5,000, you make $5,000 less, but you made $5,000 on the future, and then you're good. So that's what a future is. So a future is that on an exchange. It's very liquid. You can buy it back. That's awesome. A forward is different. It's the same idea, okay? But what happens is that it's a contract between 2 people. So you really can't get out of it. So if I sell you the wheat through a forward, I have to deliver the wheat to you or whatever it is. It's usually a one-on-one thing. And if I want out of it, I have to get permission from the other side because there's a contract between me and you. That's what forwards are. Now, let's say I think wheat's going up. I'll buy futures. So if I'm a user and I go, ooh, wheat's 50 cents, but I'm afraid when I need it in May, it's going to be 75 cents. I'll buy a 50-cent future. So if it goes up, I can make that money to offset what extra I spend. So remember, producers like farmers, drillers, tree cutters, lumberjacks, I guess it would be. Okay. People who sell commodities are worried it's going to drop. They're producers, so they will sell futures. Now, if I'm a user like Sbarro's and I got to buy a fucking shitload of wheat to build, I don't know if they use wheat in their pizza. Who the hell knows? It's probably plastic. They're worried the price will go up, so they're going to buy their Sbarro's. I love you, pizza. I'm not saying you have plastic in them. Just throwing it out there. Don't sue me. That's right. Nobody's going to watch this, so we're good. Then so what happens is Sbarro's would buy the 50-cent futures. So this way, if the wheat goes up to 75, they can just make the money. So users buy futures to hedge. Producers sell futures to hedge. And now you could also be a speculator. You just go, oh, I think wheat's going up. I'm going to buy futures. Or you think, I think wheat's going down. I'm going to sell futures. So remember that they're contracts, okay? Futures are very liquid. They trade on an exchange. They're very standardized, and they're a derivative. Forwards are none of that. They are a derivative. They're not on an exchange. They're not standardized. You can have a 2,200 bushel contract, whatever you want. And you can make it for as long as you want. You don't have to be 3 months. You can say, I want it for 2 weeks or a week or 3 days, whatever it is. That's the difference between futures and forwards. Okay. Forward pricing. So when you buy a mutual fund at 10 in the morning, you don't know what the price is. You find out at 4 p.m. or really you find out the next morning, but it's priced at the end of the day. So that's what forward pricing is. So you can buy it, but you have no idea what you're getting until the market closes and they price it, which is usually you'll find out in the morning. So mutual funds trade on forward pricing. ETFs, closed-end funds, and ETNs trade in the market. So you know right away what your price is going to be. Okay. Fraud and unethical. So fraud is like criminal, like lying. Okay. Basically, you're misrepresenting, omitting material facts, lying, deceiving, manipulating, all that shit. And they're unlawful. That's criminal. Unethical is like, oh, I made a mistake. Maybe I churned. Maybe I made an unsuitable recommendation, but I didn't know. Or something like that. Like maybe you did something that's maybe not so good. Like not illegal per se, but kind of just like not good. Okay. You can't go to jail if you see the word unintentional or unethical. There's another word, I can't think of it. That means not criminal, it's unethical, okay? If you see intentional, willful, misrepresentation, fraud, it's always can be criminal, and jail time is on the table for that. Okay, I think we talked about this. Front end load is for an A shares, you pay when you go in. Back end load is CDSC, you pay when you leave, and it goes down every year. And Class C is not a no sales search, not a no load, and their expense ratio is very high because you're paying a high 12B1 fee. Full power of attorney versus limited power of attorney. Full power of attorney, full trading authorization, pretty much the same thing, okay? So full power of attorney means, let's start with the whole power of attorney. You have power of attorney, you have the right to, you have the ability to make decisions, you have discretion to make decisions to buy and sell securities on behalf of your client without getting permission first, okay? If it's limited, that's all you can do. If it's full, okay, if it's full, then we have, if it's full, then you have the right to make this, you can make decisions on securities, plus you can pay bills, you can withdraw money, pay your fee, all that stuff. You can actually withdraw the money for the benefit of the client. That's full power of attorney. And full power of attorney actually is considered custody. Okay, fundamental analysis. What's fundamental analysis? Oh my God, I can't say it. Fundamental analysis is actually looking at the, I almost said it, at the balance sheet, income statements, earnings per share, PE ratio, okay? Though you're looking at the debt to equity ratio, you're looking at all that stuff. You're looking at the financial condition of the company, okay? You're looking at an actual company. As opposed to technical, you don't give a shit about the name. All you care about is the trends. You see support, resistance, you see daily moving averages, you see momentum on trading momentum, you see like head and shoulders or saucers or patterns. That's what you're looking for, trends, patterns, stuff like that. Overbought, oversold. Because it's about the trading and the price movements. So let's think about it this way. Fundamental is about the company, and the technical is about the price movements of the stock and looking for patterns. And we're on to the G's, baby, the G's. Okay, so what's a general obligation bond? Well, if I'm going to talk about that, I probably have to talk about a revenue bond also, right? So a GO bond is a general obligation. It's issued by a city, a state, a town, whatever it is. And it's to pay for shit that's free to use. So like, not a hospital, a high school, a library, a community center, city hall, shit like that. It's for projects, a field maybe. It's a project for that's free to use, which means it's not generating revenue, which means they have to use taxes to pay for it, okay? So that means they're going to use what they call ad valorem taxes. So a general obligation bond is a bond that is non-self-supporting, issued for stuff that is free to use, and it uses ad valorem or property taxes. Since it uses taxes, it probably needs a voter approval. Since I'm here, I might as well talk about revenue bonds. Revenue bonds are literally the same thing, but they're for stuff that costs money to use, like subways, buses, bridges, tunnels, hospitals, airports, all toll roads, highways that have tolls. All of them cost money. So what they do is they issue the bond, and then they build the project, and the revenues from the project pay the interest. What both of these bonds have in common is that most of the time the interest, not the capital gains, the interest is tax-free from federal taxes. You might have to pay state taxes if you buy it from a state you're not in, because why would you help out another state? But if you buy a bond, a muni bond, whether it's a GO or a revenue in your own state, you probably don't have to pay any federal taxes. There are instances where they are, but let's not talk about it yet. But the capital gains will always be, the capital gains is always taxable. Okay, GDP, baby, GDP. So maybe out of order, but gross domestic product and then GNP. We'll talk about both. Gross domestic product is how we measure the economy. Is it getting better? So if the GDP is going up, that's we're in an expanding cycle. If it's going down, we're in a contracting cycle. So GDP is basically the market value of all the goods and services produced by U.S. companies. So GDP puts you also factor into it, filter, factor, whatever it is, that it also has to be produced in the U.S. So if you have a U.S. company that produces a lot of stuff in the U.S., the GDP counts all of their services. But like an Apple or maybe a Microsoft or something like that, maybe even Tesla, anything they make outside the country, like Apple uses a lot of China, Hong Kong stuff, that stuff wouldn't count toward the GDP, but it would count toward GNP. So GDP is what the market value of goods and services that the U.S. companies produce, and it's made in the U.S. GNP, gross national product, is the market value of the goods and services by U.S. companies produced both here and outside the company. So if you see the word partnership, just alone the word partnership, not limited partner, just the word partnership, it means a general partnership, which means these are general partners. They all are partners. They all have liability beyond just what they put in, but they can all run the company. That's what a partnership is. So a partnership is a group. It can even be verbal, like you and me get in a partnership, but it's a partnership, and it's not a limited partnership. A limited partnership has a limited partner and a general partner. The limited can't be involved in running it and has limited liability. The general partner is actually absolutely involved in it. So if we have just a regular partnership or general partnership, that means a partnership. They're the same, one and the same, and the partners run it and they have liability beyond just what they put in. I think we talked about these good till cancel orders versus GTC orders. So a good till cancel order means what it says it is, because we're morons. We have to spell shit out. Good till cancel means you put the order in and it's good until I cancel it, which means it goes beyond today, tomorrow. It can go. They every like May and October, they just renew them to make sure they're good. But good till cancel orders, most orders are not. They go beyond today. Okay, you can place it as a good till cancel and you leave it in there for 2 months or 3 months or whatever it is. As opposed to a day order, which means you place the order and it expires at 4 p.m. You don't have to call and cancel it. A GTC, you have to cancel it unless it's unrenewed, but you have to cancel it. A day order, it ends at 4 p.m. You just put it in, and if at the end of the day you don't do anything, it expires. What's goodwill? Goodwill is the intangible part of the value of a company's business, okay? So basically, it's not part of, if you're trying to figure out book value, right? Because book value, I think we talked about, was the tangible stuff, right? As far as the value of the company, you would use intangible goodwill, which is intangible, like their reputation, the what do they call it? The syrup for Coke, your name value, like Nike's name, or the value of the name or your reputation is part of your shit, as part of your worth, but it's not part of book value, because book value is basically if we sell the company for the trucks, the buildings, the desks, everything they have, that's book value. Tangible, touchable stuff. Intangible means it's kind of reputation. It's not a hard thing. Okay. What's a grantor? So a grantor is, or a settler, a settler is a person who sets up a trust. Now they set it up, they put the money in, they get the trustee, they pick the beneficiaries, and then they're out of it. Okay. They're not, I mean, you can be the grantor, the trustee, and the beneficiary. You can do that. But if you're just a grantor, you drop the money in, and then if you make it irrevocable, you're done. You have nothing to do with that anymore other than the trustee, right? The trustee, unless you're the trustee. So the grantor puts it in. Once it's in there, the trust, if it's irrevocable, we don't care about the trust, about the grantor at all anymore. Then we say, thank you, move on. If it's irrevocable, then the grantor is involved, because at any point they can bring it back, and it does counter their estate. So an irrevocable trust, the grantor has nothing to do with it once it's in. An irrevocable trust, well, then it's still part of their estate if they die and stuff like that. Gross income is basically all the money we get, okay? Basically, if you're in a company or a person, gross income is all the money you get from all sources. Before taxes, that's the top line thing. Gross margin is like your profits, okay? Gross margin is basically like your operating profit, right? So basically saying, I haven't paid interest or taxes yet, so if I make $1 million and it costs me $200,000 to do it, I made 800 grand. That's gross margin. Again, gross revenue, very much same thing as gross income. Gross revenues, how much we earn from our business operations. A growth fund, not gross. Growth fund is a fund, it's a mutual fund that basically invests in growth stocks. So that's the question. It's going to be what are growth stocks? Growth stocks are like, they're expanding, they're tech stocks, they have high PEs, low dividends, they're more about capital appreciation than anything else. And that's what a growth stock is. Same thing with growth style investing, is you're basically investing in growth stocks. Guaranteed security. So you know that you or I as reps can't guarantee anything, but a firm can. So like basically a guarantee, so you can have like a muni bond that's guaranteed to principal, interest, and dividends, not to capital gains, but not by us. It's like a third party guaranteeing that they're going to pay interest, dividends, and the principal back. It's not like you're guaranteeing a profit. You're just guaranteeing that we're going to pay the principal, the interest, and the dividends. Now remember, it's only as good as the company is, right? If it's a shitty ass company, that guarantee doesn't mean anything. But if it's a strong company, then you back that up. Okay. What's a guardian? A guardian is someone who's appointed by the court to look over an account, whether it's a minor or mentally incapacitated or whatever. It's like, I almost think Think about the whole Britney Spears thing, that conservative shit. Her dad, for whatever reason, was the guardian, and he had a fiduciary responsibility. So if he did shit wrong, he can actually get in trouble. That's the thing. If you have a fiduciary responsibility and you do shit wrong, you can absolutely get in trouble. That's the G's, baby. Not very much. Okay, these letters are coming hard and fast. What are we up to now? H. Give me an H. Okay, H. So let's start with this one. Okay, so what's a Head and Shoulders platform? Okay, so what's a Head and Shoulders? Head and Shoulders pattern looks like this. Like we go up, we go down, we go up more, we go down, we go up again, and we go down. So the whole point of this, a Head and Shoulders, I mean, it's weak, but it looks like here's a shoulder, shoulder, head. This is the Head and Shoulders top, which means that every time I say that, I think it's something else. But Head and Shoulders top, that usually means it's bearish or it's a reversal of an uptrend. This is the uptrend. This is the reversal. This thing here is like a shakeout. What happens is all the people who shorted it up here are buying it to cover the short, but it's not real, so it's going down. We call this like a dead cat bounce. Because hell, you throw a cat out of a building, it bounces once before it does. I'll probably get demonetized for doing that joke. Okay. Now, we got that. That's Head and Shoulders. That's a Head and Shoulders top. Head and Shoulders bottom would be this. It's even worse. But it's a Head and Shoulders bottom. It's a downtrend. Here's a reverse. So we think it's going to be bullish or a reversal of a downtrend. What does hedge mean? Okay, so like hedge funds, all that stuff. Hedge means to kind of reduce your risk. Okay, that's what you're trying to do, is reduce your risk. And I'm just going to throw it in here. Hedge funds are really made that what they do is everyone goes, oh, they don't risk. They take risky shit. Yes, but they also hedge it. Like they'll buy shit and buy options, or they'll buy shit and buy some other product that is opposite, it's non-correlated, to hedge their positions. So hedge funds, so a hedge is basically an act to reduce a risk. A hedge fund is a pooled investment of money for usually high net worth or accredited people, and they're not unregistered with the SEC. I mean, at some point they have to register, but for the most part, they're unregistered. You don't have to. Yeah, they're not registered. I'm going to leave it at that. And what they do is they buy securities. They buy more risky, more alternative securities, and they will also use other things to offset that risk. They don't have to. They can go all in, balls in, and try to do something. But a lot of times they'll take off some of the risk with some sort of hedge. So a hedge is reducing your risk. Okay. A hedge clause is usually not allowed, usually meaning all the time, not allowed in a contract, because it's basically saying you can't blame me for doing something. So it's almost like a hedge clause tries to make it seem like, oh, you can't blame me if this happens. No, that's not true. Okay. As an investment advisor, if you put a hedge clause in your contract, it could be a violation. And I say could, it will be a violation, because you're saying, hey, don't blame me for shit going wrong. You can't do that. Okay, high net worth just means you're rich. I mean, some people try to say that the same as qualified, which is the million under management or 2.2 net worth, but I just say that's a qualified investor, which means that those people you can charge performance-based fees to, but that's more qualified. High yield bond. A high yield bond is a bond that has an interest rate that's higher. Obviously, it's because it's riskier. Usually it means it's below. I think we talked about it before in one of the earlier video, that if it's below triple B, right? So triple B is the lowest investment grade. Anything below triple B, BB, B, CCC, CCC, all that, those are all high yield or speculative or junk, if you want to say that. Okay, so what's a holding company? Okay, so a holding company is a company that owns like a bank holding company. Everyone goes, oh, they're exempt. No, I want you to think of this. Like a bank holding company is literally a corporation that owns a bank. There's two big ones: financial services holding company and a bank holding company. A bank holding company is literally just a corporation that owns a bank. But a financial services holding company is a corporation that owns a bank and a broker-dealer, investment advisors. They can hold other things. There's different requirements for that. But on their own, they are not exempt. Holding companies are not exempt. They're just corporations. So if I'm a bank holding company, I own a bank. The bank is exempt from registration, but I'm not. If you hold something, you're the owner. Own, long, own, hold, all mean the same thing. Short, sell, right, kind of mean the same thing. What's a holding period? Usually that's when you have restricted shares. You have to hold it for a certain amount of period. A lot of times it's 6 months. It's not every time, but holding periods are like, they make you hold it. Like if you do a Reg D, you have to hold it for 6 months fully paid. If you buy shares outside the country under a Reg S, you have to hold it for a year fully paid. There are exemptions to that, but that's pretty much what a holding period is. Another version of holding period is how long you held the stock for, right? So if you buy stock today and you hold it for a year or less, it's a short-term holding period. And if you hold it for over 12 months, and it's a long-term holding period. So so holding period is, for one thing, how long you hold it for as far as meeting restricted. But another one is if you've held it for more than a year, it's a long-term holding period, which means long-term capital gains rate. Or if it's a year or less, then it's a holding period of short-term, which means it's in a short-term capital gain, which is the same as ordinary income. Home state, that's like where your principal, I always say that home state rules, baby. So if you're an IA or a broker dealer in a state, that wherever your principal office is, wherever your principal place of business is, that's your home state. And that's whose financial stuff you have to follow. As long as they're not higher than the SEC if you're regulated by the SEC. But if you're a state advisor and you're in 5 states, you have, even if the other 5 states have higher financial requirements, you just follow your home state and they're okay with it. Home state is where your principal place of business is. What's hypothecation? Hypothecation. Okay. Hypothecation. I always think of that anticipation catch-up thing. Hypothecation is when you open a margin account, and it happens is you fill out the credit agreement you get, the margin agreement, want to call it. Then the hypothecation agreement is saying, I'm allowing you to take my shares and use them as collateral to lend me the money, right? So margin account, you're buying shares on margin. You're borrowing money to buy shares. So the broker dealer will take 140% of your debit balance, the money you're borrowing, in shares. So if you buy $10,000 worth of stock, you're going to put down $5,000, you're going to borrow $5,000. So that means you bought $10,000 in stock. The broker dealer will take $7,000, which is 140% of your debit balance, in shares and hypothecate them to the bank. And then the bank will lend them the $5,000 so they can lend you. So hypothecation is basically putting your shares up as collateral for the loan, kind of like a mortgage. Okay, so we've done A through H. Now we're on to the I's. Let's get into the I's. Okay, so what's an immediate annuity? So an immediate annuity is, instead of having a deferred one where you put money into the annuity and it grows tax deferred and then you take it out, an immediate annuity is you dump the money in and then you take it out right away. You can only do an immediate annuity if you do a lump sum contribution. You cannot do it if you do an extended one. Okay, so if you do a contract plan where you're paying in for 15 years, you can't start taking the money out until you're done putting it in. Always remember, with all these plans, other than like mutual funds, you can do it. You can put money in and take it out. With the retirement plans and stuff like this, you can't put money in and take it out at the same time. So that's an immediate annuity where you're putting a lump sum in and you're getting paid out for life. So even if you're 25 or 30 or 59 and a half or 60, you're going to start getting paid out from the day you put it in. You start getting paid out. Immediate or cancel. What's an immediate or cancel order? That's basically saying, hey, I want to buy the stock at this price and place a limit order, but I want to buy as much as I can right now and cancel it. So if I give you an order to buy 1,000 shares at 42 IOC, immediate or cancel, that means you're going to buy as much as you can. So if you buy 600 shares, you cancel the 4 and I accept it. If you can buy the whole 1,000, awesome. But I want you to buy as much as you can right now and cancel the rest. Unlike a fill or kill, which is similar, and we've already talked about it, a fill or kill order is I give you 1,000 to buy at 42, fill or kill. You either buy the entire 1,000 and then cancel it. Obviously, you're done, or you don't buy a share. You either buy the entire thing or none. That's fill it or kill it. Okay, so if you don't complete your CE, your continuing ed, you go into what they call inactive status. And that means you can't do business, you can't do anything, you can't collect commissions or anything. You can collect commissions for stuff you did before you went inactive, but now once you're inactive, you can't. And it's really hard to become inactive now because it's a yearly thing and you have a whole year to do it and you just log on and do it. You don't have to, you used to have to go all the way down to the Prometric Center, go there and make an appointment. Now you just do it from your home. As long as you don't cheat, you're good. Okay, income bonds and income funds. Okay, remember, an income bond is bad, an income fund is good. So income funds are good, income bonds are bad. I keep saying that wrong, right? So now, let's go on to this. An income bond is like an adjustment bond. A company is going bankrupt, they decide to restructure, and all the people who owned bonds before, they're told, hey, you have a choice. Either they go bankrupt or you agree to this adjustment. So the adjustment here is that they say, okay, we have a coupon, and it is what it is, but we can't afford it. So we're going to adjust it and say, we'll still pay the same coupon or higher maybe, but we're only going to pay we're only going to pay it if we hit a certain income threshold, like earnings per share, some sort of threshold that they set that we can afford it. And the reason they do that is that if you're trying to get back on your feet, sometimes having to make that monthly payment every 6 months is tough, right? So they can't do it. So listen, so every time you get, 2 steps forward, you can take a step and a half back. You're not really moving forward so much. So the whole point is an income bond is saying, hey, we want to readjust our structure so that we will only pay that income payment when we are making enough money to afford it. Now, great, that's awesome, but it also is a company that was basically bankrupt. So it's very risky. It's never really suitable for anyone. It almost has to be an unsolicited basis or a hedge fund or somebody's looking for crazy risk. Yeah, because if it works, you can make a lot of money because the bond is now trading at a deep discount. So if it starts paying, it's going to go up in price. So there's a lot of upside, but there's a hell of a lot of risk. Okay, an income bond is that. An income fund is a fund, a mutual fund that's supposed to working on creating income, generating income, whether that's interest payments or dividend payments or something like that. That's what they're looking for. It's not just bonds. It's not just preferreds. An income fund is trying to create income through dividends and interest payments. I think we talked about it before. An income statement is basically all the money that's going in and out. Okay, there's a balance sheet, which is assets and liabilities. An income statement but is more about the money going in and out, the income we're generating. An income stock is like a utility stock or like a value stock that's paying a high dividend. That's all it is, just paying income. It's a stock. There's no guarantee. Dividends are not guaranteed. But an income stock is something like maybe a defensive stock or a value stock or utility that is very well known for paying dividends. Okay, what's an indenture? Okay, the indenture is basically, you're going to be saying, basically, I apologize. I'll try to edit it out, but it's not going to work. Basically, we have to deal with this. So an indenture, try not to say it, is an agreement between the issuer and the trustee. The trustee on a corporate bond, they have to do an indenture. I guess they can do it in any bond, but they have to do it on corporate bonds, where it's an agreement between the issuer listing on what they can and can't do and the trustee, whose job it is to protect the investor. So if we violate any of that, the trustee will come at us and sue us, meaning the issuer, not the customers, because the customers are being protected. What is an index? It's a benchmark of a group of securities at the S&P 500, the Dow 30, it's all industrials, the Russell 2000, it's all this small cap stocks. You have the Wilshire 5000, which is like a shitload of stocks, it's the whole market. The whole point of an index, it represents what the stocks are doing on a given and at any given moment. An index fund is a fund that kind of replicates the performance of a specific index. So you buy an index fund, it's passively managed, it's not actively, they're not trying to beat the index, they're trying to benchmark it and match it, okay? There's a little lower fees, they have ETFs that do it, they have index funds, index mutual funds, all these things are there. But an index mutual fund might be a little more active, some fees, but a straight up index fund, okay, or an index ETF would have very low fees because you're not actively trying to beat the index, you're just trying to match it. Now, nobody ever can. So what happens is some of these index funds, not the ETFs, the index funds maybe take on a little more risk to make up for what they call tracking error. Tracking error is that if we're trying to track an index, we're not always going to nail it because the index is just a bunch of numbers. We actually have to buy the securities. We have margin costs, we have commissions, we have salaries, we have expenses. So that's going to reduce our return. So they will actually take on a little bit more risk to bump up what they make to reduce that tracking error. And indexing is when you try to match it. Okay, so basically where you're an investment approach where you're trying to match the index. You're not trying to beat it, trying to match it. Very passive, very low cost, all that stuff. They all kind of go together. What's an index option? An index option is an option like an S&P 500, the SPYs, whatever it is, where you're buying calls or puts based on the index moving. So if you buy an S&P, if you buy an S&P call, okay, you're betting the index will rise, and what you do is you'll make money, you'll get cash if you exercise it. If the index goes above your strike price and you exercise it, you'll get that money in cash. So you're actually betting on the index going up or down. So like if you have a big portfolio, you might buy S&P puts to offset that. Okay, you'll buy S&P puts to offset your risk. Okay, because you have a portfolio matches the index, so it goes up and down with the index. So you buy puts so that even if the market drops, you're going to make money on the put to offset what you lose on the mutual fund or on your portfolio that matches the index. Again, you're buying, if you're bullish, you buy index calls. If you're bearish, You buy index puts, and when you exercise, you will make the in the money amount. You don't get the stocks in the index, you get the in the money amount. The amount in the money, that's what you get paid. An indication of interest is usually during the cooling off period. So the cooling off period is when you file the S1, when you're registering your shares for the first time to be sold to the public. That 20-day cooling off period, you can't take any orders, but you can take an indication of interest. Okay, so an indication of interest is just saying, hey, I'd be willing to buy 5,000 shares or whatever it is. It's not binding on anyone, on either the broker dealer, underwriter, or the customer. If you come out and say, I want to buy a bunch of shares, and then later they go, hey, we can allocate 5,000 to you, you can say, no, I only want 100, I can't afford it. It's not binding at all. Okay, what are the indicators? So I always think of leading, lagging, and coincident. So don't worry about naming all of them, listing them all. It's more about understanding what they're about. So the leading indicator is telling us where we're going in the future. Coincident is where we are right now. And lagging, it tells us where we were. Again, I don't want to use examples, but I'm going to do anyway because I'm a flake. The S&P 500 is a leading indicator. Like, think about during the pandemic, the market was skyrocketing in the summer of 2020. The summer of 2020 sounds like a song. But in the summer of 2020, the market was skyrocketing despite fucking horrible shit going on. So it was like, why is it going up when the world is ending? Because it wasn't thinking about now. It was thinking about 6 months later or a year later. So that's a leading indicator. So it's telling us where we think we're going. Coincident is just explaining where we are now. And lagging is telling us where we were. Like, corporate profits are a great lagging indicator because you report the corporate profits at the end of the year and tells you how the year went. Okay, so individual account versus joint account, right? So an individual account is like your account, your own account, what you have. Like, mine just is being obliterated because I just can't trade for shit. But that's my account. It's my thing. Nobody else has control of it. So if I call up a broker and say, watch my account for me, and then I disappear, they can't do anything unless I gave them power of attorney. Now, a joint account is when it's more than one person. It could be more. It could be 3, 4, 5 people. Joint with rights of survivorship is multiple people, and if one person dies, the rest of the money, the shit in the account, goes to the other people. Then there's joint tenants in common, where it goes down to their family or their beneficiaries. So you and I have an account. We have joint tenants in common. I die, my money goes to my people. If you die, your money goes to your people. There you go. And that doesn't avoid probate, where the rights of survivorship does. So really, the difference between the two joints, despite this being an individual account question, but whatever, the two joint accounts, the difference between the two is where the money goes when you die. Tenants in common goes down, rights of survivorship goes across. What's an individual retirement account? That's an IRA. That is an account that you set up that is a retirement account for you. So if it's a traditional, it goes in pre-tax. If it's a Roth, it goes in after tax. There's other ways where a regular IRA would go in after tax too, but not on this video. It goes in, you set it up, you contribute yourself. The most you can put in is, depending on the year, since it's 2023, you can put in $6,500 a year of earned income. It has to be earned. You can't be a trust fund baby and do this, okay? Trustafarian. And if you're old like me, 50 or older, you can put in an extra 1,000. You can't take the shit out before you're 59 and a half. And on a regular IRA, you have to take it up by the time you're 73 now, not 72. And a Roth, there's none of that, because here's the great thing about a Roth. You put the money in after tax, which means you pay taxes on it. It grows tax deferred. If you hold it long enough, over 5 years, and you take it out in a qualified way, like for a good reason, or 59 and a half, then you don't pay taxes on any of it. And so there's no RMD either, because they don't give a shit when you take it out, because they can't tax you. Like, the reason they make you start taking the money out of an IRA is because they want to tax you finally. That money's been sitting in a tax-deferred account for 40, 50 years. They want to tax it, so they make you take it out. Industrial development bond. It's basically, see, there's that word again. It's basically when just said it twice, even though I made fun of myself. When a municipality buys property and leases it out to a corporation. They issue the bond to buy the property, then they build it up, or just lease it out to a corporation. And sometimes, through the legal opinion, they decide that the corporation, the credit rating of the corporation, is what the bond is based on, not the municipality. Inflation, purchase power risk. They kind of go to there. Inflation, we're dealing with in 22, 23. Usually it's around 2 or 3% a year. It's the rise in prices of goods, not bonds, not stocks, rise in prices of goods. So the fact that you can measure through the CPI, Consumer Price Index, you can measure inflation through the CPI, and that's saying every time all prices are going up. That's why sometimes if you have a union job or something like that, every year you get a little 2 or 3% raise, cost of living adjustment, COLA, I guess you can call it, right? Where they're adjusting you to the rising price of goods. So like if I made, 30 grand a year in 1990, that's like, 65 grand a year now or something like that. So that's it, because that's how much I would have to make to buy the same amount of stuff as I paid for it. So if I made 25 grand a year in 1990, I don't know the numbers, to buy the same amount of stuff, I'd have to make 60 or 70 grand a year now. So inflation is a rising price of goods. And the best hedge against inflation is either gold or precious metals or common stock. Yeah, and inflation risk is when you buy bonds and shit like that. And anytime you have to buy something that's fixed income, that you're getting the same amount of money every single time, you have inflation risk because you're getting the same money, but everything's costing more. Okay, what's an information barrier, also known as a Chinese wall? Maybe it should be in the sea, maybe it should be here. Okay, information barrier is like when they put up barriers, not physical, but like electronic, or they could put walls up. Like I have some buildings, when I worked at some firms that were big, you had to use a key card to get into various ones. And if you didn't have the right key card, you couldn't get in there. So that's an information barrier. It's to protect inside information flowing back and forth. And it also helps with like market makers versus retail versus institutional. They get orders from their customers, and that should not impact how others react to the orders. Like, so if I'm a retail customer and I give you an order to buy, 1,000 shares of IBM, well, technically, once you get that order, you as a customer, broker dealer, can't buy it in front of me. But in another department that has good information barriers up, they can, because they don't know about my order. That's what do you call it? Not know. You don't know about it, so you don't have to worry about it. It also protects the spread of inside information. Most of the time, it's about putting the difference between like underwriting or investment banking and research and trading, because all of them could use some of that information to trade on it, and you don't want that. Like it used to be, research used to be under the investment banking arm. And what happened was, you go to, say you're an investment banker and you go to a Coca-Cola or Home Depot and say, hey, I want to do some of your investment banking business. And they go, well, that's great, but your firm just gave me a sell rating or a neutral rating in research. So that'd be embarrassing. So the investment bankers went back and yelled at the research people and told them to give them a buy rating. And that's not good, because that's not real. So they have to be separated. So the investment banker has to go in there, and whatever the rating is, they can't control it. They actually put in rules that investment banking, unless it's a really, really small firm, investment banking cannot be in charge of research or their hiring, firing, or even compensation. That's keeping a wall between them, the Chinese wall between them, to make sure that they don't interact too much. And actually, some of the firms, I think my daughter was at a firm where she had a friend in another department, and she tried to look them up, and the email doesn't even show up. Like, you can't even email them. If you want to talk to someone over the wall, on the other side of the wall, you have to bring in like a compliance officer to sit in or to monitor the conversation. Make sure you're not trading secrets. What's an IPO? An initial public offering. Okay, so an IPO is the first time issuance of stock. First time going public, an IPO. And remember, since you're working in Wall Street, if you're watching this, you can't buy on that. You can buy in the market, you can buy an additional offering, you can buy a follow-on, but you cannot buy part of the deal of an equity IPO. Again, an IPO is the initial time. It's a primary offering. The primaries can be follow-ons, where second, third, fourth, fifth time you offer shares to add more shares. But the first time is always an IPO. Okay, the inside market. Okay, inside market is the highest bid and the lowest ask, right? So you have to determine where we are. So, okay. So this is just a quote for Cisco. It doesn't matter. Just remember, if you want to see the website, go to QuantShare, just so I don't get in trouble. So the inside market is the highest bid, okay? So level 1 shows the bid and the ask, the highest bid and the lowest ask, okay? So these are the people willing to buy. This is where people want to buy the stock. This is the highest price anyone is willing to buy. And that's the inside market. That's the buy. That's the bid, or they call it the NBBO sometimes, National Best Bid, Best Offer. And here's the offer. This is the lowest price anyone's willing to sell it at. There are people behind it, right? So look, JP Morgan, Bank of America, Lehman, how old this is. But these are all bidders below it. They're not on the inside because they're not the best bid. And here, these are all offers. They put colors in there to make it so much easier for us. So we don't even look at the colors we don't want. We can set our own colors. But now these offers are higher than what's the best. So this is the lowest price anyone's willing to sell. And this is the highest price anyone's willing to buy. So if you want to buy shares, you have to pay the ask. You have to buy where people are willing to sell. And if you want to sell shares, you have to sell it where people are willing to buy. So the bid ask is the inside market, the highest bid, the lowest ask. So this would be 2630 by 2631. That's the inside market. They would also probably put size. They would add these up and then add these up and come up with a number. But that's the inside market. So what is insider and inside information? So insider is someone basically has not 10%, more than 10%, or any partner, officer, director. So I say partner, officer, director, I call it the pods, PODs, or more than 10%, or anyone who is in possession of inside information. What the hell is inside information? Inside information is material non-public information. Basically, material information that's important that you can make a decision on that would matter, and it's non-public. That means it's not been publicized yet. You can have that information, but you can't use it. You can't trade on it because that's called insider trading. So here's the thing. So being in possession of inside information is not a crime, okay? Being in possession of inside information is not a crime, and what you should do is tell your supervisor or your principal so they can tell you how to handle it. But you can't use that to make decisions. You can't tell people if somebody wants to buy something and you know it's going to be bad. You can't wink, wink. You cannot do anything. If you're in possession of inside information that tomorrow this company is going to declare bankruptcy, and little grandma walks in and wants to buy a bunch of shares, you can't go, oh, grandma, don't do it, wink, wink. You have to let them do it. Unless there's a real reason, a real good reason to not, but you don't do it. You can't solicit orders. You can take unsolicited only. So again, inside information is possession of material non-public information. They may just say MNPI, okay? Now, as an insider, you may always have that, but you're a 10%, more than 10%, or a pod, partner, officer, director. And somebody used the acronym PODS, PODS, partners, officers, directors, and S for shareholders over 10%. Or if you are in possession, you can be a temporary insider where you're in possession of inside information. They also added the rules a little bit that it used to be just you would get in trouble, but now everyone in the chain gets in trouble. So if I'm in possession of inside information and I tell you, and then you tell your sister, and then your sister acts on it, just to act on it to be a problem, then all of us are in trouble, unless I can prove that you knew you weren't supposed to say anything. Okay. Institutional communication. Let's talk about all three. So communications, there's retail, correspondence, and institutional. Correspondence is you're sending information to 25 or less retail clients or people in a 30-day period. If you send it to, and it doesn't need to be pre-approved, it's reviewed. If you send it to more than 25 individuals in a 30-day period, it becomes retail, and it needs to be pre-approved by a principal of the firm and possibly sent to FINRA if it's a mutual fund or DPP or CMO or option. If it's institutional, you're sending it to institutions. It doesn't matter how many institutions. Like if I work for a broker-dealer and you send it to me and my capacity as a representative of the broker-dealer, that's institutional, does not need to be pre-approved. We have to review it. That's all. So the principal will review both correspondence and institutional. So if I say we send 20 with things to 20 people, and then I also send it to 20 institutions, it's considered correspondence and it just needs to be reviewed, not pre-approved. So an institutional investor, okay, an institutional investor is any person deemed by FINRA to be an institution. So understand, FINRA's job is to protect, FINRA and NASA's job is to protect retail customers, grandma and grandpa. But as you get more and more sophisticated, you need less protection, so they let you do more things. So retail can't do shit. They just buy and sell, and they stay in the little world because FINRA and NASA have to protect them. The next level up is like accredited. That's the 1, 2, 3 accredited, or the Series 7, 65, or 82. 1, 2, 3 accredited is 1 million net worth, 200 salary single, 300 miserable. Right now, they can do more things. They can buy in private placements. They can invest more in Reg A's and stuff like that. That's an accredited investor. Then we go up. The next one is qualified on the state level. That's someone you can get to 1 million net, 1 million and 1.1 million invested with the advisor, or 2.2 million net worth. They're qualified. You can do performance-based fees. A qualified purchaser is someone with 5 million or more. Again, the higher you go, the more things you can do. Institutions are just what they are. I mean, there's definitions, but it's really whatever the state says they are or FINRA says they are. Institutions are never really human beings, okay? They are firms that manage money, banks, hedge funds, broker-dealers, stuff like that, mutual funds. Since they are institutions and they can defend themselves, that's the point. FINRA believes that they can defend themselves, so they have a pretty open, wide open ability to do almost they can't lie and cheat, but they can buy almost anything they want because they've signed a form with the broker dealer or whatever saying, hey, we can make your own decisions. We don't need you to worry about our suitability. Just give us anything you think we can make money on. And then the highest level is QIBs, okay? Those are financial institutions that manage 100 million more in money. They're totally considered, they can totally defend themselves. They don't need hardly any protections from FINRA or NASA. And they're allowed to buy like on 144A things. That's pretty much what they're allowed to buy, things that no one else can because they don't need protection. So again, you start low and go up, and the higher you become, more sophisticated you become, the less protections you need. So then they let you do more things. Okay. Intangible versus tangible. So an intangible asset is something you can't touch, like formulas, copyrights, trademarks, like the formula for Coca-Cola, 7X, whatever they call it. That's an intangible asset. It's an asset, but you can't actually touch it. Tangible is like trains, buildings, desks, computers, trucks, planes, stuff like that, things you can touch. Intangible are things you can't touch. Okay. Interact. So let's talk about communication. So if you make posts like social media, so if you post something that cannot be changed, it cannot be changed by someone else, that's called static, and it needs to be pre-approved all the time. That's like a post, okay? If you have interactive can be changed by someone, like a chat room or something like that. That does not need to be pre-approved. It's like a public appearance. So static needs to be pre-approved. That's the word you need. Or it can't be changed. And interactive means it can be changed or added to or something like that. And that's like a chat room or like maybe even like the comment sections. Those do not need to be pre-approved. They have to be reviewed after the fact. What's interest? Okay. Interest. Interest is when you borrow, when you lend money, right? So, okay. What's interest? Interest is what my family doesn't have in me. No, interest is when you lend money or borrow money, right? You lend money or borrow it. The lender receives the interest payments. Okay, those are payments basically for borrowing money, and those are legally required, as opposed to dividends, which are just so if you buy a bond, you're going to get interest from the company legally. If you buy stock or preferred, you're going to get dividends, maybe, but they're not legally required. Interest is legally required. What's interest rate risk? Interest rate risk is the risk that if you buy a fixed income, like a 5% bond, you're getting $50 every year, right? And interest rates are at to 7 or 8%. Now, those new bonds being issued are paying $70 or $80 a year. You're still only getting your 50 because it doesn't change unless it's a VRDO. Coupon never changes. Remember that pretty much. So you're still getting 50. Your bond is now worth less because it's not as attractive. That's interest rate risk. And remember, long and low, baby, long and low. Long-term bonds move more than short-term bonds. Low coupon bonds move more than high coupon bonds. Remember, the lower the coupon, the deeper the discount, the more the bond will fluctuate. Good. Okay, interest rate options or yield-based options could be Y or I. Yield-based options are when you buy options on the actual interest rates. You're not buying on the bonds, you're buying on the rates. And usually it's T-bonds that they're doing it too, okay? So you're buying options on the yield. So if the yields go up, if you think the yields are going to go up, you buy a call. If you think yields are going down, you buy a put, okay? You think the yields are going up, you buy a call. You think the yields are going down, you buy a put. And you can actually, if you own a bond portfolio or preferred or any fixed income portfolio, you remember you're worried about interest rate risk, so you'd buy yield-based calls. So as the rates go up, you'll make money on the calls to offset what you lose on the bonds, if you remember from before the interest rate risk. International fund. So I think I did this already. An international fund is purely a fund of just non-U.S. securities, where a global fund is U.S. and foreign securities. Internal rate of return. Okay, that's the rate of return where future value becomes present value. It's a rate of return that it's really, think of it this way. It's the rate that we use for DCF to get to present value. I have whole videos on this shit, okay? So if we have future value, we want to discount the value of that future value to get present value. That rate of return is called the internal rate of return. That's the discount rate we do. And we'd love to earn more than that because that means we have a positive NPV. Okay, interstate offering and intra, they're separated, but I'm going to do them together. Interstate offering means more than one state. Like inter-squad scrimmage, which means different places. Intra is one state. Interstate means you're subject to SEC because you're crossing state lines. Intrastate is like qualification. It's in one state. Or on the Series 7, that would be a Rule 147. and the SEC doesn't really have jurisdiction other than fraud. Interpositioning. Interpositioning is when you get an order and you're a broker-dealer and you add another broker-dealer or party into the mix for no good freaking reason, okay? Like if I can do a trade and then I add in Joe's broker-dealer just to execute it, there's no reason for that, okay? So the only time you can do that if it's better for the customer. Like the only time I think of that is like when you trade bonds, right? So if you're a bond trader and you're a firm, you have to have relationships with the other side because there's counterparty risk. Counterparty risk is a risk that the person on the other side of the trade just fucking disappears, okay? That's the risk. So everyone, whenever you have whenever you set up a bond shop and you're going to trade with them, you actually have to have a relationship with the other person. So you almost set them up as a customer, you do due diligence and all that. So you want to do that. So maybe I get an order from a customer from a bond that's not very well known, and the only people that make a market in it is this broker-dealer that I don't have a relationship with. But I go, oh, wait, one of them that I does have a relationship. So I will send the order to my friend, and then they will do the trade and come back. That's okay because your firm can't get the bond even if they wanted to. Or if that other company could get a discount, like a cheaper rate or a cheaper price, then that works. So the only time you can add a third party in there is if it's better, not equal, better for the customer. If they don't, it's interpositioning, it's a violation. Intestate, not inter, okay, intestate, okay? Intestate means you died without a will. So if somebody dies intestate, that means they died without a will, and then probate comes in and just rips you off. I mean, manages it, makes sure that it gets sent to the right place and pisses everyone off. Okay. That's intestate, I-N-T-E-S-T-A-T. Okay. In the money? In the money. We're in the money. We're in the money. In the money is if you have an option, whether it's exercisable. So if you have a call, say you have a 50 call, if the market price, it doesn't matter buy or sell, remember that. If you have a 50 call, any of the market price above 50 is in the money. Anything below 50 is out of the money. 50 is at the money, okay? And on a put, anything below. So if you have a 50 put, buy or sell, doesn't matter. Anything below 50 is in the money, at 50 is at the money, and above 50 is out of the money. In the money means it is exercisable. Doesn't mean profit. It has nothing to do with your profit or yield, profit or return or anything, a loss. It is strictly about whether it's exercisable or not. And in the money intrinsic literally mean the same thing, okay? In the money and in, so if something's so if you have a 50 call and the stock's trading at 53, that's $3 in the money or $3 of intrinsic. If you have a 50 call and the stock's trading at 47, if 0 intrinsic, 0 in the money. They are pretty much interchangeable. When I say pretty much, it's just because I don't really say definite, because they are fucking the same thing. Okay, inverted yield curve. Okay, so an inverted yield curve is we have a normal yield curve. Let's talk about it. Let's have some fun. Okay, so interest rates are going up and down. I know that's awful. Don't worry about it. And then to the right, these are the years. Okay, this is the number of years. Okay, now if you have a bond that's really short term, it's going to have a very low rate. Let me clean this up. Now, if you have so this is a normal yield curve. The longer you borrow something for, the more it's going to cost you, right? So that's the goal here. The longer you borrow something for, the more it's going to cost you. So that's a normal yield curve. Now, if the Fed starts raising rates, the shorter rates move more, and then boom, okay. They start raising the rates. Like now we have an inverted yield curve, which is kind of weird, right? That's an inverted yield curve. And that means the short-term yields are higher than the long-term yields. Usually it's a sign of recession, blah, 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 blah. So it's an inverted yield curve because it's not normal. Okay, we're allowed to say that, right? So it's not the normal thing. So a normal yield curve is this, and an inverted is that. Good. Okay, so what's an investment advisor? An investment advisor is a firm. Remember, it's a firm that gives advice on securities for a fee, ABC. Advice, business for compensation. They're either federally covered and registered with the SEC, or they're state registered under 100 million. They're going to register with the states only. Okay, so investment advisor is always a firm, never an individual. As far as there are instances, but let's leave that alone. It's investment advisor is a firm that gives advice as a business for compensation, and they register either the SEC or the state, never both. The Investment Advisors Act of 1940 covers federal covered advisors. It defines and spells out the rules for advisors that are registered with the SEC. Come on, wake up. You bored yet? Don't be bored. We got this. We're not even halfway through, but we're going to get there. We're getting close to half. We're going to get there. Let's go. And don't forget to please like, subscribe, and share this shit to people who you think it'll help. Let's go. Then there's the Investment Company Act of 1940, which handles mutual funds and UITs and face amount certificates. So remember FUM, F-U-M, face amount certificates, unit investment trusts, management companies, F-U-M. Face amount certificates, unit investment trusts, management companies. They're covered by the Investment Company Act of 1940. Investment banker. What's an investment banker? An investment banker is I guess you could say they're a firm, right? They basically, oh my God, there it is. And what's an investment banker? They assist corporations and issuers in trying to raise money by issuing securities and bonds and stocks. They help them, they give them advice and tell them how to do it. So an investment banker is a person, if you want to say that, firm. Technically, if you work for them, you're an investment banker. But it's I guess it's a type of broker dealer. I'm not saying guess for some reason. It's a firm that assists a corporation in going public, raising money, selling shares to the public, selling bonds, whatever it is. They give them advice and tell them how to work through it. Investment counsel. Investment counsel is basically, God fucking damn it. Investment counsel is an advisor that's principal business is giving advice, investment advice, okay? And investment supervisory services. So an investment counsel, it can't just be one of the businesses they do. It has to be the primary business. Giving investment advice has to be their primary business. Investment constraints, okay? Investment constraints are limits or restrictions that a customer puts on the advisor that they want. Either liquidity needs, time horizon, basically that maybe they want ESG. Those are investment constraints or limits on what the advisor can pick. They're telling the advisor what you cannot do. We want liquidity. We want, we need it in 2 years. We want ESG, ethical investing, stuff like that. An investment grade security is a security that has a credit rating of BBB or higher. BBB, A, AA, all that is considered investment grade. Anything below BBB is speculative junk or high yield. An investment objective is the goal, is what we want. We want growth, capital. We want growth, income, capital preservation. Really, by the way, with suitability, it's kind of everything. It's either growth, income, or capital preservation. There's variances of that, but really, that's what people want. Either growth, income, or capital preservation, safety. That's really everything it is. Again, there's differences in there, but it's all under those three umbrellas. An IRA rollover is like when you get a 401k lump sum or some other retirement plan and you roll it into your IRA within 60 days. You have to do it within 60 days. And if you do that, there's no tax consequences. Okay. That, as opposed to an IRA transfer where you say you have an IRA with Schwab and you want to move it to UBS. That's a transfer. It's basically you never touch the money, right? Because an IRA rollover, you may get the check and have to redeposit it. There's issues with that. But the point is you're touching the money. On an IRA transfer, you never actually touch the money. It's just, hey, JP Morgan, send it to UBS. We're good to go. There's no time limit. No worry about that. Okay. Issuer or issuer. Okay. An issuer is a firm or organization that's issuing or proposing to issue a security. Okay. That would be like Tesla, the government, a municipality like New York City, or anyone issuing. If I went public, if I issued shares or bonds or anything to raise money, I'm an issuer, and the issue is what I send, okay? The issue is me actually issuing the shares. And issued shares are basically how much. So remember, an issuer is someone, a firm, that either proposes or does issue any kind of security, whether it's a bond, preferred, common stock, whatever it is. That's an issuer. They either do it or propose to issue it. The act of issuing is issuing the shares, and then issued shares are the amount we've actually issued. So we've authorized, say we authorize 1 million shares, we actually issue 500,000, that's issued. If we buy back 100,000, that's treasury, and that would leave us with 400,000 outstanding. Outstanding shares is what we have left out there in trading. So outstanding is issued shares minus the treasury stock equals outstanding. But remember, even treasury stock has been issued, it's just been bought back. Okay. Two types of trust. There's a lot, but let's go over there's revocable and irrevocable. Irrevocable means it cannot be altered. Once you set it up, the grantor cannot change it or alter it unless the beneficiary says okay. But for the most part, it's irrevocable, it's untouchable, unchangeable. You can't get your money back. And this way, if you die or whatever, or it's not part of that money is not part of your estate, it's not taxable to you anymore. But again, you have no control over it. Revocable means you can put it in and then take it back and change it whenever you want. J, baby, J. Okay. Joint account. A joint account, we talked about it, is when there's more than one person. We did talk about this. A joint account is more than one person, and they have to be individuals. They can't be corporations. You can't have remember, partnership account is for a limited partnership. It's not two people. Okay. A joint with rights to survivorship. Okay. Joint with rights to survivorship means we have an account. If I die, it goes to you. If you die, the money goes to me. Joint tenants in common means if I die, the money goes to my estate, my beneficiary, my heirs. And if you die, your money goes to your estate, your beneficiaries, your heirs. And remember, joint tenants in common is possibly subject to probate. Now, junk bonds are high yield bonds, speculative. We kind of just talked about them. K, letter K. CJ was quick. Letter K, KEO plan called an HR-10 is for self-employed individuals. Okay, it's a corporate plan that's set up by a self-employed. Now you can have employees. So if I'm self-employed, I may have a couple of employees, but here's the deal with the KEO. If I set one up for myself, I must set it up for them. If I contribute a percentage for myself, I have to give them the same percentage of their salary that I did of my salary. Keynesian. Okay, Keynesian, I'm not a fan of this. It's basically John Maynard Keynes set it up. And it's saying the only entity that's large enough to help the economy out of a problem is the government. Okay. The government, and what they do is they spend money and they do projects and stuff like that. The government spending and lowers taxing. Okay. So that's how they believe that they can stabilize the market. And basically every country does it now. Where the government controls the spending and controls the economy to prevent it from going shitty. Okay. KYC, know your customer rule. That's a rule that requires broker-dealers to get certain information on each of its customers so you know what's going on, so that you know what is going on. Okay, we're on to the L's, and this could be a big one. L, give me an L. Okay, so let's start with last in, first out, as opposed to first in, first out. Okay, so first in, first out, FIFO is when you sell shares. Say you buy a bunch of shares. Let's do it, okay? Okay, so let's say we have three things here. We bought stock in June at 30, and then July at 35, and then August at 37. Stock's moving up. That's awesome. And then it doesn't matter when, but I only sell 100. If I sell everything, we're fine. But if I only sell 100, I'm going to do FIFO. And I probably talked about it already, but we get to see it again. If I choose a method, what I should do is choose these shares. That I'm going to sell shares. I'm going to sell these. So I only pay taxes on $3, which is awesome. That's normal. Select a share. I choose my shares. If I don't choose a method, they're automatically going to go to FIFO, which is first in, first out, which is these, okay? So that means that if I don't choose a method, they're going to choose that. So I would have to pay taxes on $10 versus my $3. So that's where FIFO comes in. If you don't choose a method, they do that. Now, if I have a non-qualified retirement account, they do it a little different. They do LIFO automatically, and I can't change that. So I put in 20K. In a non-qualified account, and it goes to 100K, right? That we're good with that. That's just the way it goes. My shit goes down, but let's pretend it went up. Now you put it in after tax, so you pay taxes on this 20, and now it's at 100. So this $80,000, okay, this $80,000 is taxable when you withdraw it. So when you take the money out of your retirement account, when you take your money out of the retirement account, it's going to start here and go backwards, LIFO. So all the growth is going to be taxed first. So if you take out 90,000, the first 80 is going to be taxed, and the last 10 is not going to be taxed. It's going to be return of principal. So that's what the retirement accounts do. Non-qualified retirement accounts do LIFO, where you're taking the last shit out and then you're going backwards. There you go. Okay, leaps. Leaps are just long-term options, right? Long-term equity anticipation products, but securities really. But they're just options that are up to 36 or 39 months. And the good thing about them is there's a lot of time value, and you're going to pay a lot for them. But if you buy them and they're over 9 months, you only have to put down 75%. Like you can do it in a margin account. Normally with options, you have to pay 100% for everything, right? So on leaps, if it's more than 9 months, you only have to put down 75%. But once it gets within 9 months, you have to put down the balance. Good. A legal opinion. Okay, so what's a legal opinion? A legal opinion is what bond counsel does before you issue a revenue bond, and maybe some geos, seen it on the bond buyer, where they're looking at the lawyer, the bond counsel is looking at the legality of it. Like, is it tax-free? Are there any liens on the property that they're doing? Who owes the money for it? Is the insurance valid? Are the signatures good? All the legal stuff. What they don't look at is whether it's suitable or the credit ratings or any of that stuff. They don't look at whether it's going to make money, whether it's suitable or any of that. They're looking at the legal stuff, okay? And we want an unqualified legal opinion. That means we have no issues, okay? Hey, look at that. It almost matches, right? It's supposed to. It's the same shit. A legal opinion, unqualified legal opinion means there's no issues. A qualified legal opinion, which is what we don't want, that means there's an issue. Either it's subject to AMT, or it's going to be taxable somehow, or there's a problem with the property. Anything qualified just means there's some issues that we have to kind of fix. Legislative risk. Legislative risk is not the same as regulatory risk. We'll get to regulatory risk. Legislative risk is that your security or whatever you have, your security will be affected by tax laws or changes in the laws. That's legislative risk. Lots of limited partnerships have a lot of that because they're worried about the tax law changing. Letter of intent. A letter of intent is for when you buy a mutual fund and you go, look, the break points are 20 grand, but I only have like 9 now. But I think I'll get the other 10. Maybe grandma's on her sick bed, you're getting the money from her. Okay, whatever. Don't want to be that mean, but it is what it is. If you think in the next 13 months that you're going to get money to cover it to get to the breakpoint, you can fill out a letter of intent. And really, even if you don't think you're going to get it, do it because it's not binding. If you fill out a letter of intent, it's good for 13 months. You can backdate it 90, but then it only goes forward 10 months. It gives you the ability to get the lower breakpoint. So let's say I put in 9 now, and it's an 8%. It's normally going to be 8%. But if I get 20 grand in there, it's only 7%. So what I'll do is I'll fill out a letter of intent for another 11 grand and say I'm putting in 9 now. I'm going to put in another 11 over the next 13 months. And then they will give me that breakpoint for now too. So it's awesome. And if I meet the 20 grand, I get it. If not, they do a little jiggering. So what they really do is if you pay a lower sales charge, that means you're getting more actual shares because less of it's going into the pockets of the rep and more is going into the fund. So there's extra shares that you get by paying a lower sales charge go into an escrow account and they grow like they're yours. If you meet the letter of intent, you get the shares. If you don't, they just fold them back into the company and it's like you paid the original sales charge. That's why it's no big deal. Just fill one out and do it. It's almost always suitable. Level load. A level load means they're just charging you a sales charge every year. Boom, boom, boom. I always think of C shares. They basically just charge you a sales charge every year. It's usually small, but it's every year. Okay, so sometimes when somebody dies in an account, you have to wait for some documents. You have to wait, the proof of death and all that. But one of the things you have to wait is for the letters testamentary. The letters testamentary, okay? Though that's a court doc stating who the executor is. So now you know who you can take orders from. That's all it is. Letters testamentary is just saying that that's naming the executor. Okay, leverage is just borrowing money, right? Leverage is borrowing money to increase what you're doing, like issuing bonds and using the bonds to increase your capital to do things. That's all it is. Using margin as leverage. Anytime you borrow money to increase your buying power or your capitalization, that's using leverage. Like if I'm a company and I'm issuing bonds, I'm getting levered up. I'm using leverage. If I issue equity, I'm not. I'm just selling my company. Leverage buyout, LBO, crazy one, right? So an leverage buyout, this is crazy, is when you use bonds or assets to borrow money to buy a company. But here's the crazy one. Say I'm going to take over a company. No, let's do it this way. Okay, so a leverage buyout, right? It's very simple. Again, it's quick and dirty. I'm not really giving it my investment banking buddies be pissed at me. But a leverage buyout is this. Company A wants to take over Company B. But Company A doesn't have enough money, but they go, hey, wait a second. Company B, the company we're taking over, has 100 million in assets. So what we're going to do is we take some of our assets and some of their assets, put them together, even though we don't own the company yet, and either go to a bank or issue bonds and borrow money based on that. So I'm literally, if I'm taking over company B using a leveraged buyout, I'm literally using their assets, the fact that they have assets, to get a loan to take them over. Again, and Milken was the king of this. These were like junk bonds and stuff like that back then. Call them junk then because they were paying 16%, right? But if you're paying me 16%, you can kind of call me anything you want. So company A is taking over company B. They say, oh, that company B has 100 million in assets. We're going to go to the bank or issue bonds or borrow money from other lenders based on that collateral. We'll use some of ours too, maybe. But again, it's almost like we're using their assets to screw them over. And then we're taking them over with that. We're buying over their company. A lot of times it works, like they're working together and it's fine. But technically you could do a hostile takeover this way. Hey, it's worth 100 million. We're going to just buy you out, doing it that way. I think it'd be tough to do now, but it could have been done. A liability is what we owe, right? A liability is we owe that, okay? Like a bond, we owe that money. A liability is what we owe. An asset is what we have. A liability is what we owe. Current assets are short term. They're a year or less, okay? So like current assets are like accounts payable, wages, salaries, dividends payable, accrued taxes payable, stuff like that. And then long term would be like mortgage, bank loans, debentures, stuff like that. So those are liabilities, what we owe. And the short-term stuff is called current. The long-term is usually fixed liabilities. Okay, so LIBOR is London Interbank Offered Rate. It's basically the benchmark. I always think of it as like their version of the Fed funds. So it's basically the benchmark that a lot of major big companies use as their benchmark interest rate, kind of like our internal discount rate or Fed funds rate. That's what LIBOR is. So even we use LIBOR, everyone uses LIBOR as a benchmark rate. Limited liability means that you have a limited amount of liability. Usually it comes down to you can only lose what you put in, kind of thing. So the word unlimited, limited means there's limited liability. Unlimited liability means there's no limit. Like if you short stock or short a call, you have unlimited liability. Literally nothing can stop you from losing money, right? But limited means there is an actual number. It's like if you buy shares of a company, you can always actually lose what you put in. Okay, LLC, limited liability company. That is a where you can have an unlimited number of members. It's a pass-through. It's a corporation. They have limited liability, but they can run the company. Okay, but again, it passes through. The LLC doesn't actually pay taxes. All the money conduit passes right through to the members. They get to run it. You can have different classes of members, and it's like my company, my tutoring company is an LLC. I used to be sole prop, but I became an LLC, so I can't really be sued for stuff. Who knows? They can probably sue me anyway. And then we have that's an LLC. Pretty simple and cheap to set up. Then we have a limited partnership. That's a partnership. You have to have at least one limited partner and one general partner. So remember, I bring this up all the time. If the test or anyone says partnership, they're talking about a general partnership, not a limited partnership. Okay. So a limited partnership has an LP and a GP. The GP has unlimited risk, runs the partnership. LP has limited risk, limited, and they only drop the cash, and that's all they can really do. They can maybe vote the person out, but that's deeper than these exams will go. And you have to have one of each, a limited and a general. But remember, they will say limited partnership. They will, if they say partnership, they're not talking about this. They're talking about unlimited risk partnership. Okay. Okay, what's a limit order? A limit order is when you go to give an order to buy or sell stock, and you put a price on it. Buy 100 shares at 42. That means I'll buy it at 42 or lower. But that's the stuff that shows up in the inside market. If I want to sell 100 shares at 30, I'll sell it at 30 or higher. So if I'll buy limit, I'll buy it at that price or lower or better. That's what they say. And if I have a sell limit, it's a budget. I have a price and I'll sell it at that price or higher or better. Limited power of attorney, limited trading authorization. Limited power of attorney is you have the right. It has to be written for broker dealers, and if it's for an IA, you can have it for up to 10 days, and at the end of the 10 days, it can be verbal or oral for up to 10 days, and then after the 10th day, you have to get it in writing or it ends. Limited power of attorney means you can do any suitable trade, but you can't really move the money around. Full power of attorney means you can do any suitable trade. Wow, I just said that. Plus, you can actually pay bills and do stuff like that. If we jump past that, they all ends at incapacitation or death, whichever comes first, right? Coma, stuff like that. But durable will go through incapacitation, but will still end at death. So limited power of attorney and full can both either be regular or durable. Durable goes to incapacitation. Regular does not, but they all end at death. Remember, all power of attorney ends at death. And for broker dealers, must be in writing ahead of time. Liquidation is two things. One, selling your shares. Just I'm liquidating my account, get it out. Okay. The other one is when a company goes bankrupt, they liquidate it. And what's the order? It's secured, unsecured, preferred, common. If they do taxes and wages, because different states have different rules, they're going to either show you taxes and wages or secured. They shouldn't do both because different states handle it differently. That's the order, okay, of liquidation. Liquidity is the ability for an investor to find a willing buyer or seller. So liquidity is the ability to find a person on the other side of the trade. If you want to buy stock, it's the ability to find a seller at a fair price. And if you're a seller, it's the ability to find a buyer at a fair price. Liquidity, marketability, it's the ability to get rid of it. The other end of it is liquidity, is basically how much cash a corporation has so they can meet their expenses. Liquidity risk, okay? Liquidity risk is the risk that you will not be able to get rid of your shares at a fair price, okay? Liquidity is the ability to do it. Liquidity risk is the inability to get rid of your shares at a fair price. That would be like if you have a lower credit rating bond, or some munis have liquidity risk. DPP MLPs have liquidity risk. A lot of things. Pink sheets, bulletin boards may have liquidity risk. The smaller the company, or the lower quality it is, the more liquidity risk you will have. Okay, listed stock and listed options means they're trading on an exchange. That's it. Listed means on an exchange. Unlisted means not on an exchange. A living trust is a trust created during the lifetime of the grantor. So if I create a trust right now, that's a living trust. It's also known as an inter vivos, while I'm alive, Latin for that, okay? Load means sales charge. So Class A shares, a front-end load means sales charge. Remember, load means sales charge. Okay. Loan consent. Loan consent is part of the margin agreement. It's one of the ones that don't have to be signed. You're allowing it's not to borrow the money. It's part of a margin agreement, and it's allowing your shares to be lent to other people so they can short stock. You can say no to that, or you can even try to get paid for it if you want. Loan value is the maximum amount of money that you can borrow against a position. So Reg T says it's 50% on stocks and 0 on options. Okay. Long means you own it. Long, own, hold, buy mean if you buy, own, hold, long, all mean you own it. I'm long the stock, I own it. Okay, I'm long the option, I own it. A long-term gain or a long-term loss is when it happens for more than 12 months. So a long-term gain is when it's more than 12 months, and a long-term loss is when it's longer than 12 months. Loss carryover, carry forward, loss carry, whatever you want to call it. It's like if you have a loss of $5,000, we know you can use $3,000 as earned income, ordinary income, and then you carry forward the rest. That's a loss carry forward. A long coupon. Okay. So usually when a bond is issued for the first time, we know that bonds are every 6 months, right? So we know that bonds are every 6 months. Okay. So what happens is when they first issue it, say we have the dated date, say it's a January and July bond, and then the dated date is like February or March. Well, they don't want to pay a 4-month coupon. So what they'll do is they'll make the first payment next January. So it'll almost be an 8 or 9 month coupon. So it's a long coupon, means it's only on the first one, and when it's longer than 6 months. They only do that to keep everything going. A long straddle is when you buy a call and buy a put at the same time. You buy them both. You're looking for volatility, unlimited gain, limited loss. And since I'm here, I'll talk about a short straddle is when you sell a call and sell a put. You're looking for income. You can only make the premium. You're hoping nothing happens. Short straddle, stability. Long straddle, you want volatility, okay? Always remember, straddles are the only things with 2 break-evens. They have an upper break-even and a lower, okay? Long-term liabilities, that's liabilities that are longer, like circular definition, that's over 12 months. So like like bonds or a bank loan or a mortgage or something like that. Loose credit. Ooh, loose. Never mind. I'm just kidding. Easy. Wow. I'm really just laying them up there. Easy money, loose credit. That's when the Federal Reserve is loosening the economy. That's when they're buying treasuries and lowering the discount rate. L shares. Okay. So L share variable annuities. Okay. L shares in a variable annuity is a type of annuity where there's a short surrender period. So let's talk about surrender period. If you put money into an annuity and you're going to do a contract plan where you put it in over time, or you're basically just putting money in and you're going to hold it for 20 or 30 years, that's fine. If you take it out early, they may charge you a surrender charge, okay, or a period on top of the taxes and all that. But L shares may have a shorter one, like maybe it's only 10 years instead of 20 years. I don't know what it is, and nobody cares what the numbers are. But L share annuities are that the period where you pay a penalty is a shorter amount of time. Okay, I think that's a good place to end it. I'm not going to do M. M's a big one. I'm going to start the next one in M. That's literally like half the alphabet, and I think I'm at 5 or 6 hours. It's crazy. Infinite, and I'm here to help you pass the Series 7, the SIE exam, the Series 65, the 66, and on the Series 6. So back to this, the longest, boringest, most valuable videos I can do, because I'm just going to go through the financial terms. So this way, when you hear something, you go, oh, I know what that is. You may not be able to answer the question, but you should know what it is. Okay, we're up to M now. M is in Mary. M is in mahogany. M is in I don't know. So let's start with this. M1. Okay, M1 is the basic money supply. Okay, it's all the currency in circulation plus like checking accounts. Okay, that's M1. M2 is that plus on-demand deposit savings account, stuff like that. So M1 is the most fluid, most liquid. M2 is that plus savings accounts. Okay, makers, M-A-C-E-R, M-A-C-R-S. So you're allowed to depreciate certain assets. So normally you do a straight line depreciation. If you have a $100,000 car and it's 10 years before the average life of it, according to the IRS, is 10 years, you could write off $10,000 a year in depreciation. That's straight line. Accelerated or makers, which probably won't be on the exam, but it's good to understand it, means you're going to take more in the beginning. Like maybe instead of taking 10 grand a year, you take 20 grand for the first couple of years, like maybe 3 years, and then you divide the last 6 into like 6 years, or 60 grand. I can't do math. So let's start over. Okay, makers, modified accelerated cost recovery system. That's fancy for depreciation, but normal depreciation is straight line. If you have a $100,000 truck, you get to write off that it's losing in value every year. So the IRS says, let's say it has a 10-year lifespan. They'll let you write off your $100,000 truck over the 10 years, which means you get to deduct 10 grand a year. Boom, boom, boom. That's regular straight line depreciation. I want to say accretion, but it's depreciation. Now, accelerated means instead of taking 10 grand a year, you're going to take more in the beginning, like maybe 20 grand for the first 2 years, and then spread the last 60 grand over the next 8 years. So you're going to take more deductions in the beginning and less at the end. So you'll have less taxable income in the first couple of years, but more in the end. And the reason they do that is because they go with, well, money now is worth more than money later. So I'd rather have the deductions now than later. So that's makers, M-A-C-R-S. Okay. Maintenance. Okay. Maintenance for, that's not like fixing, car and stuff like that. Maintenance is the minimum amount of equity you can have in a margin account. Remember, I know we talk about it later, but margin, just do it now, do the whole thing. A margin account is when you have an account that you're allowed to borrow money. You can leverage, you can borrow money to buy more shares. Instead of a cash account, like a cash account, you have to come up with 100% of whatever you're buying. A margin account, you can do less. And there's ways that you can do less than 50%, but we're just going to stick with, for this test, Reg T covers margin, and it says that you have to deposit 50%, and you should have 50% equity in your account all the time. So if you buy 10,000 in you buy 10,000 in stock, you should put down 5 grand. You can't really put that less than that. Now that's margin, okay? A margin call is when you buy the shares and they say you have to put up the money, or if you go below minimum maintenance, you have to put up some money. So maintenance on the long account, if you have a long margin account where we're buying shares, 50% is Reg T. But if the stock goes bad and your equity starts dropping, your equity can't fall below 25%. So again, your equity can't fall below 25% equity. So it's 25% of the market value. If it does, then they're going to give you a maintenance or margin call and tell you to put up some more money. On the short side, your equity can't fall below 30%. Okay. So again, on the short side, your equity can't fall below 30% of the market value, or you will have to come up with some money. Okay, market maker. Market maker. What's a market maker? A market maker is a firm, a broker-dealer member, FINRA member firm
That's their job. Their main job is to make a market in a securities. Wow, circular definition. That doesn't help me at all, okay? So a market maker is someone who has to be willing to buy and sell shares all the time. And they don't have to just be willing. They have to be out there saying, I'll buy shares at this price and I'll sell shares at this price. They have to have an active bid and offer at all, two-sided market, a bid and offer at all times, minimum of 100 shares. Well, that's NASDAQ. On the over the counters, they just have to have they should have a quote somewhere in there. They don't have to, but they should. So market makers buy and sell, they make bids, they make offers, and that creates the liquidity. By on the NASDAQ, if they have to be there from 9:30 to 4 every day, then by having multiple market makers, make 20 or 30 market makers, maybe more in a stock, that creates a market where there's a bunch of buyers and a bunch of sellers. And that's what happens. Now let's jump on this a little bit. So if you're a market maker, what you're going to do is you're going to buy at the bid and sell at the offer if you can. And if you buy at the bid, you're going to charge your customer markdown. They go to hit your bid, they sell it at your price. You're going to charge them, you're going to pay them a little bit less. So if you're bidding $50, you're going to pay them $49.50 maybe. So you're charging a 50-cent markdown. That's your commission, that's your profit. If they're buying from your offer, say you're offering it at 51 and they buy it from you at 51, they're buying it from you. Remember, as a broker, you're a middleman. This one, you're actually the other side of the trade. You're selling it to them. So you sell it to them at 51, but then you really charge a 50-cent markup. So you're actually selling it to them at 51.50, charging a 50-cent markup. So market makers make markets. They buy and sell all day long. They're supposed to be there all day long. That's their job. They trade. They're doing everything principally PDM, principal dealer market, markup. So if a customer buys, they charge a markup. If the customer sells, they charge a markdown. Okay, management companies. What's a management company? So under the investment company Act of 40, there's three things. F, face amount certificates, U, unit investment trusts, and M, management companies. That's like mutual funds, closed-end funds, ETFs. They're pooled investment and they have a manager, and the manager actually charges a manager fee, and that's part of your expense ratio. So kill two birds with one stone. Management company is an investment company that has a portfolio of securities, and they trade them. They could be active or passive or whatever. And the more passive they are, the less the fees, the less the management fees are. The more active they are, the more the management fees are. So if you have a closed-end fund or an open-end fund that's actively managed, there'll be real management fees. If you have like an index fund or an ETF or even a fund that's passively managed, the management fees will be lower. That management fee is what you pay the investment advisor, portfolio manager for managing portfolio. Not to be confused with the manager's fee. Oh God, the manager's fee is for an underwriter, right? So the lead underwriter, that's another one. The managing underwriter will charge will basically make some money. Let me do this right. The lead underwriter, the managing underwriter, that's an M, will be the book runner. They're the one who cuts the deal with the firm wanting to sell shares. They sign the underwriting agreement. They may buy all the shares and then run the show and then bring in the syndicate members, okay? And they make the manager's fee, which is really the difference between what they pay the issuer and then they sell to the syndicate. So if I'm going to pay the issuer $18 a share and then I sell it to the rest of the syndicate at $18.25, right? That's going to be a 25-cent manager's fee. That's fine. That's the way we do it. That's easier than saying, hey, just sell it and cut me a check. I'm going to buy the shares at 18, sell them to the rest of the syndicate at 18.25, and then the syndicate will sell them to the public. So that's the managing underwriter runs the show and they make the manager's fee. Again, not to be confused with management fee, which is for a mutual fund or a management company that pays the manager who manages it. Okay. Marginal tax rate. Marginal tax rate is the last marginal tax rate is the tax on the last dollar you earn. It's like, what the hell are you talking about? So what happens is, oh, okay. So these are ballpark tax. So the first 11, let's say you make 100 grand. Okay. The first 11 grand you earn, you're going to pay 10%. From 11 to 44 and change, you're going to pay 12. From 44 to 95, you're going to pay 22%. And anything above 95 up to like 180 or so is going to be 24%. So you're not paying 24. If you're in the 24% bracket, you're not paying 24% on everything. It's some mix of this. So actually, when you do the math on this, which I'm not going to do, that's what they call your effective tax bracket. Your marginal is this. So if you make 100 grand, your marginal is your top tax bracket. So when they're trying to figure out, oh, you do an investment, And what do you pay taxes on? It's going to be this rate, because remember, anything you make is going to be on top of the 100, all the way up to 180. So everything from 95,000 to 180 is going to be taxed at 24%. And that's your marginal tax bracket. That's not what you're paying on everything. And your effective is obviously going to be lower than that, but that is your top tax bracket. And anything you earn on top of the 100 grand through investments and stuff, if it's ordinary income, will be taxed at this 24%. Or if you're over in 180, it'll be 32%. Again, these are ballpark numbers, but that's the idea, that a marginal tax bracket is your top tax bracket. It's not what you're actually paying in total. It's just what you're paying on the last, they call it the last dollar you earn. Market cap. Market cap is really just how big the company is. They're not going to make you memorize the thing, so I'm not going to waste your time with it. But like they have large cap, mid cap, small cap, micro cap, nano cap. So it's all it really is the outstanding shares. Remember, outstanding, not issued, not authorized, outstanding shares times the market price. Again, market price times the outstanding shares. That is market capitalization. And if the stock goes up, if the stock goes up a lot, you become a bigger company, maybe. Like Apple, I think, is over $1 trillion, and it's really just the number of shares times the market price. And if the market price were to drop, it would go back under $1 trillion, maybe, or higher, it would give you more. So it's all market cap is specifically outstanding shares times the market price, and it changes every day. Okay, market risk. Okay, market risk is the risk that you're going to lose your money. Yeah, it's called systematic risk. Okay, it's that the whole market drops. Okay, so if you have market risk, the whole market drops. Okay, and then yours is going to go down. So let's use the banking crisis from a few weeks ago. That the banks were, there was a bank run, everyone's worried. So what happened? All the stocks went down. Every stock, even not banking stocks, everything, tech, everything went down. And there's not much you can do about it. I mean, you can buy index puts, but as far as diversification, you can't diversify away from market risk. You can against business or non-systematic, but market risk and systematic risk, you cannot diversify that away. That is just not a thing. You can buy index puts to protect it, but market risk is like what if the whole market going down big. Like March 13th, 2020, the market was down, 900 points, if not more. No matter what you owned, you were losing money. That's market order as opposed to a limit order. A market order, well, let's do a limit order first. A limit order, even though it's not an M, a limit order is when you offer to buy something or sell something and you give a price. They're not going to say take a limit order. They're just going to say, oh, buy the shares at 40 or sell the shares at 40, which means if I give you an order to buy shares at 40, you are not paying more than 40. You will not do that. And if I give you an order to sell shares at 40 or 30, you're not going to sell them below that. That's a limit order. Okay. On the second side, a market order is the order to buy shares. Okay. And buy shares or sell shares. And I'm not giving you a price. Just buy them at the best available, the next price. If it's at 42, it's at 42. If it's at 42.10, it's 42.10. I care about price because I'm not an idiot, but I'm not worried about it. I just want you to buy it because it's more important for me to get the shares or sell them than to worry about every little nickel. So again, a market order means I'm giving you an order to buy or sell at the next available price. Execute it immediately. Unless they say not held, and then you can wait, but we'll get to that. Okay, a market out clause. A market out clause is basically if I'm an underwriter, I sign the agreement, I'll have some certain parameters in there that if something hits the fan, you know what that means, we can get out of the deal. We can cancel it or postpone it or whatever it is. Certain things that make it impossible to sell, like maybe the CEO was caught with fraud, or the CEO we work caught borrowing too much money, stuff like that, or COVID hits, some event or something that happens that gives us the ability to back out of the deal. That's all. That's what a market out clause is. Okay, let's talk about manipulation. Manipulation is when you try to fraudulently move the market for your benefit. Okay, so manipulation is when you try to move the market for your benefit. You either try to get people to buy or sell or move it or do something, but you're lying, defrauding. You're not just giving an opinion. You're saying you're lying, committing an act. Things like matched orders. What are matched orders? It's where you and me, or you have two accounts and you place a buy and a sell at the same time, literally identical pretty much, and have them actually, you send them to the floor or onto the market at the same time. And you know they're going to execute against each other to create volume and make people think a certain price. Maybe you have them go up in price or something like that. So it makes people think that there's something going on there when there isn't. It's lying, it's fraud, it's stealing, it's criminal. That's a matched order. Okay. That goes along with manipulation. Marking the open and marking the close is similar. That marking the open or marking the close is placing orders right before the close or the open to make it open or close at a certain price. So a market in the open is placing a bunch of orders to buy or sell to make the price close at a certain price, or if it's an open at a certain price. Again, it's manipulation and it's not open. Okay, market price. Market price is the last reported price of a stock or a bond, basically where it's trading. If somebody says what is it trading at, that's the last sale, that's the market price, whatever it is. It's trading in the secondary market as a market price. That's it. Now, mark to market is a way of valuing a stock, is how you value a stock or a security or an asset based on the last reported trade or where it closed. That's the market value of something to determine what the value is. And the reason it's important is a lot of things, but the one that's going to be on the exam is more about you're using mark to market to determine if you have to come up with more money for margin, whether you're short or long or whatever. If an option, it's futures, it's all this stuff, but it's used to determine if the value of your security is too low, where you would need to put up more money. That's what mark to market is. They do it on like a daily basis. They check your prices, and then they check it to see against what your contract is, whether you owe money or not, and to decide if you need to put up more money. Sometimes people use it for profit and loss. When I was early on, we do mark to market every day to check our positions to see if we made money on a given day or not. We don't know taxes on it because it's unrealized, but it was an idea of, up or 3% today. We're down 3%. We do all our securities, compare them to the day before. It was on paper, it was a pain in the ass. I suck at that shit. And we would just figure it out. And that's mark to market every day, checking out the price. Material information. Okay, so there's material and immaterial or non-material. Material is information that's important for a person or an investor or anyone to make a decision on whether to buy or sell. So material information is stuff that is important. So if you are making a recommendation, you should disclose all material information that you know, that would help them decide to make a decision on whether to buy or sell. Immaterial, it's not a big deal. I mean, so material will be like if we had a merger, a takeover, or in trouble, or we, maybe started a new business line or something like that. Immaterial is like, one of our subsidiaries moved from Broad Street to Main Street. Who cares, right? Stuff like that. So, or we have a new manager in one of our warehouses of a subsidiary or something so far down the line, it doesn't really matter. And that's where the whole inside information thing comes in. They call it MNPI, material non-public information. So like if you're in possession of immaterial information, who cares what you do? Because it doesn't matter, right? But material non-public information means it's non-public, private, inside information that matters, that would make a difference. So having that in possession isn't the crime. It's the acting on that information. So if insider trading is based on, if you have the information, it is what it is. But if you trade on it or act on it or tell other people about it, that's where the problem is. But again, if you tell people material information and they don't do anything, you don't have a problem. But once you say something to someone, you can't control it anymore. So keep that in mind. Okay. And what happens if you do become in possession of material non-public information? You should tell your supervisor or compliance department or a principal and ask them what you should do. A married put. So a married put is when you buy stock and buy a put the same day. Okay. A married put is when you buy stock and buy a put on the same day. And why you do that is that if you buy a married put, the break even or your cost basis will be impacted by what you pay, and it's considered one position. If you do it on the same day, it's one position. And the good thing is if you buy stock today and you buy a put on the same day, your holding period, which you want to be over a year to get a lower tax bracket, continues on with no problem. But if you buy a put after the day, say you buy it today, you buy the stock today, and you buy the put in a week. Well, you've held this week. You've held the stock for a week now, but once you buy that put, it goes back to zero and stays at zero, your holding period, until you get rid of the put. Why that matters is you want to hold it for over a year and a day, and then you get long-term status, which is a lower tax bracket. That's not going to happen if you buy the put. It's going to take a longer time. So if you buy stock and then buy a put 9 months later, well, your 9 month of holding time is now put down to zero. And then when you sell the put or let it expire, it starts up at 1 again. So you could really extend your time. So the 2 times that you can buy a put and not have a problem, if it's a married put, you buy it on the same day. Or if you wait till after you've held it for 1 year and a day, over a year, then there's no problem. Maturity date. This is for fixed income usually, not preferreds, not common. Maturity date is for bonds, like notes, bills, bonds, stuff like that. Any kind of muni note, any kind of muni bond, corporate bond, treasuries. They don't last forever. So there's a maturity date. That's the day the principal gets paid back. That's what it is. A maturity date is the day the principal gets paid back and the issuer no longer owes the money. That's it. That's a maturity date. Okay. Mean. We're going to go through the three of them. Mean, median, and mode. They're all M's, but they're not all together. Mean is the average. That's you add. You take all your numbers, you add them up, and then divide by the number, and you get mean. I'm not going to do the math. You should be able to do mean. That's average. Median is the same amount above and below. It's like the middle. It's the same amount of things above and below. That's the median. And mode is how many times a number shows up. So if you have a bunch of numbers, the number that shows up the most, if there is one, is called mode. So again, mean is average, median is the middle, and mode is what shows up the most. Modern portfolio theory is a method of diversifying and reducing risk and increasing your portfolio, looking for an optimal portfolio. But what you're looking at, you're not looking at each security on its own. When you have to make sure that's suitable. We also have to look at the portfolio as a whole and look at that and how they work together. Like you want to diversify. You don't want to have all muni bonds, right? Because then you have all interest rate risk and inflation risk. So you want to diversify your portfolio. So you're going to look at the entire portfolio to determine the risk, okay? And that's what you're looking for. Instead of looking at one security's risk, you look at how the relationship between all the securities together creates a level of risk. That's modern portfolio theory. Mediation. So mediation is when they have you sit in a room and they all have a little peace person in the middle, like a FINRA arbitrator who sits there, and basically you're going to hash it out and they're going to make sure you don't kill each other. That's the whole point of it. The mediator goes, whoa, whoa, whoa. They try to mediate it and keep you in the middle. They don't have any control over it. Their job is just really to be in the middle and make sure that everyone gets to hear their say and stuff like that. And mediation is not binding until you sign, okay? When you sign the contract, you say, oh, we come to a meeting of the minds, we sign, and boom, we will get, then it's binding. But until then, you can walk away at any time. It's usually a precursor to arbitration. So you file for a complaint, you want to work it out, you're going to file an arbitration complaint, they're going to send you to mediation first to try to get you to do that. Then after that, if that doesn't work, you go to arbitration. A member order is where a member order usually comes after all customer orders, right? A member order, there's a whole muni one, but I don't think we're going to go there. A member order is when a friend or member wants to buy or sell shares. They take the back seat. So if there's a public customer order in the I'm stuttering, in the book or something, and it's out there, the customer order will be filled first, then the member order, because they have to come last. Member orders come last. What's a merger? A merger is when two companies come together, okay? There's a lot of insider trading stuff with that, like people worried about that. That's where it usually happens. But it's like if, when one company merges with another, like T-Mobile and Sprint getting together, and they go through a whole rigmarole. They have to go through a lot of federal laws federal agencies to make sure that they're not creating a monopoly. Like if Coke and Pepsi went together, or say AT&T and Verizon merged, that would cause a problem because that would give a monopoly pretty much of the whole market. So they would probably kill that. But that's a merger is when two companies come together, as opposed to a takeover when one company buys all the shares of another, like a tender offer, which we'll get to when we get to the T's. Member firm, I think I've said this a few times, a member firm is a broker-dealer that is registered with FINRA, that is a member of FINRA. They're registered with FINRA. They're subject to FINRA's rules. Okay, what's the mill rate? The mill rate, let's get into it. So the mill rate is what each town sets their own mill rate, and that's how they decide what to charge you on property taxes. And the books all do this 0.01% shit. It's so much easier than this. If God forbid you have to figure it out, you most likely won't, but it's super easy. All you're going to do is, this is the mill rate. This is how you're going to figure it. Each town has their own, whatever. So you're going to use this to figure out what you owe in taxes. All you're going to do, now you don't do market value. Market value is not the one we use. We use assessed value. That's if you live in a house every like 10 years, the town comes in, counts all your rooms. They have some new person count the rooms, see how big the house is, how the land is, and come out and then change your taxes and say you owe us more money. They're assessing it. So it's usually never the same as market value. But let's say it's assessed value of 300,000. And you go, wow, the mill rate is 4, which is 0.0004. That's so hard to do. So I just do this. I take off the last 3 zeros and then multiply. It's the easiest way to do it. So 4 times 300 is 1,200. So in this case, I would owe 1,200 a year in property taxes. It's that simple. So again, all you're doing is taking off the last 3 zeros of the assessed, not market value, last 3 zeros of the assessed value, whatever it is, whether it's 30 million or 300,000 or 4 grand or whatever it is, the last 3 zeros off and then multiply times the mill rate. 4 times 300 $1,200, super easy. A mini max offering. Okay, so a mini max offering is a type of offering which is going to be a best efforts, which means the best efforts is where we're going to do an offering, try to sell shares, try to sell as many as we can. But there's two types of contingent ones. There's an all or none, which means you either sell the entire issue or none at all. Like say I go to sell 1,000,000 shares, I say either sell the 1,000,000 or don't bother at all, or I do a mini max and go, look, here's a minimum. You want to sell, I want 1,000,000 shares sold, but if you get to 600 grand, we're good to go. So if you don't get to the 600, we cancel the deal. So on a mini max, we want to get to a number, and then once we're at that number, we'll try to get the rest. But we got to get to that first number, or the deal is canceled. That's what best efforts is. Mini max is part of best efforts. Okay, monetary policy. That's where the Federal Reserve comes in and tries to. Monetary policy believes that if you impact the money supply, monetary, you can impact the economy. That's what's going on now. They're raising the rate, like they're trying right now. It's 2023. In case you watch this in 20 years when I'm long dead. Monetary policy is the Federal Reserve is trying to slow down hyperinflation. So they're raising rates and selling treasuries and stuff like that. So they're trying to affect the money supply to make it harder to borrow. And during contraction, they will try to increase the money supply to make it easier to borrow. So that's money supply that they believe that they're trying to use the money supply to control the economy. That's not fiscal. Fiscal would be if the government's doing it through taxes and legislations and spending. So monetary policy is basically moving the money amount, changing the level of money in the economy to either slow down or speed up the economy. That's monetary policy. What's a money market? A money market is basically short-term debt, usually a year or less. I think you can go to 13 months. I keep seeing questions on that, but it's really like commercial papers, T-bills, bankers' acceptances, CDs, repos, federal funds, stuff like that. All short-term stuff, a year or less. Short-term debt, a year or less. Long-term bonds are not. Common stock is not. Preferred is not. Anything like equity would not be a money market. A money market fund is a mutual fund that pretty much that just invests in short-term debt. It's basically it's earn interest without having any risk. It's where you park your money kind of thing. Because individual retail customers don't really buy money markets. They'll buy money market funds. It's easier that way. Big companies who need to park their money will buy money markets, but retail will buy money market funds. And unless they've changed it, the NAV is always going to be $1. And usually, it's like a checking account. Sometimes you can write checks against the money. You don't have to put a lot of money in, stuff like that. It's almost like a checking account with a better return. And the money supply is that M1, M2 stuff that I talked about earlier. Monte Carlo simulation. That's basically what we're doing is we're throwing a bunch of scenarios at a portfolio. We're running a bunch of simulations at a portfolio to determine how much it'll go up versus down. And that's how we kind of get standard deviation. This was we're throwing all these scenarios at the portfolio to see, we're doing like a stress test in a way. We're seeing what it will go up or down based on the different scenarios. So that's Monte Carlo simulation. Moody's and S&P, they do credit ratings, right? So Moody's basically does a I say basically way too many times. Okay. So Moody's and S&P, they do the credit ratings. That's what they do. AAA is the top, triple B or BAA is the lowest investment grade, double B or BA, they're similar, are the highest speculative grade. So that's what Moody's is that, and so is S&P and Fitch. What's a moral obligation bond? The sun just hit me, so it's like, ooh, I'm like fading away. Okay, now, moral obligation bond. Okay, moral obligation bond is a bond that is it's kind of like a double barrel in a little bit. It's a revenue bond. Okay, it's a revenue bond, but they also, if they run out of money, which they normally don't do, if they run low on money and they can't pay their debt service, they will reach out to the town and the senators, whatever you want to call it, the trustees, whatever you want to call the council members, will vote on whether they pay it or not. And they don't have to. It's a moral obligation. They don't have to make it up. They can if they want to. So they can say no. As opposed to a double barrel, which is a revenue bond first, but it's with I call it a revenue bond with a geo kicker. So it's like if there's a hospital, you can't let it fail. So if there's not enough money, which has never happened with the hospital, if there's not enough money, then they will just take some of the ad valorem taxes to pay the debt service on that. So double barrel is where they have to. Moral obligation is they get to if they want to, but they can say no. The town can say no, we can't afford it. What's a mortgage bond? A mortgage bond It's not a mortgage-backed security. Remember that. Mortgage-backed security is basically looking at cash flows from people paying the mortgages, and you're getting a part of it. That's not this. And there's prepayment risk and all that. A mortgage bond is a bond that is backed by property. So we have debentures, which are unsecured bonds. Then we have secured bonds, which are mortgage bonds. Mortgage bonds, like you issue a bond and say, listen, lend me the money, and then if I default, I'll sell my property to pay you. That's a mortgage bond. Okay, good. Another tool of the Fed is moral suasion, kind of like persuasion without the PER. So it's when, like, Jerome Powell, the current Fed chair, after he decides to change the rates, they give a speech and they go, oh, he goes out there and does a barnstorming. He goes, oh, the banking crisis is over, or we're looking at more pain in the future. Sometimes that affects the economy a little bit, because you could watch him, you could see the market's up, and then he says something like, oh, it's going to be a lot of pain. The market drops. It does. It affects the money supply. It impacts people's reactions. So that not only do they vote to raise the rate or lower the rate and buy or sell treasuries, they use moral suasion to give you an idea of what they're looking at to decide what they're going to do in the future, so you can react. Just to get back into it, a mortgage-backed security kind of CMO is where you're buying a product that represents an income stream from people paying the mortgages. So they pool these mortgages, and then people pay into the mortgages, and you're buying this pooled investment of it. And each month you're going to get a little bit of interest and a little bit of principal. Your biggest risk on a mortgage-backed security is usually not default risk, because mortgages really don't do that, especially Ginnie Mae mortgages, but prepayment risk. That if rates go down, what do? People refinance, right? So mortgage-backed security, the biggest risk really is prepayment risk. That as rates go down, people are going to refinance, which means they're going to pay off the one that you're getting paid on and borrow from somewhere else to get a lower rate, and now you're getting less money. Because remember, the thing about a mortgage-backed security is, unlike a bond where you get a lump sum at the end, here you're getting a little bit of an interest and principal every single month. So over the 25 or 30 years, you're going to get all your money back as you go along, not in one lump sum. So what's a moving average? A moving average is like you plot all the prices over time, and then you look at the average price over the time, like the 60-day, 90-day, 120, 180. You're looking at the average prices, and you plot the line so you can see like a trend up and down. Technical traders use that. Okay. A multiple is just like what they call the PE ratio. This is fundamental. I like how it goes both ways. PE ratio is a multiple. PE ratio, which is a multiple, that's a code word for it, okay, slang, is how many times the market price is trading over the earnings. So PE is price divided by earnings, right? So that's the multiple, price divided by earnings, okay? And that's called the multiple. So if you have a growth stock, it's like 30, 40 times earnings. That's a multiple of the earnings, okay? So again, it's price divided by earnings per share. That's the multiple, or the PE ratio. Municipal bond is a bond issued by a city, town, state, and the big advantage of that is that the interest should be tax-free. Capital gains are never tax-free, but the interest should be tax-free. Who buys them? Rich people buy them. If it's a GO, it's for stuff that's free to use, and it's backed by taxes. It's non-self-supporting. A revenue is for stuff that costs you money, like hospitals, tolls, stuff like that. And the money from people paying the tolls and the fees and the rents and all that cover the debt service. That's the difference in GOs and revenues. Those are both muni bonds. Rich people buy munis, poor people buy corporates, wimps buy treasuries. And a muni bond fund is just a mutual fund that just buys muni bonds. Boom. And let's throw it in here. So it's usually a mutual fund that buys muni bonds, and it has the same kind of it's trying to find federal tax exempt stuff. So make sure we're clear. Muni bonds do not pay federal tax on the interest. You might pay state or local if you buy from another state, but muni bond funds, usually the interest you're getting is not going to be taxable. A muni note is a short-term muni bond. TANs, RANs, BANs, you can look that shit up, but they're short-term muni bonds. MSRB, all they do is write the rules. They do not enforce. MSRB is Municipal Securities Rulemaking Board. They write the rules for munis, not for the issuers, but for the dealers, but they don't enforce them. The last M is mutual fund. A mutual fund is an investment company. It's a pooled investment, open end. We have a whole videos on that, so you should know this. A mutual fund is a pooled investment that hopefully diversifies your portfolio. So you buy it for the management, you buy it for the liquidity, and you buy it for the diversification. And you buy it at NAV plus a sales charge, and you sell it at NAV, and it's priced once a day. You should know what this is. Hey, this is Ken at Capital Advantage Tutoring, and it's time again to get into the letters. So now we're doing N. I hope I can get to O and P at the same time because they're not super big, but we're going to start. This episode is sponsored by the letter N. N as in Nancy, and is a nincompoop and is not going to fall asleep while I'm doing this. Let's get into it. Okay, the first term you can hear is naked. Same as, oh, it's naked. Naked is uncovered. Whenever you hear the word naked or uncovered, that means it's by itself. And it almost always means it's a sell of an option. So like a naked call is an uncovered call, which is like selling a call. An uncovered call is a naked call, which isn't selling a call or selling a put. It's never really going to be buying. You don't buy naked, you sell naked. Like a naked short is actually when you short stock without getting a borrow, whatever. Okay. But you can also talk about NASDAQ. Basically, it's an exchange that's an over-the-counter exchange that is level 1, level 2, level 3, all these different stuff. But the NASDAQ is an exchange much like the New York Stock Exchange. The NASDAQ is a negotiated market where broker-dealers deal with each other. And the New York Stock Exchange is a hybrid auction market where they deal with the exchange and they sit on a floor and they trade. It's a more electronic now, but the thought process is that all the stocks trade in one spot. They have one DMM, designated market maker, like a specialist whose job it is to maintain a fair and orderly market. And you deal with the exchange, not really with each other, where on NASDAQ, you're negotiating broker-dealer to broker-dealer. NASAA, North American Securities Administrators Association. It sounds like a bunch of letters, but it's not the space one. It is an organization that is there to protect investors by writing the rules and all that for all the different state administrators, not FINRA, the state securities administrator. The National Adjudicatory Council. I can't even say National Adjudicatory Council. That's basically if you get nailed by FINRA and you want to appeal it, that's who you go to. The Adjudicatory, the NAC, the National Adjudicatory Council, don't ask me to spell it, is the council where we get appeals. Anything we get screwed up on, we appeal on. Okay. Now we have capital markets and national capital. I don't like that. We're going to do them anyway. National capital versus national global. National capital markets are like the old small caps, okay? Then national global are the large caps, and then national global select are the biggest. So it's all about market capitalization. We've talked about that. Market cap is what the company's worth. So a small market cap company is a national capital market. They have lesser listing requirements. They're not as liquid, stuff like that. Global market is the bigger ones. Those are the bigger companies. And that's the old large caps. And then global select is the bigger one. Okay. That's the highest one. They have the most strict requirements to get in there. They're more strict than global market. They're similar to the New York Stock Exchange listing requirements. NAV, net asset value. Okay. NAV is the net asset value. That's going to be what you pay for the mutual fund. Yeah. When you buy in, you pay NAV plus a sales charge. But NAV is net asset value. It's what and they calculate it once a day. When you buy a mutual fund or any kind of investment company, they have an NAV. If it's an open-end fund, you are buying it on the NAV plus a sales charge. And when you sell it at the NAV. If you have to do the math, it's assets minus liabilities divided by the number of outstanding shares. Okay. A negative consent letter. A negative consent letter is basically if I say to you, hey, do you mind if I do this? Only respond if you have a problem with it. Usually what happens with net basis trades. Well, we're on this. So a net basis trade is when we do a principal trade, but we don't disclose the commission or the markup to you. So it's kind of like when you buy shares at 40, I'm going to sell to you at 41 and say, hey, you bought them at 41. I built in $1 markup or profit, but I don't disclose that to you. So if I want to do that, if you're an institution, I have to send you a negative consent letter saying, hey, we do pre-do net basis trades. Do you have a problem with that? If you do, let us know. If you don't say anything, we're going to assume you're okay. We can only do that with institutions. You have to actually get permission from a retail customer to do what I just said. So again, negative consent letter means you only come back if you don't say anything, we think you're okay with it. Okay, so now negotiable versus auction market. So the NASDAQ is considered a negotiable market, okay? And then the New York Stock Exchange's auction is hybrid, okay? But we're going to go back to that. Negotiable means tradable. So there's really two types of things that can happen. Either a security is negotiable, which means it trades on the market, or it's redeemable, which means you buy and sell from the issuer like a mutual fund or a UIT or an annuity. Okay, a negotiable CD. It's a money market. It's usually a minimum of 100 grand, and it pays interest paying. And it's negotiable, means you can trade it between parties. Not so much trade on the exchanges, but you can get in and out of it. You don't have to hold it the entire time. That's what negotiable means. Again, back to that, tradable. Okay, net income. Net income is basically your earnings minus all the costs of depreciation, interest, expenses, taxes, selling, all that. It's your net income. It basically think of net income after all your expenses, kind of like your paycheck. I make 10 grand in a month. and I only bring home like 7 or 6 because all the taxes and everything come out of it. So net income is what you're actually, the income after all the expenses are taken out, taxes, everything. Now there's net interest cost and true interest cost. It's the way they measure whether they decide who's going to win the bid for a muni offering. So I'm a municipality, I do an auction, I send it out there and say, hey, everyone, a competitive offering. Everyone, please decide where you're going to, what we're going to bid on it. And we either do it NIC or TIC, NIC or TIC. Don't go in too deep into it. Just NIC does not take into account time value of money, where true interest cost does take into account time value of money. I would go with that one. Net revenue pledge. So there's gross revenue and net revenue. So again, back to the munis, right? So if we have a municipal bond and we decide, okay, where are we paying the debt service? Debt service is the interest and principal payments. Are we paying them out of the top line or the bottom line? Again, what the fuck does that mean? Top line means if it's gross revenue pledge, which we talked about already, probably gross revenue pledge, we pay the debt service before we pay any expenses or maintenance stuff. If it's net revenue pledge, we pay the maintenance and operations and maintenance, and then we pay the debt service. So gross, you're paying out of the top line, out of the gross money. And net revenue means you're paying the interest payments out of the net revenue after all the expenses and maintenance are taken out. Net investment income. It's basically so when companies invest, they earn interest and dividends and stuff. So what they're going to do is they're going to get that money, deduct all. Always remember, net means you're deducting your expenses, right? Just think that way. So it's taking the interest and dividend payments it gets from investments, subtracting the taxes and operating expenses and all that stuff, and then that's your net investment income. Net present value. Net present value is net present value is basically the difference between the present value and the market price. So if we have to find present value, we take the future value, use discounted cash flow to find present value, which is like a fair market value right now, or expected price. If the market price is below that, it's a positive NPV and worth investing. If the market price is above it, then it's a negative NPV. Like if I have $1,000 bond in 3 years at 5%, it's going to mature in 3 years at $1,000. Right now, it should be worth a present value of $855 or $860, making up numbers. So that's the present value. If I could actually buy it for less than that, that's a positive NPV. That's a good thing. If I have to pay more than that it's a negative NPV, and I probably wouldn't do it. Net worth. What the hell is net worth? Net worth is what either you or an entity or firm's actual value is. So it's assets minus liabilities. A company's total assets minus total liabilities. On a public company, it's also called shareholders' equity. What's a new issue? A new issue is like an IPO. It's a first time issuance, okay? It's basically the first time we issue either a bond or a stock or whatever it is. It's the first time we issue that, okay? Usually what they call an IPO, and this is going to come with a prospectus. We have to register with the SEC, stuff like that. What's a no-load fund? A no-load fund is a mutual fund that has no front-end or back-end sales charge, and they can charge a 12B1 fee, but it has to be under 25 basis points or under 0.25% of the net asset value. You cannot call C shares or B shares no load. No load is specifically to what it is. Nominal yield is also known as a stated. Nominal yield is stated rate, is the interest rate, is the coupon. Boom. Okay, non-accredited versus accredited. So an accredited investor is a 1, 2, 3 accredited, right? 1 million net worth, or 200 salary, or 300 salary if miserable, I mean married, or they have a Series 7 or a 65 or an 82, right? Those are accredited investors. They can buy on Reg D. A non-accredited investor is not that. Someone who's less than that, who hasn't met the accreditation stuff, and they're very limited on what they can do. They're like the normal retail traders. Okay, so now we have non-contributory. Wow, I can't speak. Non-contributory plan, and then we have contributory. Non-contributory plan is like one where where the employee does not make contributions, only the employer does. That would be like IKEA. Or even like a profit sharing, I guess would be profit sharing will be one too. Non-cumulative preferred. Non-cumulative preferred. Remember, preferred is, if they miss a dividend, they don't actually owe it. So if say I miss a dividend for 3 years in a row on a preferred stock and I never pay it. If it's cumulative, I have to make up all those dividends before I can pay anything else. If it's non-cumulative, screw it, you're out. If I didn't pay that year, I don't owe anything beyond that. So cumulative is better for the customer because it's going to have a lower return because it's more protecting. of the past dividends. Non-cumulative, if I don't pay, you're out of luck. Non-exempt securities. So a non-exempt security, remember, exempt means it doesn't have to register, like a bank, a government, something like that. Non-exempt means it has to register. I always think of non-exempt as like corporate, but they either have to register under the Act of 33 and then follow the Act of 34 stuff. So non-exempt pretty much means corporate without an exception. And remember something, you can only be exempt from two things. You cannot be exempt from risks. You can only be exempt or non-exempt from taxes or registration. So non-exempt security is one that has to register. An exempt security does not have to register. It might be exempt from taxes. Who knows? Okay, a non-issuer transaction. So a non-issuer transaction is between like you and me. So if you buy shares of Ford stock, right? Okay. If you buy shares of Ford, okay, then you're not buying it from Henry Ford or the company. You're buying it from like John or Mary or Bobby or Sue, right? Horrible names. But you're buying it from someone else. That's a non-issuer transaction. A non-issuer transaction is a secondary market trade. It is a secondary trade between two investors. An issuer transaction is when you buy it from the actual company and the actual company gets money out of that, okay? So that could be an IPO, that could be a follow-on, additional, anything where a company is issuing shares and you're paying them. So like when you buy into a mutual fund, you're buying it from the mutual fund and that's an issuer transaction. When the mutual fund makes trades in its portfolio, that's a non-issuer transaction, okay? So when a mutual fund makes their own trades, it's a non-issuer transaction. When you buy from when you buy from a mutual fund or a company like in an IPO, you're absolutely buying an issuer transaction because they're getting the money. Okay, non-marginable, pretty much shit that's not on NASDAQ, but let's go down the list. Over-the-counter, bulletin board, and pink sheets are normally not marginable. Options with 9 months or less maturities are not marginable, and IPOs are not marginable for the first 30 days. That's why when you buy a mutual fund, you can't buy it on margin, but once it's traded for 30 days, then you can borrow against it. Non-NASDAQ security means it's not trading on NASDAQ. It's an over-the-counter equity, okay? A non-NASDAQ security means it's an equity security that's not traded on NASDAQ. So it's an over-the-counter, which means pretty much pink sheet or bulletin board, if even bulletin board is a thing anymore. Non-qualified annuity, a non-qualified annuity or non-qualified retirement plan. I should just do it that way. A non-qualified retirement plan means it's not sponsored by a corporation for the most part. More importantly, it's not protected by ERISA, so you don't get the same protections as an ERISA qualified plan. And remember, most contributions to non-qualified plans are not deductible, which means you're paying taxes on them. But the good thing is then once you're older, say you put in 20 grand and it goes to 500 grand, we pay tax on the 480. We don't pay tax on the 20 you put in. That's a non-qualified plan, not protected under ERISA. Remember, these are high-level stuff. I have videos where I go a deep dive on all this shit. So pay attention. Non-qualified stock option plan. It's basically a stock option plan when it's non-qualified, and the difference between the market price and the strike price is taxable. That's the thing. So the whole point of a non-qualified stock option plan is that you can pay taxes on it. And they will talk about this stuff on the exams now. Non-recourse loans means you put money in, you borrow, but you do not owe any of the money if the partnership fails. But if a recourse loan means they have recourse against you, that means if the partnership fails, you can be liable for the money you borrowed. Like they may be gone, but you still owe the money. Kind of like a student loan. Non-systematic risk, okay? Non-systematic risk is like business risk, okay? Systematic risk is market risk, right? You can't diversify that away. You can buy options to hedge it, but you can't diversify it away. Non-systematic risk is like business risk. You can diversify that by buying mutual funds, ETFs, having a bigger portfolio, using modern portfolio theory to diversify that risk away. You can diversify a non-systematic risk, business risk, but you cannot diversify away systematic risk. Okay, we have a normal yield curve and an inverted yield curve. A normal yield curve, I've done videos on this, so I'll try to link it here. But a normal yield curve looks like this, right? Short yields, lower rates, the longer, right? So these are the years, this is the yields, right? It could be either way. Maybe this is the yields, this is the years, I don't know, but it doesn't matter. The shorter you borrow, the lower the rate. That's a normal yield curve. But what's going on now, like when the Fed starts raising rates, they start raising the rates. So all of a sudden, boom, now you have an inverted yield curve where the shorter term, you're paying a higher rate on shorter term stuff, which is not normal. So normal, can't use that word, right? But normal is like what we expect You borrow money for a longer time, you pay higher rates. You borrow money for shorter time, you pay lower rates. In an inverted, usually a sign of a recession or the Fed raising rates or tightening, the shorter rate is going to be higher than the longer rate, which is just not normal. That's inverted. Note usually means short term. It could be under a year, but usually just means a shorter term. Like treasury notes are 2 to 10 years. Muni notes are like under 2 kind of thing. So notes are always pretty much the shorter term bonds. Okay. Not held order. Basically, a not held order is when you give your broker discretion, not like the full power of attorney discretion, but the ability to choose the time and price, meaning you can give them an order to buy 1,000 shares not held, and they can decide any point in the day to buy the shares when they think it's right. That's a not held order. You do not need written power of attorney for that. Notice of sale. A notice of sale is when a municipal issuer puts a notice in the bond buyer to say, hey, we're issuing a bond. We want the issuers to bid on it. Now, that's not to be confused with notice filing. Notice filing is when, like a federal covered security, like whether it's a federal covered IA or certain federal covered securities, they just file notice in the state to let the state know they're there. They provide the documents that the SEC requires. So they give those documents to the states, but the states don't really have jurisdiction. It's just a record keeping thing to say, hey, we're here, whatever. Okay, that's the end. Now it's time for O's. Like, oh my God, I can't believe we're still doing this. That it's, oh my God, it's still so long. Like, oh my Lanta. Okay, so let's get into the O's. Okay, what's an odd lot? Odd lot. Odd lot is an amount less than 100 shares. So a round lot is 100 shares or more. An odd lot is between 1 and 99 shares. And usually odd lots don't show up on the tape or even in the bid and offer on the book or anything. They're just what usually retail people use. And that's why we lead into odd lot theory. Odd lot theory is the theory that retail people are idiots. Normal people buy less than 100 shares at a time. Institutions buy 100, 200, 500, 1,000, 20,000, whatever. Retail people buy odd lots, and retail people are idiots. So we figure if there's a lot of odd lot buying, then it's probably a bearish, because the idea is that they're always wrong, right? They're late to the game. So if they're a bunch of buying, it's too late. So you probably should start selling. If there are a lot of people selling, maybe it's time to buy. That's odd lot theory. Okay, an offer. An offer is, so it depends. If it's under NASA, there's offer and sale. So an offer is the attempt. Okay, I guess it's sort of the same. An offer is the attempt. The sale is the transaction. But another way is an offer on the NASDAQ or FINRA trading side. There's bids and offers, right? Bid is where people want to buy. Offers or ask is where people want to sell. So it works on two things. An offer is the attempt to make a sale. The sale is the actual transaction. Or two is the offer is the I want a price that I want to sell it at, an offer or an ask. An offering circular. An offering circular is like a disclosure doc, a little mini prospectus, usually for a Regulation A offering. Not every Reg A needs to do it, but if they have to, then it's offering circular, not a prospectus. The Office of Supervisory Jurisdiction, that is a broker-dealer's main branch. They can have more than one, but it's where all the compliance, all the approval of new accounts, trading, market making, supervision, all that stuff. So the way it goes is there's the main office, blah, blah, blah. There's OSJs, which are they're supervising the other branches, where they can do all the trading, the market making, the compliance, the investment banking, all that stuff. And then below that is the branch office, where you can just do sales. The OSJ looks over the branch. And an OSJ is a firm. A lot of places you work at, they go, oh, he's the OSJ. No, that just means he or she is the manager of the OSJ. The OSJ is actually the office where they supervise the branches and other OSJs, maybe. Okay, open-end mutual fund, open-end investment company is a mutual fund, right? An open-end investment company is a mutual fund. Closed-end is a closed-end. Open-end is a mutual fund. Okay. Opening purchase and opening sale is when you either buy or sell options for the first time. So an opening purchase is when you buy options for the first time. So if you buy a call or buy a put for the first time, that's an opening purchase followed by a closing sale. If you short a call or write a call for the first time, that's an opening sale, which is followed by a closing purchase. Okay. Open market operations. Open market operations is when the Federal Reserve, under the FOMC, the Federal Open Market Committee, is buying and selling treasuries from the banks to either increase the economy, the money in the economy, or decrease it. So during expansion, they're going to sell treasuries to take money away from the banks. And during contraction, or when they need to inject money, accommodating, or QA, they're going to be buying treasuries to put money into the banks. An omitting prospectus is a type of mutual fund advertising. So what happens is, if I'm a mutual fund, I can send a prospectus or I can send an omitting prospectus, which is a slimmed down version. It has all the material information, but not everything you need in there. It cannot be associated with an application to invest. If you want to invest, you're going to have to get an actual statutory prospectus at some point. Open-end bond indenture. Okay, the open-end and closed-end. So open-end is where if I issue bonds now, you have a certain level of priority. If open-end means I can issue more bonds after that have the same level of priority as you do for my assets. That's an open-end, and that you don't want that. A closed-end means I issue these bonds, and then any more issues or any more bonds I issue, stretch that, reverse it, they're going to have lesser priority, which means you get first shot at the money. If I have to pay or get bankrupt, you'll get paid first, and then the other ones would be like junior to. They'd be like subordinate to you. You want a closed-end indenture, because then if you buy a bond from me and I issue the bond based on my earnings and all that, you feel safe to go, look, I know this is how many bonds are being issued based on the earnings. I think they can pay. And then if I do a closed end, that means even if I issue more bonds, they get paid after you as opposed to with you. But if it's an open end, they come on and they have just as much a claim to my assets and earnings as you do, which kind of dilutes your leverage, I guess, credit. Open order. An open order is basically slang for good till cancel. If they say it's an open order, that's how we call it. It's an open order. It's an open order. It's a good till cancel. Operating income is basically the income, the net sales minus the cost of goods sold and all that stuff. So operating income is our sales minus all the expenses, depreciation, cost of goods, costs, and stuff like that. It's going to be on the income statement. Operating income, obvious income, is on the income statement. Options. Options are derivatives. That means their value is based on another asset. So you can have index options, equity options, but specifically equity options. If you buy a call, you have the right to buy stock at a price. If you buy a put, you have the right to sell stock at a certain price. And if you sell those options, you gave that right to someone else. Not going to get into this high level stuff. The Options Clearing Corp is the organization that kind of supervises the options and guarantees performance. That doesn't mean they're guaranteeing making money. They guarantee that if you buy a call and I sell it to you and I disappear, and you exercise and I disappear, then they will guarantee that you get to buy your stock, and then they will chase me down. Okay. Optimal portfolio. What's that? Under modern portfolio theory, it's trying to find the most amount of reward with a given level of risk. Again, the highest reward with a given level of risk. Ordinary income. Ordinary income is basically not capital gains. There's two types of income, really. I mean, there's passive too, but there's capital gains, which is that whole buy and sell, option expiration, or mutual fund distribution of capital gains, or everything else is ordinary income, which is taxed at your normal rate. Like look at your paycheck, whatever you bring home from your paycheck, that's how it's being taxed. OTC market, over-the-counter market, is the trading system where it's broker-dealers dealing with broker-dealers directly, not on an auction exchange. So it's basically JP Morgan buying right from Morgan Stanley or from Options Disclosure Doc, the ODD. An option disclosure doc is what you remember, the DATO 15 that I created, DATO 15, disclosure, then approval, then trade, then options agreement, 15 days later. ODD is the disclosure doc that you have to hand someone before they can open an account. They get the disclosure doc telling them how dangerous options are. Then it gets approved by the ROP, the principal. OID, original issue discount, literally a zero coupon. It's issued below par. And remember, OID, you must accrete. OID, you must accrete. Outstanding shares. That's how many shares are out there in trading, okay? So it's issued minus treasury equals outstanding. Authorized doesn't matter. Authorized is just authorized, okay? That's what we're authorized to issue. Then we can issue a certain amount of them. And then if we buy some back in treasury, what's left is outstanding. So when we issue stock, if we issue 1 million shares, we have 1 million outstanding. If we buy back 100,000 of it, we now have 900,000 outstanding, and in the not 100 in treasury. Now remember, treasury stock, once it's issued, it's always been issued, but it's kind of been issued and bought back. Okay. Overbought. Overbought is a technical trading term. Like if it gets near the resistance, it's thought to be bought too much, so it's probably going to come down. Again, that's a technical. Kind of like oversold is the other. When it's too low, we think it's going to go up. I always think of that Greek. Like I always think of the guy Icarus who flew too close. He was told not to fly too close to the water because it would get wet, or too high. So you want to stay in the middle. Overbought, too high. Oversold, too low. And by the way, oversold would be near support, overbought would be near resistance. That helps. Overlapping debt. Remember, this is 100% not in alphabetical order because I'm trying to come up with words. Overlapping debt, normal geo bonds. If I issue a geo bond in my town of Chatham, it has to say inside the town, but we actually have a high school that uses Chatham Township and Chatham Borough. So our taxes actually leave the town, and that's overlapping. So like a county park system, a regional high school, a county library, where more than one town feeds into this project, that's overlapping or coterminous debt. Over the counter reporting facility, ORF. So when you do a trade on NASDAQ, you use TRF, trade reporting facility, to report the trade to ACT. If it's over the counter, you can use ORF, over the counter reporting facility, because we're idiots. We have to do it that way. And it still goes to ACT. It's like the same thing, but one's for ORF is for over the counter reporting, TRF is for NASDAQ. Oversubscribed. Okay. Oversubscribed is actually a good thing. That's what you want. An oversubscribed offering means it's like, say we issue 1 million shares and there's like 1.2 million offered. I mean, wanted. Okay. So if we have 1 million shares issued and we haven't sold them out yet, and all of a sudden there's over 1 million people who want the shares, that's oversubscribed. So the demand is greater than supply, which is a good thing. And that's why sometimes they have the green shoe clause where you can issue an extra 15% to accommodate some of that demand. Okay, that's the O's, baby. O. Okay. Okay, we're going to start with the letter P and then go to letter Q. Q is not very long. Speaking of P, I'll be right back. Okay, I'm back. We're going to do letter P and we're going to do Q. Mind your P's and Q's, okay? Q is not very long. P is kind of a long one. It's a long P. I don't know. There's a joke in there somewhere. I have no idea. Okay, I'm Ken Finnan, and I'm from Capital Advantage Tutoring, and it's my job to get you past all these licensing exams. The Series 7, the Series 6, all that stuff, and the 65 and the 66, just a mishmash of fucking words. Okay, let's get into it, and let's start on letter P. Okay, we're going to start with painting the tape. What is painting the tape? Painting. It's slapping trades on the tape to make it look like there's more trades. It's illegal. It's manipulation. It's an illegal manipulation of the market. So you're putting trades on the tape to make it look like there's more trades or more activity than there is. Okay. Paid in surplus. Paid in surplus is when you issue shares for the first time, it's the amount above par. So par, we'll get to, par on a common stock is $1. So if you sell the stock for, if you issue the shares for $20 a share, that's going to be $19 of paid in surplus or capital surplus. Okay. A paper profit or loss is an unrealized gain or loss. It's just on paper. We're not actually gaining or getting or losing anything. It's just on paper we win or lose. And that's what some people are trying to tax that, which would be impossible because what if it becomes a loss later and you already taxed it? Crazy shit. Okay. So par is like the face value, principal stated value. So in reality, the best way to think of it this way is par on a common stock is $1. It's an accounting tool. That's all it is. Par on a preferred is 100 normally, could be 25. It's whatever the company sets it as. And when you do the percentage, when you figure out how much they're getting paid, it's going to be percentage of par, which is 100 on a preferred or 1,000 on a bond for the most part. They can change the par on a preferred to 25 or 50 or 10 or whatever they want. It can be any one of those things. So if you buy a 5% bond, a 5% preferred, it's going to be 5% of whatever par is. So if it's 100, it's $5. If it's $25 par and it's a 5%, it's going to pay you $1.25 a year. So par is really just an accounting tool. It's what they use to measure the value of the security, not the market value, just the accounting value. Parity is the price, the market price where converted shares, once you total up the value, is equal to the convertible bond market price. That's parity. If it's above parity, then it's probably worth converting. If it's lower, then it's not. Participating preferred. Love this. Participating preferred is that if we have a normal preferred, it pays you 5% a year. If it's participating and we have a really good year, they'll actually increase the dividend for that one dividend, not it's forever. So say we have written in the indenture, not the indenture, in the prospectus, and the participating preferred, that if our earnings are over $5 a share, we give an extra 1% for that quarter. So what happens is if I'm normally a 5% preferred and we hit that target, you'll get 6% that one dividend, and then it'll go back unless we keep hitting the targets. So participating preferred means that they will bump up your preferred coupon for that period, for that one time, based on increased earnings of the company. What's a partnership? A partnership is a business organization where at least two people, okay, don't confuse limited partnership and general partnership. They're versions of this, but a partnership is where more than one person, two or more people manage a business and they're all totally liable. So if it's a regular partnership, usually if they say partnership, they mean general partnership, which means everyone's liable, as opposed to a limited partnership, which is the L's, where there's one limited partner who doesn't have risk beyond their investment, and then the general partner who has unlimited risk or personal risk. A partnership account is an account for a partnership. It's not two people, it's for a partnership. So what I just talked about, a partnership account is an individual account, but it's for a corporation. So it's the point I'm saying individual, it's not a joint account. It's not two people. It's the account for the partnership. And you have to have certain documents, the partnership agreement and all that stuff, plus a list of authorized individuals, the ones who can place trades and talk about the company, talk about the account. Pass-through securities, pass-through certificates. Pass-through securities. Those are like mortgage-backed securities where we create a security and all the income coming in, like from the mortgage payments, if it's a mortgage-backed security, all the people paying the mortgages goes into the entity and it passes through to the investors. That's why it's called a pass-through. They take a little bit of a fee, but the money comes into the account and then it passes through to the investors. That's why it's called a pass-through security. And most of them have prepayment risk and all that. And what they're passing through is all the dividend, not the dividend. What they're passing through is all the interest and principal payments. That's what you're getting. Passive income. It's a type of income that is from investing in limited partnerships or DPPs where it's passive. You can use you're going to pay taxes on passive income, but any kind of passive losses, okay? So a passive loss can only be used against other passive gains. So if you have a loss or a write-off on a limited partnership or a DPP or a direct investment in real estate, all passive, those passive losses can only be used to offset passive gains. They can be not used to offset your ordinary income. Passive management is when you're not trying to beat the market. You're mostly just rebalancing. You think the market is efficient. You're not trying to beat the market. You're just buying it and not so much a buy and hold. But what you're doing is you're only going to rebalance. If you see the word rebalancing passive, every quarter or every time period, you're going to rebalance the portfolio to bring it back to the original percentages that you planned. You're not trying to take advantage of the markets or trying to find inefficiencies. You believe that the market is efficient, which means the price is right, that you're just going to buy a market index of stocks and holding it, and you're not going to really change it unless something gets out of percentage. Not because you think the market's changing, just because you had set percentages and you want to bring them back to those numbers. So if you see the word rebalancing, usually that goes with passive or indexing or benchmarking. A pattern day trader is someone who does day trades. What's a day trade? A day trade is when you buy and sell a security in the same day, a day trade. If you do 4 round trips, day trades, in a 5-day period, you're named as a pattern day trader and your margin requirements go up to $25,000 minimum. You can do 4-to-1 leverage. There's other things, but that's what a pattern day trader is. Someone who has done 4 round trips in a 5-day period. The broker dealer automatically does it. Your leverage goes up, but also does your minimum equity if you want to use margin. Okay, payable date or payment date. That's the day that the dividend actually gets paid. So you remember DERP, declaration X date, record payable. Payable is the date after the record date when they actually just send the check. PE ratio. PE ratio is, again, we're idiots, right? So it has to be in the thing. PE ratio is a price to earnings ratio. So that's market price divided by the earnings per share. Market price divided by the earnings per share. They also call it the multiple. So if you see a high multiple, high PE, it's usually a growth stock, doesn't usually pay dividends. It's very volatile, more volatile. And then if you see a very low PE and they pay dividends, it's more of a value stock, undervalued, out of favor, stuff like that. Okay. Payment for order flow is when an introducing broker-dealer, a small broker-dealer, sends orders to an executing broker-dealer, and the executing broker-dealer rewards them for sending the order. They give them a little piece of the business. That's a payment for order flow. And the big thing is Robinhood got in trouble for this because they didn't disclose it properly. Okay, so now let me go back a little bit. Payable date is the day the dividend gets paid. But let's talk about payment date. That could also be considered when the dividend's paid, but also under Reg T, payment date is when the customer has to pay for the shares, and that's usually T+4, S+2, 7+2, or T+4. That's when the customer has to pay for it. So wait a second, guys, wait. Settlement is T+2. That's when the broker-dealers settle. You have actually 4 days to pay. Okay. Payout option. Payout means like when an annuity or anything's paying out. But in this case, a payout option is when like an annuity is paying out, annuitizing, you're going to get paid out. I'm saying the same word over and over again. So you can choose like straight life, which means it'll stop paying when you die. You can do joint and last survivor, which stops paying when the second person dies, or life with period certain. It pays for life, but no less than a certain period. Okay. That's the payout option, the payout period, and the choice is on a variable annuity. Okay. Pegging. Do not Google this. Please do not Google this. You will be scarred for life. Pegging, do not Google it. But in our world, it's manipulation of you're trying to manipulate the price by keeping it you're pegging it to a price. You're trying to push it up or push it down to have it close at a specific price. It is illegal manipulation of a price. Pegging is bad. Don't Google it, please. Peak. I peaked in high school. No. Peak is basically if you have expansion, then before contraction, you hit the peak of the mountain, right? So peak is it's going up here, kind of like where the inflation is starting to slow down a little bit of disinflation. The GDP isn't rising as much during an expanding economy. So it's going up, but it's slowing down. It's going to head down the peak of the mountain. Boom. Okay. Okay. In case you ever have to, oh my God, I can't even say it. Pecuniary is relating to money. Boom. A penalty bid. A penalty bid is so when I'm an underwriter, I'm the lead underwriter, and I'm doing what they call a syndicate bid, or I issue the shares. I have all my syndicate players allocate shares to their customers, and I'm buying shares to hold it up. That's a syndicate or a stabilizing bid. I'm allowed to do that. It's like manipulation that's allowed. But you're supposed to, as the members of my syndicate, you're supposed to sell your shares or allocate your shares to investors, not flippers, people who just sell it on the opening. So if I find out a lot of your shares are being resold immediately in the opening, I can enact a penalty bid where I start penalizing you by taking away your profit. So for every share that I buy from your customers, it's coming out of your profit, not mine. A pension plan. That's your qualified retirement account. Usually it's where the company puts money in, and then when you retire, they pay you. Like my grandfather, he worked for Kohler. He got paid until he died. He actually, till his wife died. They got paid every month, 800, 1,000, whatever it was a month. Every month for that. Okay. So they got paid a pension. Okay. But a pension plan has changed a little bit. For the most part, it is a contract between an individual and an entity, either a corporation or government, where they will pay you after you retire. It's a retirement plan. Penny stocks. Penny stocks are, according to the SEC, are non-NASDAQ, which means over-the-counter securities trading under $5 a share. So remember, they're very speculative, very risky. There's a lot of rules around it. If it's under $5 and not on an exchange, it has to be both. So if it's under $5 and on an exchange, then it's not a penny stock. I mean, it could be, but let's go with on this test. No. So it has to be under $5 and non-NASDAQ, which means it's not trading on an exchange. It's over the counter. Personal property, basically it's non-real estate. So any kind of property you have that's not real estate. So like personal property is like, if you have, furniture and stuff like that. Performance-based fee. That's when an IA will charge a fee based on how the fund, how your account does. Okay. So performance-based fee is normally disallowed. I mean, it's disallowed unless the administrator allows it. They all do, but it's disallowed unless the administrator allows it. So you can charge a performance-based fee. It's like if they do better, you get a piece of that. Not only can you get an percentage of the assets under management, you can get a percentage of their profits. Now, a couple of things, capital gains, if you want to call it. On the state level, if you're going to do this as an IA, they have to be a qualified customer, which means they have to have at least 1.1 million assets under management with you, or 2.2 net worth. That would be a qualified customer. What's a person? Okay. So a person is any kind of entity, individual that can sign a contract. It's easier to know what is in it. So think any fund, organization, unincorporated trust, government, political subdivision, anything. We're persons too, but we're natural persons. We're a firm, even a partnership, but unincorporated anything is a legal person. But it's easier to remember what is in it. Remember, so if it's a dead individual is not a person, an incapacitated, like mentally challenged, is not mentally incapacitated, or under 18. So I remember the way I remember what's not a person as I go dead, dumb, don't touch. Personal income. It's an individual's total earnings from wages, bonuses, and all kinds of investments. Okay. Phantom income. Okay. Phantom income is like if you have a zero coupon and you have to accrete, you're going to pay taxes on that amount, even though you're not getting it. So phantom income is like you're paying taxes on money you're not getting. So if I buy an OID for like $600 and it's 10 years to maturity, well, it's $40. I'm accreting. You have to do the math on this. I'm accreting $40 a year for 10 years. Every year they're increasing my cost basis by 40. I owe taxes on that unless it's a muni. So I'm paying taxes on shit I'm not seeing. So that's called phantom income. Placement ratio. This is so boring, but it's fine. Placement ratio is basically in the bond buyer. It's all the bonds placed, sold, allocated to customers versus how many they issued. Okay. And it's based on par value. It's not on dollar. It's not on the number of bonds. It's on the dollar amount of bonds. Always remember that. Whenever they count bonds, they don't say, 4 bonds. They say $4,000 worth of bonds. They always do bonds based on dollar amount. So the placement ratio is how many of these bonds that we issue have we actually allocated to customers. A planned amortization class, a PAC. It's a CMO tranche. It's based on a CMO. You add these companion tranches to it, and it makes a PAC, a planned amortization class. What you need to know is that it protects against both prepayment risk and extension risk. Prepayment risk and extension risk. It protects both. So you have a much more consistent payout level. Your income from this would be much more consistent than if you had something else like a TAC. A TAC protects against only prepayment risk and not extension. Okay, if you hear the word point, on stocks, it means $1. On bonds, it means 10. So I would go like this. 100 basis points equals $10 equals 1% equals 1 point. 100 basis points equals $10 equals 1%, which equals 1 point. Political risk. Anytime you invest pretty much outside the US, you have a risk of that. That there's going to be upheaval or something like that. Look, the main Western countries in ours, if you go from Democrat to Republican or, a Whig party to something else, that's not really political risk. It's like there's going to be upheaval like what happened in Greece and Argentina and stuff like that. Maybe Venezuela. I don't know. I always forget the two. But when Cuba, that's the best one. When Castro nationalized all the products, all the stuff that we had, all the oil companies and everything in there were taken over by the national government and it's gone. That's political risk. So if you invest outside the country, always look for political risk or currency or exchange risk. Okay. POP, public offering price. That's the price we offer it to the public, or when you buy a mutual fund, that's the price you pay. That's NAV plus a sales charge, calculated one time a day. So public offering price could be one for a new issue. Okay. For a new issue, I'm probably going to talk about later. A new issue, that's the price we offer it to the public. But on a mutual fund, it's NAV plus a sales charge equals the POP. Portfolio, it's just a group of securities that you're holding. That's all. Portfolio-based margin. It's like instead of having regular Reg T, and this is only for like the high-end companies, right? High-end people that have a lot of money, high-end net worth stuff. Your margin is based on the risk. They do a calculation based on the risk of your whole portfolio to determine your margin. So hopefully you won't have to put as much down. So you have to have a big, I think it's over $500,000, something like that. If you have a big account, maybe it's 5 million. Who the hell knows? Numbers don't matter. You're using margin instead of having to put 50% all the time. They look at your portfolio and determine the net risk of all the stocks and bonds together, and then they come up with a margin. And it's usually going to be less than the 50%. So it does let you do leverage up a little bit more because you're taking less risk. Portfolio income is income generated from dividends, interest, and capital gains. It's also called investment income. Portfolio income is income from dividends, interest, and capital gains. Okay. I do this all the time. Position limits. So what are position limits? Position limits are the total number of options you can have on the same side of the market, which means bulls with bulls, bears with bears, at any one time. So like some of the bigger companies, the max is like 175,000 contracts. So if you have 165,000, if you're long 165,000 calls, well, we're going to pair it up with the other bullish options selling puts. So if you have 165,000 calls, you can probably only sell 10,000 contracts of puts because they're bull. We match up the bulls with the bulls and the bears with the bears. Also, since we're on this, there's a thing called exercise limits. That's the most amount of options on a single side that you can exercise in any 5-day period. A portfolio manager is either the IA or somebody who is managing a mutual fund or a portfolio. Makes sense. Usually it's an IA managing a mutual fund. I think it has to be an IA managing a mutual fund. But the point is, a portfolio manager is the entity or the firm, or I guess it's an individual that is managing a portfolio. A positive yield curve. I think I did the other one. A positive yield curve is, I think I've done this, where you have, here's the interest rates, here's the years. It's a positive, means it goes from lower, the shorter terms have lower yields, to the longer terms, longer maturities have higher yields. That's a positive sloping yield curve. Okay, power of attorney. There's limited and full. Power of attorney has to be in writing for broker dealers at least. IAs can get up to 10 days of verbal power of attorney, then they have to get it. But power of attorney lets the registered rep select either the buy, sell, the amount, or the shares. Asset, action, and I don't know what the other one, amount. If you're the rep, choose either the buy, sell, or the amount, or the security, you have to have power of attorney in hand in writing, broker dealer side. Now, limited power of attorney means you can do any suitable trade, but you can't pay bills, you can't touch the money. Full power of attorney means you can do any suitable trade, plus you can pay bills and remove money, withdraw money, stuff like that. But all of them end once you're considered incapacitated or a coma, it ends, or if you die, or if you revoke it. Durable power of attorney still ends at death, but if you're considered incapacitated or in a coma, it'll still work. Now, there's one that shows up that may not be on here called springing power of attorney. I've done a couple of videos on this. Springing power of attorney means if I'm normal now, but I'm worried that if I get into dementia, incapacitated, I want somebody to watch my account. So I'll name my daughter on the account. She does not have access now, but once I'm considered incapacitated or mentally challenged, whatever it is, then the power of attorney kicks in. So it springs in the future. Preemptive right. That's a right of common shareholders to maintain their percentage ownership. So if the company if you own shares of a company and they issue more shares, the preemptive right will allow you to maintain your percentage ownership. And the thing is, they're very short term. Now, to maintain it, you still have to buy shares, but they allow you to buy shares less than where it's trading at a discount. And it's only good for like 25, 30, maybe 40 days. You get it for free. If you do get it, you can let it expire. Moronic, but you can. You can sell it or trade it. Same thing. You can give it as a gift, or you can exercise it, which means buy more shares. Preferred stock is a type of equity. It is a type of equity that has a fixed dividend. It is preferred because it gets paid before the common in every way. Whether it's a liquidation or just paying out dividends, you cannot pay the common unless the preferred is paid. So it comes ahead of you, okay? It has usually a par value of 100 or maybe 25. It pays a fixed dividend. Remember, dividends are not guaranteed, so they can go, screw it, we're not paying you. But if it's going to get paid, they have to get paid before the common does, okay? It's not income. It's a fixed income, but it's not a debt. Remember that. It is equity, but it is considered fixed income. It has literally all the same risks as bonds. Interest rate risk, inflation risk, call risk, reinvestment risk, all that stuff. Couple of things about preferred real quick. They usually, big one is they don't have voting rights. Normally, they don't have voting rights. That's a big one. And they don't participate in stock splits and stuff. They just don't, because it's only for common. A preliminary prospectus, also known as a red herring. Red herring is a preliminary prospectus that's a disclosure doc that's kicked out, distributed to all the customers or potential customers, because you can't buy anything, during the registration period, that 20-day cooling off period. It does not have the final date or final price on it. It really can't. It has almost everything else that the statutory prospectus does, but it is not considered an offer for sale. It'll actually stay on the sideline. This is a preliminary prospectus. This is not an offer for sale. Only sales can be made through a prospectus, which is a disclosure doc. I'll talk about it now. A regular prospectus, a statutory or final, is the one that's done after the stock has been declared effective, and you have to send that to everyone no later than confirmation or completion of the trade, which is really T+2. That's a disclosure doc. You can send these things an email or a link. As long as a paper copy is available, you can send them a link or a PDF of the prospectus. Okay, premium. Couple things here. Premium is the amount. The premium is the amount that a bond is trading above par. That's that. So that's the first one. It's the amount that the bond's market price is above par. So if it's at 104, it's a $40 premium. The other premium is the cost of an options contract. When you buy a 50 call at 4, the $4 of premium, it's what you paid for the contract. Now it's really 4 times 100, $400, but premium is what you pay for an option contract or receive when you sell one, or it's the amount above par on a bond. Prepayment risk. If you have a mortgage-backed security, the risk is that if rates drop, people will refinance their mortgages and you'll get your money back sooner than expected, and you don't want that. So prepayment risk is a risk that if rates drop, the mortgage-backed security would be paid off early, and you'll get your money back sooner than you wanted to. That goes along with extension risk, is that rates go up and people don't refinance like now, so you're stuck in this mortgage-backed security that's not paying so great. Pre-refunded advance, so pre-refunded, advance refunding, defeasing the debt, escrow to maturity, all mean the same thing. I just did a video on this, depending when you're watching this. It's what happens is it's not the same as refunding. Refunding is just buying the bond, issuing a new bond and buying it back. Pre-refunding is I have a $10,000 bond paying 5%, rates drop to 3. I would like to issue a new 3% bond instead of paying the 5. But since it's not callable or not callable yet, I can't pay it off. So I'm going to issue the bond anyway at the lower rate, take the $10,000 from issuing that bond and put it in an escrow account and buy treasuries. I will buy enough treasuries that they will kick off enough interest that it'll pay my old bond. So if I have issued a $10,000 bond at 5%, I'm paying $500 a year. I will buy $10,000 worth of 5% treasuries, and as it pays, it'll pay off the old bond. I have a much better video on that, but that's a pre-refunded, advance refunding, defeasing the debt. Present value. So we need to know future value. So if you have a future value, present value is what you need to invest now to get based on a certain interest rate to get to that number. It's the expected price. So if you have a 0 coupon for 1,000, the present value is what we expected to be trading at now. But the literal definition is the amount of money that you need to invest now at a given rate to get to future value. A pre-sale order is when you're buying munis when somebody's buying munis, or a firm is buying munis at an auction. So what happens is a notice to sell comes out, the issuer will say, hey, we're issuing a bond. All the different underwriting syndicates will bid on the issue. And during that time, if you place an order with one of the syndicates, even before they've won the deal, you get priority. That's called a pre-sale order. A price spread or a vertical is when you have a spread and the strikes are different, the months are not. So that's a vertical spread. So no, horizontal is when the months are different and the strikes are the same. And a diagonal is with both the months and the strikes are different. So again, a price spread or vertical spread is a spread, buy a call, sell a call, where the strikes are different, not the months. A primary dealer is a dealer who basically deals with the Federal Reserve. I keep saying who trades government securities with the Federal Reserve. They are a primary dealer. A primary distribution is when an issuer sells shares or bonds, whatever it is, and they receive the money. So that's a primary, as opposed to a secondary, which is when one of the investors, one of the shareholders gets the money, okay, or even a secondary market trade. Primary, also even a first, second, third, fourth. If the company is getting the money, the proceeds from the sale of the bonds or the shares, that's a primary offering. Primary market is where new issues are sold. That's literally what it is. The primary market is where new issues are sold and underwriting. Secondary market is where shit trades. The prime rate, what's the prime rate? It's the rate. It's like of all the rates we know, it's, PBDF, Pretty Boys Drive Ferraris, right? The prime rate, it goes prime rate, then broker loan, then discount, then Fed funds. But prime rate is the rate that the banks lend to their best customers, okay? Now, if I wanted to borrow money from a bank, they go, ooh, Ken, here's prime plus 4. So prime rate's 5%, I'd have to pay 9. But prime rate is like their base rate that the banks lend to their best customers. Prime brokerage, I've done videos on this, but a prime broker is a big broker dealer that does all the margin, all the holding the securities and deliver and all that stuff for sophisticated clients, like mostly for hedge funds and stuff. So a hedge fund will have billions of dollars. They will hold it at a prime broker, and when they do trades with various broker dealers, other than the prime broker will send the shares or the money to those broker dealers to settle the trade. Basically, they're holding the securities and the money for the customer and facilitating trades for them. They have a minimum net cap of 1.5 billion, no 1.5 million. Principal, the guy I saw every morning at school. Okay, so now the principal transaction is when you use your own inventory. When a broker dealer uses their own inventory or their own money to buy and sell shares to facilitate trades, that's a principal trade. Also, a principal is a supervisor at a broker-dealer. Again, back to this, a principal transaction, same thing, is where the broker-dealer uses their own inventory to buy or sell to facilitate a trade. And they usually charge, if you see principal, you think dealer, you think markup, markdown. PDM, baby, PDM. Private placement is like a Reg D. Private placement is where you sell to just usually accredited investors and a small amount of unaccredited investors. You don't have to, it's an exemption from the registering with the Act of 33, but there's rules like you have to hold it for 6 months fully paid, unless you sell to a quib, and then you can do less. But the point is, private placements are not going through the normal public. They still have to have an offering circular, an offering memorandum, private placement memorandum, whatever you want to call it, but they're not registering to the Act of 33, so you can only sell to certain types of investors, pretty much accredited, and again, up to a small 35, maybe up to 35 non-accredited. Since we're selling it to sophisticated people, they're allowing us not to have to go through the Act of 33. Okay, a private securities transaction is when you work for a firm, like a broker-dealer, and you do trades either in your own brokerage account, or you act as a registrar for like a friend of yours. Like if a friend of yours comes up to you and says, hey, I'm doing this new app, I want you to raise money for me, I'll pay a commission, that would be considered a private securities transaction. If you did it without permission, it's called selling away. If you did it with permission, it's called a private securities transaction. A proceeds transaction is when you say, okay, I call you up and say, hey, John, go sell my IBM and then use that money to buy GE. You're doing it in one transaction. Okay. Profit sharing plan is a employer contribution plan. For the most part, employees don't contribute, but based on certain profits or certain numbers, they can put what they want in there. A lot of times even if you don't make profit, they can put money in, but the company puts money in and they're not beholden to putting a certain amount of money in at any time. It's based on profits and stuff like that. A progressive tax means the more you make, the more they take. That's why I've done the videos with the tax brackets. Like the first 11 grand, the first 18 grand you earn is taxed at a certain rate. 18 to 82 is taxed at another rate. 82 and up is taxed at a different rate. So the more you make, the more they take, as opposed to regressive, which is like a sales tax, so it hurts the poor people more. Proxy is like when you let someone else vote your shares for you. So it's a limited power of attorney. If you can't get to a shareholder meeting, you're going to let somebody else vote in your stead. A proxy statement is when the broker-dealer sends you the information so you can make your own decision, and then you can decide whether you're going to let somebody else make your vote for you. A protective call is when you're short shares, you buy a call to protect it. A protective put is when you're long shares, you buy a put to protect that. The prudent man rule is a standard of investing. They used to have these legal lists where every state had a list of securities that you could buy for these custodian or guardian accounts. So now they use the prudent man rule, which is like, what would a prudent man do? It's basically using common sense to decide, which also means that any security that you think is suitable, you can put in an account. Like there's no rule on what securities you can and can't do. I mean, with IRAs there are, but for the most part, when you're investing, if you think futures are good or options are suitable, then go for it. Okay, a publicly traded fund is like a closed-end fund. It's an investment company, but it actually trades on the exchange, unlike a mutual fund, which you buy and sell from the company. Purchasing power risk is the same thing as inflation. The fact that over time, if you invest in fixed income, your money won't buy as much as it used to. That's purchasing power risk. You can't buy as much. So the best hedge against that is pretty much common stock or gold. A private investment in a public offering. Okay. That's basically where, like, say a group of accredited investors or quibs will go to like Home Depot and say, hey, we want to buy 30 million shares, $30 million worth of your stock on a private placement. And they'll do that and they'll buy it. The problem is they have to hold it for 6 months fully paid so they don't dilute the market. Okay. It is restricted for 6 months. That's the big thing about it. Okay. And the reason we do this is it's a way to inject money into a company. But remember, the company's already trading public. So we're just doing a private investment in a public entity. Okay. A purchaser's rep usually goes with a Reg D. If you're like unaccredited or not sophisticated enough, usually you'll bring in a purchaser rep, not someone involved in getting commission on the deal, like an accountant or a lawyer or another registered rep that you're friends with, that can explain the risks and rewards of investing in a certain Reg D offering. A put is an option, a piece of paper. A put is an option that gives you the right to sell at a certain price for a certain amount of time. So if you buy a put, you're bearish, And if you sell a put, you're on the other side. You're obligated to buy the stock. So again, if I buy a put, I'm bearish. I have the right to sell. If I sell a put, that's the other side of the contract. I'm obligated to buy the stock if the buyer of the put makes me do it. A pyramid scheme or a Ponzi scheme, those are all like they're manipulation. That's not good. That's a crime. Okay, that's the P's, baby. That's the P's. I think I got all the P's, right? I got all the P done. Good, I'm glad. Wait for the shape. Sorry. Okay, now that's a line from History of the World, Part 1. Okay. The Q's, mind your P's and Q's, not a lot. So a QUIB, a qualified institutional buyer. This is the Q's, baby. Q's, Q's, Q's. Okay. So qualified institutional buyer. This is a institution. It's not an individual. It's never an individual that has at least 100 million under management. Okay. Now, if it's a broker dealer, it could be 10 million. But for any financial institution that manages at least 100 million and they're professionally doing it, they are a QUIB. And they get to do a lot of things. They usually can buy restricted shares under 144A. Qualified legal opinion. So if I have a legal opinion, which is if I'm going to issue a revenue bond, the bond counsel or lawyer is going to issue a legal opinion. Unqualified is good. Unqualified means there's no issue. Qualified means there's some sort of problem with the deal and it probably needs to be fixed. A qualified plan as a retirement plan, which has tax-deductible contributions. It's covered under ERISA. You can't discriminate. The money goes tax-deferred. We know all this shit. And you have the earliest you can take it out is 59 and a half, and you can have an RMD of 73. Also, remember, since you haven't paid taxes on any of this yet, and it's non-discriminatory, which means you have to offer to every full-time person over 21, the money goes tax-deferred. When you take it out, you pay tax on everything. A QDRO, Qualified Domestic Relations Order. This is a court order, like say I'm married and I get caught, whatever, doing something really, really gross, okay? And my wife goes, screw you, get out of here. If I've been putting in my money in my 401k for the 30 years, well, she's entitled to some of it. But if she doesn't have this QDRO and she tries to take it out, she's going to pay a penalty. So this goes to a court and says, hey, Mrs. Finnan can take, ex-Mrs. Finnan, the first Mrs. Finnan, right, my first ex-wife, can take money out of to put in her own IRA or her own IRA without paying the penalty. And so if you have a 401k, they won't let you take that out without a penalty unless that's there. Okay. So a qualified person is an individual under the state laws that is allowed to get performance-based fees attached to their accounts if you allow it. A qualified person has either 1.1 million assets under management or 2.2 net worth. A qualified tuition plan is basically a 529. QTP, it's a 529. A qualified cash dividend is when you buy shares of a common or preferred and maybe ETFs. If you hold it for at least 60 days before and after the X date, it's not qualified, which means you owe taxes on it, but it's going to be at the lower, almost the capital gains rate, the 15 to 20%. So if you own a stock long enough, that's why it's tax efficient. You don't pay tax on the common stock till you sell it. And after time, your dividends are taxed at a much lower rate. Quick asset ratio, okay? Quick asset ratio, quick test, quick ratio, asset test, all mean the same thing. It's a pretty stringent measure of liquidity because it takes all the current assets minus inventory divided by the current liabilities, okay? So normal current ratio is current assets over current liabilities. The quick test, the quick ratio, quick asset ratio, the asset test, the quick, whatever it is, a quick ratio, all mean the same thing, and they mean you're going to take the current assets, subtract inventory, and then divide by current liabilities. A quote is basically a bid and an offer, right? I'm quoting the bond as a bid, as an offer. That's my quote. Okay. Usually market makers or broker dealers do that. And that's the Q's, baby. So P's and Q's, not so bad. The next one up is, what is after Q? R. R is a big one. It might be a standalone. It's like 4 fucking pages. Wow, R is going to be on its own. Hopefully I'll get that out over the weekend. Guys, thank you so much. Don't forget to join. Don't forget to like, subscribe, and share this shit, okay? Also, check out every Tuesday and Thursday. I do a live Q&A. Ask questions on any FINRA exam. It's free, baby, free. Hey, you made it this far in the alphabet. You might as well keep finishing. You've done A through Q. We're on to the R's now. R will be a standalone video probably because there's a lot of R's in it. I mean, maybe I'll put S, but S is big and so is fucking T. So it's big. So we're going to go into this. I'm Ken Finnan. It's my job to get you past the licensing exams. And if you just want to learn the basics of finance terms, follow along on this series and you're going to learn some stuff, I think, and hopefully I'll make you laugh a little bit. So now on to R. Are you ready, kids?
Who lives in a pineapple under the sea? Yes, that's S. So I'm going to go with R. R for Randy. R, are you ready? Let's get into it. Okay, so what's a rally? A rally. He's rallying up when a stock goes up quickly, like it's rallying back. If it's down, it's coming back up. It's a quick rise or a rise in either a market or a specific stock. Random walk theory is the idea that historical prices will not affect what's going forward. Like literally, you're walking down the street, it's random. We're not where we're going. So the future price movements are not determined by what happened before. So again, random walk theory is that basically we don't believe in technical analysis because technical traders think that if you see support, resistance, or patterns, it's going to keep going. So random walk theory believes that what happened before has no impact on what's going to happen in the future. Rate covenant. So a rate covenant is part of a revenue bond. You know, the crime, C for covenant, RIME, right? Rate covenant is that we're going to charge, it's a revenue bond that the issuer is, or whoever's running the bond is going to charge a high enough revenue rate on the revenue producing project. Wow, that was horrible. But again, the issuer is going to charge a high enough rate to cover the debt service, right? So we have debt service they have to pay. What's debt service? You should have listened to my D's. That's when everyone needs a little D, right? So if we look at the debt service is what you pay in interest and principal every year. So rate covenant says you have to charge a high enough rate, or we promise to charge a high enough rate to be able to pay that interest and principal every year. Okay, what's a rating? A rating is how they determine credit risk. That's a AAA, AA, triple B, or that's S&P or in Fitch, or Moody's is A, and then A, then big A, and then big B, little a. Those are the credit ratings, and the lower it is, the more credit risk you have, right? That's a credit rating, or just the rating, or the rating companies are the ones doing it. So anything under triple B or BAA, under, not those, BBB and BAA are investment grade. Anything under those are considered speculative or junk or high yield. Ratio writing. So a ratio rate is when you know what covered call is, right? When you buy stock and sell a call, but what you do is you buy 100 shares and then you sell one call. That matches up. But if the stock has a high beta, you want to kind of match up on that. So if a stock has a high beta, what you're going to do is you're going to say, oh, say it has a beta of 2. That's big. If you bought 100 shares, you would sell 2 calls. Now, the problem with that is you have unlimited risk. It's very aggressive. It's not like covered calls where it's super safe. This actually has unlimited risk because if you buy 100 shares and sell 2 calls, right, you have one covered call, which is safe, but then you have one naked call, naked, uncovered, risky, right? Okay. So that's ratio writing, and you do that when you're kind of properly hedge a position based on its beta or its volatility. A REIT, what the hell is a REIT? A REIT is a real estate investment trust. It's like a pooled interest. It's like a mutual fund, but it isn't. That manages portfolio. It trades on the stock exchange. It could be untraded, but they can trade or not. But the ones we think of that they're tradable, they're liquid. So you're diversified. Instead of me buying like a property in Miami, my family makes fun of that way I say words. Megan and Miami. Maybe it's an M thing. Who knows? Instead of me buying one property in Miami and having the risk of that thing, I'll buy a REIT for the entire Miami area. Hope I said it right. The whole Miami area. So this way I'm diversified. So if one property fails, I still have 99 others in this pool. Now remember, I'm not managing it. I'm just buying it like a stock, like a closed-end fund in a way. And they invest in property, whether it's mutual fund and mortgages, or whether it's like flipping houses and stuff like that. Not houses, I shouldn't have said that. Flipping commercial property. They don't usually do residential. It's mostly commercial property. Why they don't do residential, I don't know, but it isn't there. So they pass through 90% of their gains. They don't pass through their losses, and it does trade. You can buy it on margin, and you can sell it short. But again, it's a pooled investment of real estate, and it creates diversification. Real estate limited partnership, or RELP, I sometimes call them, is a limited partnership, which we should know what they are. That's a partnership with a limited partner and a general partner, and they do the same thing. They have central management. They manage multiple properties, but the partnership passes through all the gains and losses. So think, here's a property and here's the owners. All the money goes in and flows right through to all the partners. So that's a limit. That's a partnership. So a real estate limited partnership is one that does that on purpose. Okay. That's what they do, that as a partnership. They do specifically real estate. Then there's other ones like oil and gas and stuff like that, which is, we probably did already. So there's oil and gas limited partnership, which is oil and drilling and stuff like that. There's equipment leasing, which is they buy like equipment and then lease it to companies and they make money that way. But then this one is a real estate limited partnership. They do real estate. And that's high level. I'm not going super deep into it. Now, if you see the word raw land, usually it's with this raw land, there's no depreciation, no write-offs, no nothing. It's strictly for speculation or capitalization. So if you see raw land, there's no deductions allowed, no depletion, no depreciation, but you're looking specifically for high risk, high reward, speculation or capital gains. What's a realized capital gain or loss? That's when you actually pull the trigger, right? So if you buy stock at 50 and it rises to 60, well, you made money, not really. It's unrealized gain. You can't be taxed on it unless you talk to certain Congress people. They want to do that, but you can't tax unrealized gain. So you didn't actually get it yet. So a realized gain is when you bought stock at 50 and it goes to 60 and then you actually sell it and you have a gain that's taxable or a loss. Buy stock at 50, it goes to 40. Until you sell it, you have a paper or unrealized loss. But once you sell it at 40, boom, you lose $10. And that's a realized gain or a loss. Realized means it's a taxable event. Could be a tax deduction if it's a loss, but if it's a gain, then it's taxable. Recession. What's a recession? So a recession, again, depending who's president or whatever, whoever's in president will never say they're in a recession until after. It doesn't matter right or left. A recession is technically, according to this, 2 quarters of negative GDP growth. A depression is 6 quarters of it. Real property as opposed to personal property. Real property is like real estate. Personal property is like your actual stuff, like your cars, your desks, your computer, stuff like that. Real property is like real estate buildings, stuff like that. Record date. So we have the record date is Thursday. Settlement is normally T+2. So you have to buy the stock by Tuesday or before. That's the cum date. I'm not spelling that. Two days before, because then you'll settle on the record date and you'll get the dividend. If you buy it the day before the record date, you will settle after the record date and you will not get the dividend. I always try to picture myself as like the transfer agent or the payee agent at the end of the record date on that day. Say it's a Thursday. They look at the list and he or she goes, okay, these people are on the list, they get the dividend. If they're not on the list, they don't get the dividend. So the record date is a day you must be an owner of record to receive some sort of distribution. Real-time reporting system. Okay. Real-time reporting system. That's the way muni bonds are reported for trades. When you do a trade in a muni bond, you use the RTRS, real-time reporting system. The other one for corporates and treasuries is called TRACE, TRACE. They take 15 minutes to report it, but from the execution. But RTRS is for munis and then TRACE is for corporates and treasuries. Recapture. Recapture is not a good thing. It's if you take a deduction and the IRS goes, nope, we want it back. So they're recapturing that. So recapture is not a good thing. Recapture is like you took too many deductions and the IRS goes, we want that back. A receivership. A receivership is when there's bankruptcy and the court appoints someone to manage the affairs of the business. So if you go into bankruptcy and you don't have they'll name a receiver. It'll go into receivership. They'll name some sort of administrator to look over that, like a trustee, to look over that and decide how to sell the money, how sell the assets. Okay, reclamation. Reclamation is, what settlement is? It's like the broker dealer literally they love to fight when I'm doing this. Not really fighting, they play. Reclamation is if I do a trade and I'm the one broker dealer, you're the other, and we compare the trade and it locked in. And then I go, oh my God, it's a mistake. I shouldn't have accepted the trade. I shouldn't have settled it or cleared it because the numbers don't work. I'm going to go back into the system and reclaim it and say, hey, listen, we should not have accepted that trade. Whether it's wrong or non-deliverable, I reclaim it and go, I shouldn't have done that. Recourse loan and non-recourse loan. Well, I'll do them both. A non-recourse loan is when you loan money to a limited partnership as part of your investment and you don't owe the money. If the partnership fails, you don't actually owe the money. A recourse loan means that you do owe it. So if you do a recourse loan into a limited partnership and the partnership fails, you still owe the money. But then that recourse loan does count toward your cost basis. So it's all the basis. It affects how much you can, take off in losses and how much you earn and what your percentage is. So a recourse loan means that you owe the money still, even if the partnership fails. And a non-recourse loan means that if the partnership fails, you don't owe the money. Okay, redemption. Redeemable securities, we'll go both. So a redeemable security is like a mutual fund or a UIT, stuff like that, okay? Now, they're redeemed back to the issuer, like mutual funds, UITs, I guess annuities if you want to say, but no, let's just go with UITs and mutual funds. They're redeemed back, or even like the Series EE things, right? So you don't sell them in the market. Things are either negotiable or redeemable, okay? Redeemable means like a coupon, you give it back to the issuer and you get your principal back. That's what that is. Okay. Negotiable means you trade it. If you want to get rid of it, you have to find a buyer. So redemption is the act of returning it to the issuer and getting your principal back, or whatever you're supposed to get back. And redeemable just means that you can do that. Refunding is lit now. A refund is like what I don't do. If you cancel a lesson, I don't refund you. But a refund is when I say I'm an issuer and I have a bond at 8% and rates drop to like 5 or 4%. I don't want to pay the 8 anymore. So I'll issue a new bond at the lower rate and then take that money and pay you off. That's refunding. Unlike pre-refunding is when I think I covered this. Pre-refunding is the same situation, but I can't call it back yet. So I will issue a bond at a lower rate anyway, buy treasuries, use that money to buy treasuries, okay, that I got from issuing the bond, buy the treasuries, and the interest from those treasuries will pay off the interest on the older bond. It's kind of a accounting loophole. Redemption fee. A redemption fee is like when you buy a Class B shares, or even if you get shares of a mutual fund and you leave sort of early, they can charge you a redemption fee. So like, especially in Class B, if you sell it within the first 5 to 7 years, you're probably going to pay some sort of redemption fee. But usually if you hold it for long enough, they waive it. But if you're under that numbers, you're going to have to pay a fee. Red herring. What's a red herring? Red herring is a preliminary prospectus. What you can give that out during the cooling off period of a registered security, non-exempt security. You give that out to get indications of interest. What's missing from it? It can't have a final date or a final price, because God forbid you saying you're going to be there. Remember, if you're doing this before the SEC has declared you effective, so you can't be like, hey, it's going to be printed this day and this price, because that's assuming the SEC is going to approve you. No, they don't approve. They declare you effective. Remember, no regulator ever approves anything ever. So a red herring is a preliminary prospectus that you push out to get investors interested, and that you can get an indication of interest. It's not, it's not an offer for sale. It actually say on it, this is not an offer for sale. Offers can only be made through prospectus, which is the final prospectus. Registered. Okay. So registered means you're either registered with under the SEC or some sort of state, you're registering the security with either a state or the SEC. Registered certificate. So that's registered. That's non-exempt securities have to register with the SEC or the state they're going to do business in. Okay. There are exemptions. If they're non-exempt, they have to do it. If they're exempt, they may not have to do it. A registered security means that basically your name is registered on the books of the issuer. So the issuer knows who you are. You buy the shares, the issuer knows who you are. That's what it is. An ROP, the registered option principal. They supervise reps with options accounts. Okay. So again, they sign the advertising, they approve the new accounts. The ROP, or the Series 4, the registered options principal, is the individual. It's not a firm. It's the individual that supervises options activities, and they open accounts and they check the advertising and all that stuff. Registered rep. That's what you're going to be after you pass these exams. That's an individual that is registered with FINRA, and any state they do business in, they'd be an agent. But a registered rep is an employee of a member firm. Member firm always means FINRA firm, right? Okay. And they're registered with FINRA and their firm. Okay. And they are basically serving customers. They're giving advice. They're facilitating trades. They're executing transactions or giving advice or impacting with retail customers over securities. Registration by qualification. That's when an issuer registers their shares in one state only, and it's up to the administrator to decide when they're effective, and you file with the administrator only. You're not in more than one state. It's one state only. Once you cross state lines, the Fed wants to be involved. So that will be registered by coordination. Registration by qualification is one state only. Registration by coordination is when it's multiple states, but you're not federally covered because you're going to register both the SEC and all the states you're in. Literally, if you cross the state line, the SEC or the federal government has jurisdiction. So you're going to register with the states, more than one state, and the SEC. So you're coordinating between the SEC and the state, and you're effective when the SEC says you are, not when the state does. Registration statement, that is absolutely the legal document. That's called the S1. Well, on the federal level, it's an S1 where you file it. That starts a 20-day cooling off period. And that's it. A registrar is usually a bank or a trust company that's job it is to make sure that the record of the owners of corporation securities are right. They're like, think of the transfer agent as the one who handles the changing of the names. The registrar is looking over their shoulder going, no, you missed a name. The registrar is like the boss of the transfer agent. The transfer agent is changing all the names on the on the list of securities owners, and the registrar is making sure that they do that. That's their job. Okay, a regressive tax as opposed to a progressive. Progressive tax means that the more you make, the more they take. That's normally like the way income tax go, right? If you make 30 grand a year, you're going to pay this. If you make 50, you're going to pay that a little bit more. And if you pay 100 or more, you're going to pay even more. Now, remember, it's graduated. So it's not like if you make 100, you pay that higher rate on everything. Everything over the threshold you pay. I've done videos on these. A regressive tax is like a sales tax, okay? So it hurts the poor people more. I just like to say it that way. So progressive affects more the richer people more within reason, and a regressive tax hurts poor people more. That's why whenever they try to increase the fare on the subway, they say that's a tax on the poor people. Because think about it. If you're making $15 an hour and they raise the rate from the subway ride from $2 to $3, that's an extra $2 a day. That's a chunk of your hourly rate. And not every day, but it is what it is. But if you make, 300 grand a year, really an extra $2 a day isn't going to impact you. So a regressive tax hurts poor people more than rich people. Regular way settlement. Regular way settlement is pretty much T+2. Everything settles T+2 except for two things, right? Okay. So everything settles T+2 except for two things. But cash settlement isn't really a thing. Cash settlement is a type of settlement, but no securities trade cash. It's you choose to trade cash, which is same day. So regular way settlement is T+2. The two things that are not T+2 are option trading and treasury trading. Those things are T+1. And then actually, even if you exercise an equity option, that's T+2. Because think about it, when you buy a call or a put on a stock and you exercise it, you're buying or selling the stock, which brings us back to T+2. But if you do an index option or non-equity option, it's T+2 trading and T+2 exercise. Regulated investment company. That is an investment company that's subject under subchapter M of the Investment Company Act of 40. Blow my head off with this stupid shit. So boring. They're regulated if they are regulated under subchapter M, as long as they distribute 90, the mutual funds and REITs, okay? They both do these, even though REITs aren't part of the Investment Company Act of 40. They're regulated under subchapter M of the IRS code that says if they distribute at least 90% of their income, net income really, but just income, then they only pay tax on what they don't. So the investors actually get more money because they're getting it hasn't been taxed. They owe tax on it, but that has not been taxed yet. Unlike a corporation, when they earn money, they pay taxes on everything. Then they kick out a dividend and then you pay tax on it. So it's double tax. Okay, Regulation A, small issuer. Regulation A plus, really. Regulation A plus is up to, there's tier 1 up to 20 million and tier 2 is up to 75 million in a 12-month period. Don't have to go too deep on it. Just know that. Now, it's still sort of registered. It's just light registered. And anyone can buy them, especially Reg A tier 1, anyone can buy, right? Tier 2, anyone can buy. But if you're not accredited, then you can't buy as much. You're limited what you can buy. Well, I'm going to go out of order first. Reg D, I'm going to go out of order a little bit, then I'll go back to Reg BI. Reg D is like, I think D for direct. I think Reg A, SMALL, like small issuer. Reg D is for direct, so it's a private placement. That's the whole private placement where we don't register with the SEC. We're exempt. We're just selling to kind of rich people, accredited, right? We know what accredited people are because you watch my letter A video, right? So you can only sell to accredited investors, and there's different levels, but the most you could ever, like if it's 504, you can sell to anyone you want. That's under $10 million. $5 million and more. If it's a 506B, you can sell to all accredited, but only up to 35 non-accredited. And if it's a 506C, which is the big one, it's still 5 million and more, but it's the highest level. You can only sell to accredited, no unaccredited, but you're allowed to put general ads out there. And the reason is that if only accredited can buy, even if grandma reads it, she can't buy shit. So that's why they don't mind general advertising. Reg BI is all about best interest. It used to be, the broker dealers used to have just the level of you need to be suitable. Now Reg BI means you have to do what's right for the customer. You have to do what's best for the customer, even if it's going to hurt you. And you have to identify and confirm all kind of possible potential, not possible, not every conflict of interest, but any kind of potential conflict of interest. And you have to make sure that you're doing what's best for the client ahead of your needs. I have videos on this. Regulation FD, it's about fair disclosure. So if I'm if I'm the CEO and I'm at a lunch with a bunch of analysts and I blurt out something by mistake that's inside or not public, I have to make sure I push that out as a public statement to everyone, because all those analysts and investors now who've heard me blurt that not to the public are now in possession of inside information. So to protect them, I have to disclose it out there. The other thing is they don't want me giving special information to just like my biggest investors and analysts. I'm sure it still happens, but the point of Reg FD is they say fair disclosure. If you're going to tell one person, you have to make it available to everyone. Reg T is that whole margin that's run by the Federal Reserve. So actually, Reg T has to do with any time the broker-dealer deals with the customers, okay? Anytime broker-dealers deal with the customers in the form of money, Reg T comes into play. So there's two ways. One, whenever you buy shares, we know that settlement is T+2, but that's when the broker-dealers settle. Reg T settlement is actually T+4. That's when you, the customer, have to have the money into the broker-dealer, or your account gets frozen if you don't get an extension. Okay, so that's Reg T. That's one part of Reg T. The other part of Reg T is for margin, that they want at least 50% down. So the loan value of stock is 50%. So if you want to buy $100,000 worth of stock, you have to put down 50%. That's the Reg T. And now here's the thing. So on Reg T is always 50% of the market value. So if your equity is more than Reg T, they actually let you borrow the extras, like a mortgage, like a home equity loan. I have all margin videos on that. Again, this is high level stuff. Okay. Reg M as in Mary, Reg M. It prevents people involved in a secondary. So it's a secondary or an additional offering, not an IPO. If you're the underwriter or the syndicate member or the issuer and you're part of a additional offering or follow-on, there are restrictions. I'm going to do a whole video on this at some point on what they can do. They cannot buy the shares during the restricted period before, depending how big the company is. It's either 0 days or 1 day or 5 days before the pricing day. Because think about it. If I place a bunch of buy orders right before it's priced, I'm going to push the price up, and that's not good. And that would like an issuer or an underwriter would like to do that if they could to push the price up. They make more money. So Reg M is preventing people involved in a deal of a follow-on or a secondary additional offering to push the price up to manipulate the price. Reg M for manipulation, but it's not for IPOs. Reg NMS is a system in place to give non-discriminatory access to bids and offers to get the best price. That's the theory behind it. The theory is to make sure that everyone can access the best price, the best bid, best offer, whatever it is, fairly. Regulation S, as in Sam, is offshore. It's a U.S. company issuing shares in another country. That's all it is. It's Reg S, so this way they're exempt from registration, right? So Reg A is sort of registering registration light with the SEC. Reg D is not registering. Rule 147, which is only one state, is not registered with the SEC. Reg S is issued in another country, so it's not registered with the SEC as long as it stays out of the U.S. for at least a year. There are exceptions where it could be 6 months. So if it's equity, it's a year. If it's a reporting company in the U.S., then it's only 6 months. And then if it's a bond, it's only 40 days because nobody gives a shit about bonds. But again, you're issuing securities in another country. Only non-residents can buy, other than freaking Quibs. Quibs can do whatever the hell they want. You're issuing it outside the country, and it can't come back into the U.S. for pretty much a year. Reg Show is all the rules that under the SEC for short selling. Like you have to get a borrow or a locate. If there's a circuit breaker, you can't sell on a down ticket. You can only sell on a plus ticker, plus bid. There's all videos all over the place for stuff like that. But Reg Show is the regulations regarding shorting of securities. They have to get a locate or a borrow and the rules on that, and when they can do a buy-in, stuff like that. Reg SP, I always think of super privacy. Reg SP is a federal regulation covering privacy of customer information. And Reg SP says you have to tell them what you're going to distribute to other people, and the investor or the customer has to be able to opt out of it very easily. You can't make them like write an email. Basically they can opt out of it and say, I don't want you sharing any of my information. They can say that. It has to be a very easy opt out. Regulatory risk is the risk that regulations may negatively affect the operations. So like if you're a pharmaceutical company and you have a drug that you're waiting to see if it's going to be approved or not, that's regulatory risk. But if you're like a limited partnership, I'm just saying regulatory risk is like there's going to be a ruling. Okay, like some agency is going to make a decision on you based on regulations. Legislative risk is that they're going to change the law of the land. reinvestment risk is only, okay? It's only for things that pay you. It's not for zero coupons. It's not for common stock, like bonds, coupon paying bonds, preferreds. As you're getting paid, what happens? So say you're getting 5% a year. Oh yeah, you're getting 5. Oh, now it sucks, but 5% a year, and then rates drop to 3. Well, you're still getting your 5, but what are you going to do with the money you get? You're receiving that money. You're going to have to reinvest it, but the only thing available is that lower rate. So that's reinvestment risk. And again, reinvestment risk is only for things that pay you on a consistent basis. So zero coupons do not have reinvestment risk. Regulatory element. Okay, so regulatory element, there's 2 kinds of continuing education, regulatory and firm. Okay, regulatory element is what FINRA requires. And now it used to be every second anniversary and then every 3 years. Now, regulatory element is where you sign into your FinPro account, you go online and you take this annual, it's now annual continuing ed. And they actually added it in with the whole MQP program, where you get to keep, even if you leave, you get to keep your licenses for up to 5 years, as long as you do continuing ed every year. That's regulatory element where FINRA runs it. And if you don't do it by the end of the year, then you're what do you call it? Deficient. Continuing education deficient, CE deficient, and then you can't do any business. Now, there's also firm element, which I probably talked about. It's your firm. You know those little modules that you have to do every like 3-4 months? Oh, one in AML and one in ethics and one of that. That's the firm level, and they have to do both. So FINRA requires you have to do theirs every year, and then you have to do the firm element from the firm. And the firm does very specific to like each firm will have a different list of what they have important. So like when I was at the prop trading firm, everything was about not front running, but equity and insider trading and stuff like that. But then I went to the bond shop. It was much more about like markup and markdown and bond trading and AML and stuff like that. So each firm on the firm element is going to gear it toward what they need, where on the FINRA is going to gear it to what you're licensed for. That's what kind of stuff you're going to get. Okay, rejection. Literally my entire life with women. So rejection is when if I send you securities to clear and you go, nope, they're not good delivery, I'm rejecting them. If I take them by mistake and I go, I shouldn't have, then I do reclamation to give them back. But rejection is basically my entire life, is where I go, you try to deliver shares and I go, nope, I don't agree with them, or they're not in good delivery form, whatever it is. A remainderman sounds like a horror show, right? Remainderman. It sounds like, a tall, thin guy in the woods or something like that. So the remainderman is like, so you have a trust and you have a regular income beneficiary who's getting the money. Now what happens is when that beneficiary dies, the remainderman gets it. There's a little nuance to that, but that's pretty much what it is. The remainderman gets their money after the beneficiary of a trust or something dies. Remuneration, literally getting paid for services or work provided. That's all it is. Remuneration is getting paid. Remunerate me, baby. Okay. Repo or repurchase agreement. So whoever's doing the buying is doing a repo. So if the Federal Reserve is trying to jump the economy during contraction, they will do repos where they will buy the treasuries from the banks, and then the banks will sell them, and then the banks will agree to buy them back with a little bit more, like 2 or 3 days. That's a repo, even the next day, but that's a repo. So the Federal Reserve is buying in a repo. The Federal Reserve is buying treasuries from the banks to give them money. They do that during contraction, okay? And then they get that little bit of, they get the money and then they lend it out at a much higher rate and then they pay it back a little bit more. So I'll do this again because I just got confusing. I buy treasuries from you. You have my money. Say you buy them at 980. You promise to buy them back. You will buy them back from me in 2-3 days at 980 and at 132nd, say, okay? Now, that little 132nd, that's your interest to me, and that's what you're paying for. But you're going to take that money and lend it out at like 8 or 9%. Because remember, fractional banking, the video I did, says they don't have to have all that money on hand. They just have to have a fraction of it, and then they can lend this shit out. So a repo is when whoever's doing the buying is doing the repo. So a repo is when the Federal Reserve buys it, and then you're going to rebuy it back from me. A reverse repo is the opposite. We do that during expansion when the economy is expanding. I'm going to sell it to you, and then I'm going to buy it back from you a little bit more. So I'm taking money away from you. And remember, that little bit more interest is so insignificant, it doesn't really matter. You're not making money on that. So that's a repo and a reverse repo. Repos you do during contraction, and reverse repos the Fed does during expansion. Required minimum distribution. That's the amount that you have to take out. That's not the day, remember. So usually it's required beginning day is the day you have to start taking your money out. But RMD is a slang for when you have to start taking it out or how much you do. So if you have a qualified retirement account or a regular retirement account, 401k, IRA, stuff like that, once you turn 73, so the April 1st after you turn 73, you have to start withdrawing money out at a rate that all of it will be distributed by the time you're supposed to kick it. Okay. So if you're 73 and they think you're going to live for 10 years, okay, if you're 73 and they think you're going to live for 10 years based on actuaries, you have to take out 10% of your money every year. Okay. So that's RMD, and that's going to be every year. Now, the new rules are if you don't take that out, they used to tax you 50%. Now they tax you 25% on what you should have taken out. So if you're supposed to take out 100 grand a year and you only take out 50, they're going to tax you 25% on that 50 that you didn't take out. So take the fucking money out. Okay, reserve requirement. That's what the banks have to have on deposit at any point. So I've done the video and I'll try to attach it on fractional banking. I can only attach 3 videos, so I have to pick and choose. But for fractional banking allows banks to just take a portion of what they get in deposits, put it aside, and then lend out the rest. They only have to keep around, it's around 10 or 11% of what the bigger banks have more, but it's usually around 10% of what they get in deposits. And that allows them to grow the economy a little bit because they can lend out and invest 90% of the money that comes in. They don't have to keep 10. So that's a reserve requirement. And they usually don't change that too much. 2008, they did with the too big to fail. They're trying to put that on some of the broker dealers now, which is a problem. It's kind of shutting out the small broker dealers, but we'll get there. So again, the reserve requirement is what the Federal Reserve requires banks to keep on deposit. They call them the reserves. It's either cash or treasuries they can use. Resistance, there's support and resistance. So if you're a technical trader, resistance is like the higher price where it keeps, like, there's not a rule that it can go through that, but there's pressure. There'll be downward pressure when it gets up to this point. Like, look, I'll show you. Hold on. Okay, so the stock is trading in a range. Like, it goes from 50 up to 60, down to 50. So what do you think is going to happen when it gets to 50? It's probably going to rise up. So that's called the support level. The bottom is called support. It's not a hard number. It's just that when it gets down there, people see that and then they want to buy it. So then they'll push it up. And when it gets up here, they go, oh, it's been hitting 60 a bunch of times. We think it's going to go down. So they start selling it. It puts downward pressure on it. And that's resistance. The upside is resistance. It's stopping you it's resisting your rising. And support is holding it up. So it's probably going to prevent it from going down too much. Now, a breakout is if it goes through that, right? So we think it's going to bounce off of it, but it goes through what we think is going to keep going higher. Through resistance means it's bullish, okay? And you place a buy stop up here. But if you go through support, it's not a good thing. We think it's going to go down again because once you get through the floor, you have to go to the next floor before you stop falling. Okay. A restricted security is usually an unregistered non-exempt security, like a Reg D. Usually it's subject to 144 holding period, stuff like that. So pretty much restricted means unregistered non-exempt, means it has not been registered yet. So there'll usually be some sort of holding period or some restrictions, hey, on selling it. So a respondent is someone who's been named in an arbitration or disciplinary action. Like if I was in trouble, I'd be the respondent. They're the plaintiff or whatever. They're the one leading the action. I would be the respondent. I have to respond to it. Restricted account. And a restricted account is a margin account with below 50%, below the Reg T, right? Below the 50%. It's not even a big deal. Just when you buy stock, you have to meet the Reg T. Nothing happens. I get restricted all the time. I mean, I don't know it. I know that I go below 50% because I literally can't pick a good stock to save my fucking life. So if you see residual claim, that's what common stock owners have, right? So if a company goes bankrupt, all the creditors and all that get paid off, whatever's left goes to the common stockholder preferred. Well, to be fair, none of it gets there because that's the equity. Residual claim is you get paid after everyone else is paid. Retained earnings. Retained earnings is when a company makes money, the profits, or their income, I guess it's better if whatever their income is, what they don't pay in dividends. So if we earn $1 million and we pay out $400,000 in dividends, that's $600,000 in retained earnings. Retained earnings are literally just us, what we don't pay in dividends. Retiring a bond is basically ending the obligation. You either buy it in the open market, you call it, or it just matures and you pay it off. Retired bond means we don't care about it anymore. It's gone. I know I'm going to jumping around. A restricted person is someone, because I have like 4 different databases I'm looking at. So restricted person is a person who pretty much works in a broker dealer or in our industry and cannot buy on equity IPOs. Restricted persons, member firms, associated people of member firms, immediate family, employees of member firms, fiduciaries, portfolio managers, and people who own broker-dealers, or even lawyers or accountants who do most of their business with broker-dealers, they're restricted from buying on equity IPOs. They can buy on additionals, they can buy in additional offerings, follow-on, same thing, secondaries. They can buy in bond offerings. They can buy in preferred offerings. No one cares, okay? It's literally common stock IPOs they can't buy on because, hell, if here's the thing, if people in the business could buy on them, then none of the good deals would ever get out to the public. Return on investment, it's your profit or loss from a transaction, okay? It's an annual, usually maybe it's done as annual, but return on investment is how much you're getting versus your investment. So it's your profit or loss divided by what you invested. It's pretty straightforward. Retail communication. So this is communication to the public that basically makes some sort of investment recommendation or some version of that. Retail. So let's go with the three of them since we're here. Correspondence is to 25 people or less does not need pre-approval. Or if it's over 25 people in a 30-day period, then it needs pre-approval, and that is retail communication. If it's to institutions like broker-dealers, hedge fund, mutual funds, it doesn't need to be pre-approved, it's reviewed. So correspondence and institution are treated the same way as far as whether you have to pre-approve it or not. They will put more restrictions on correspondence if they see something wrong. Institutions can kind of defend themselves, but correspondence is 25 or less, no pre-approval. Retail is over 25, needs pre-approval. And institutions is sending to institutions does not need pre-approval. Revenue bonds are bonds that they're a type of municipal security that is issued for projects that earn revenue. So the revenue from the project pays a debt service, unlike a GO bond where the property taxes, ad valorem taxes, pay the debt service, which is interest and principal. So revenue bonds are issued for projects that earn money. And they're not corporate, they're a little corporate-y, but for the most part, they're issued by city, state, town, whatever, and they're there to generate revenue, like a parking garage, a hospital, airport, like that, toll roads. A revenue anticipation note, a RAN. A revenue anticipation note is a short-term muni, that is used, like, if we know we need money now and we say, oh, we got tolls and we got subway fares coming over the next few months, we'll issue a muni note now, a revenue anticipation note now to get the money. And then when we get our revenue, non-tax revenue in the future, it'll pay it off. It's like a bridge loan to get us out of an emergency. If you see the RevDex or the revenue bond index, that's on the bond buyer. It's like 25 revenue bonds, and they just an index that tracks it. It's a weekly thing, I think. Okay, there's churning and reverse churning. So churning is when you excessively trade, right? But reverse churning is like if you're in a fee-based account, you know you're getting paid regardless. So what you do is you ignore the account. You don't do anything because I'm getting paid. I'm getting, $2,000 a month from assets, no matter whether I move it or not. So I'm not even going to do anything. That's reverse churning. That's just as bad as churning. A reverse split is when usually it's bad. It's usually not a good thing. A regular split is a sign that the stock is too high, maybe, and it's all marketing tools, but they're going to get more shares worth less on a regular split. On a reverse split, you're going to get less shares worth more. They kind of do it to raise the price of it. So like Citicorp did it right after the 2008 shit. They couldn't get it over $5 a share, so they did a 1-for-10 reverse split. So that means for every 10 shares you owned, you only got one. But the price went up to 40. It was at $48 by $4.80. It went up to 48. So if you owned 100 shares at $4, you now own 10 shares at 40. So a reverse split is the opposite of a regular split. You're going to get less shares worth more versus a regular split. You're going to get more shares worth less. Even out, everything evens out like market value wise, but it just looks better. They're not marketing. A revocable trust. A revocable trust is a trust that can be canceled or changed by the grantor. The grantor sets it up, and they set up either revocable or irrevocable. Revocable means that the person who set it up can cancel it, change it, do whatever they want, and it's part of their estate. An irrevocable trust, once you put it in there, you can set it up, and then the trustee handles it based on what the rules are. You cannot take that money back. It is not part of your estate. There are advantages and disadvantages to both. Talk to a lawyer, not me, about that shit. I think you already talked about reverse repo. It's when you're selling shares and then you're going to buy it back later at a higher price. A right, also known as a preemptive right, or a right hand, okay, or the right wing, whatever you want to call it. A right is when it's very short term. It's like 30 to 45 days, maybe 60, where a company who's issuing more shares, they give the existing shareholders the ability to keep their percentage ownership. They give their shareholders the ability to keep the percentage ownership. They don't have to use the right. But if you own 100 shares, you're going to get 100 rights. Now, you may not get 100 shares out of it. You may get 5 or 10, but you get a right to buy shares very short term at a discount from the last sale. So they're very short term. What can you do with it? You can sell it or trade it, same thing. You can give it away. You can exercise it, which means buy the more shares to keep your percentage ownership. You let them expire. Moronic, but you can't. You can't give them back to the company. Rights of accumulation. That is literally just if you have a mutual fund that allows you to get. So rights of accumulation is this. We know what breakpoints are. They get their volume discounts. Can you hear the dogs barking? Volume discount. That's why I look. And I have ADD. I can't look at one thing. So if you have a mutual fund and say they have a breakpoint, so every 10 grand, say you get a lower sales charge. Well, if you put in 8 grand, you're going to pay the 8.5%. But if the value of your fund rises past the 10 grand, then any new money gets the lower sales charge. So say you put in 8 grand and it grows over a year or two to 12 grand. You decide to put another 2,000 in. Well, you're now at 12 grand plus the 2 is 14. You're going to get the lower sales charge. So rights of accumulation allows the growth of the fund to qualify you for a breakpoint. By the way, a rights offering is the same as getting a preemptive right. Risk, it's the potential for loss. That's what it is. There's inflation risk, interest rate risk, default risk, political risk, foreign exchange, call, all that shit. Risk adjusted return, it's return adjusted for the market risk associated with it. Like usually it's going to be a Sharpe ratio does that. I think beta does, but it's a risk adjusted return is really just your return adjusted for the risk you're taking. The risk-free rate return is treasury bills. It's usually like the 90-day T-bill. Why? Because short-term T-bills don't have any default risk, no inflation risk, or so little that it doesn't matter. No default, no inflation, no interest rate, no reinvestment, no call risk. So, no political risk because they're short term. They don't really have any rates. And when they talk about risk premium, it's the amount you're earning above that. I like this segue. So risk-free rate is like the 90-day T-bill, say it's 4%. If you're earning 7%, you have 3 points of risk premium. Riskless principal transaction. Okay, riskless principal transaction. Normally a principal transaction is I'm the broker dealer. I own the shares. You come to buy it. I sell it to you out of my inventory with a markup. But I have risk because the market may go up or down while I own the shares. Risk as principal is I don't actually own the shares until you give me the order. So I don't own the shares. You call up and say, I want to buy 1,000 shares at whatever price. I'll buy the shares and then turn around and sell them to you with a little bit of a markup. So risk as principal, a risk as transaction or simultaneous is where I'm not actually buying or selling the shares or taking a position until I have the order from you. So I don't have risk there unless you run away. Risk tolerance is basically the investor's ability or willingness to lose their money. Okay, their risk tolerance, they're aggressive, they have high risk tolerance, conservative, they have low. So the younger they are, the more sophisticated they are, the more money they have, they can have higher risk tolerance. The older you get, the less risk tolerance you have. So if someone in their 80s or 90s can't have a lot of risk tolerance, they don't have time to run it out. Where somebody at 25 could say, listen, I'm willing to take a chance, put it in there, and hopefully it'll work out over time. Rollover, that's an IRA rollover where you're moving it from one type of account to another. Not like moving it from JP Morgan to Schwab, but like moving it from a 401k to an IRA. And that you can do that once a year. And the best way is do it entity to entity instead of you getting the check. Because then if they take longer than that, to take too long, you're not going to have a tax problem. Because if you take the check, if you take it out of one place, take the check and going to deposit it somewhere else, you have 60 days to do it. And they actually hold back some of the shares, some of the money, which is a problem, deeper level. A Roth IRA is an IRA that is separate where you, again, high level, a Roth IRA is an IRA that's different than a regular IRA, that the money goes in after tax, it grows tax deferred, but if you hold it for more than 5 years, and if you take it out in a normal distribution, you pay no taxes on the growth, which is great. There's issues with it, like income limits. If you make too much money, you can't put it in, stuff like that. A Roth 401k is sort of the same thing. Now, they change the rules a little bit. I think I talked about it in a video. A Roth 401k is where you set it up at work, where you can put the money in after tax or gross tax deferred. But previously, the company had to set up a separate one as a regular 401k to match. Now I think they changed the rules where they can put it in after tax also, and it grows tax free. I don't hold me to that. Really, let's go with this one. The Roth 401k, you can set the same thing up as a Roth in your own at your firm instead of just with an IRA. And you get to put any money in after tax and it grows tax free. The company will match, and there's other issues with that. A round lot, it's a unit of trading that's a multiple of 100. So if you want to buy for shares, okay, for common stock, round lot is 100 shares. So if you buy 80 shares, that's an odd lot. If you buy 100 or 200 or 300 or 400 or 500, that's a round lot. A mixed round lot is like 140, 180, 240. So a round lot is 100 shares. So 100, 200, 300. Rule 144, I'm not going to go deep into it. It's a rule that restricts selling. So if you do restricted shares, it's a 6-month holding period. Then you can sell whatever you want, depending on certain things. Well, and then the other one is for control people of any shares. They have no holding period, but they have to follow the 144 rules. They can sell the greater of the 1% of the outstanding, the 4 weeks trading volume, 4 times a year, which is every 90 days. And then every 90 days, they have to fill out a new form. That's for control people. They have no holding period, but they have to follow that their whole life. 144A is an exemption to the holding period for 144. So it allows quibs to buy during that 6-month holding period. 145, Rule 145, is all about mergers and acquisitions and stock splits and stock dividends and reorganizations. It sets the rules for that. A lot of rules on that. Rule 147 is that if you register your shares in only one state to only be sold in one state, then you're exempt from the SEC requirements because you're an intrastate offering, because the federal government can't really control what the states do within reason. So Rule 147 is for intrastate offering. You can register all in one state. Rule 415 is for shelf offering, where a WIXI or a well-known seasoned issuer or a seasoned issuer can do a shelf offering, and they can actually sell the shares for up to 3 years instead of a normal 1 year. RMD, required minimum distribution. That is, if you have a qualified retirement account or some version of that, they are going to require you to start taking your money out. It's now 73. It was 72. And now it's 73. You have to take it out at a rate that would, I think I already did this, but you have to take it out at a rate that all of it will be expended by the time you're supposed to die. I definitely did it again, but hear it twice. Not going to hurt. So good. I said it twice. Okay. That's ours, baby. That's the R's. Okay. So that's a big one that took a while. S's are up next. So we're going to go there. Guys, hopefully stay awake during this.
Okay. Don't forget to stay to the end because there's a little surprise. No, there's really no surprise. I'm just hoping to stay on to the end so you can actually give me some viewing time. I'm going to pretend that there's a surprise at the end. So actually, let's get into this. So instead of me wasting a lot of time. So letter S is in Sam. This is going to really exacerbate the fact that I had to learn to get rid of my lisp in high school and before that. So before that high school, if I was in high school with a lisp, I think I would have got my ass kicked a little bit more than it did. It did get my ass kicked, but not as much as if I had a lisp. Okay, first thing we're talking about is sales proceeds. Okay, sales proceeds is when you sell something, right? When you sell something, there's cost basis when you buy it and sales proceeds when you sell it. So when you buy stock at 50 and sell it at 60, 50 is your cost basis, 60 is your proceeds or sales proceeds, and the difference is your gain or loss. In this case, it would be a $10 gain. So also remember, if you buy a put or sell a call, your break even is your sales proceeds. So again, if you buy a put or sell a call, your break even is your sales proceeds. Okay, also safe harbor. So safe harbor is like, it's a legal precedent. You're not guaranteed, but if you follow these guidelines of safe harbor, you will not be subject to legal action. So a couple of them are the two main ones that I think about on the tester in general is corporate buybacks. When companies buy back their stocks, they have the safe harbor so they don't get in trouble or accused of manipulating. Because think about it. If you're buying back your own stock, there's a chance you're going to push it up. So they make rules like you can't buy in the opening or at the end of the day within the last 10 minutes or so. They say you can't buy more than 25% of the daily volume. You can't buy in straight plus sticks. You can't push the stock up. You can only bid where other people are bidding or where it's already traded. So those are the safe harbor rules for corporate buybacks. The other one is for research. If you're going to do soft dollar, you can provide, as a broker dealer, you can do soft dollar, which is going to be in this video. Soft dollar is where you provide a service as a broker dealer and they pay you in the form of commissions. So the safe harbor rules are that's fine to do that as long as you limit it to what you're giving. You can't do hardware, you can't do rent, you can't pay the rent or salaries. But what you can pay under safe harbor rules are you can provide for research, you can provide for like access to a seminar, and you can provide software to help them allocate or do trades and stuff like that. So seminars, research, and software you can provide. If you do that, you're under the safe harbor where you won't get in trouble if you provide those things. Obviously, you can provide more things than those three, but those are under safe harbor. So again, safe harbor is like a legal precedent where if you follow the rules, you will be safe from being sued. Sales load or sales charge. Okay, same thing. Sales load is the amount you get charged. I prefer sales charge. Sales load sounds dirty. Sales charge is what you get charged for buying into a mutual fund. So if you buy into a mutual fund, you pay the NAV plus the sales charge equals the POP. The sales charge, the max is 8.5%, and they have breakpoints for stuff like that. We're not getting into it. We've talked about that before. So sales charge is what it costs to get into a mutual fund, and it's a max of 8.5%. Okay, S corporation. An S corporation is a pass-through entity, which means all the profits and losses pass through to the investors. My voice is disappearing. That sucks. Another S word. And then here's the thing. So it passes through all the gains and losses. It's like a partnership in a way, but it has some rules. It has a rule that you can't have more than 100 shareholders in it. If it's more than 100, then it doesn't work. It passes through, and all the investors have to be U.S. residents or human beings. They can't be corporations. If they don't meet that, then it has to be taxed as a corporation, where the actual corporation pays taxes. Okay, so if they don't meet the 100 or less, and the U.S. residents and or corporations, they can't have corporations. Think of it this way: they have to be U.S. resident human beings to be shareholders. If it's not that, they lose that protection, and they have to become a corporation, a C corp in a way, and they have to or be taxed as a C corp, and they pay taxes. And then when they distribute, you pay taxes. So that would mean double taxation, which is not the purpose of these things. Okay, secondary market is where shit trades. Okay, there's a primary market, which is new issues. Then there's a secondary market where the stuff trades. And there's 4 markets in the secondary market. I'm not going to go deep into it. First market is the exchanges. Second market is over the counter. Third market, remember, anything on an exchange is listed. So third market is where listed shit that trades on an exchange actually trades over the counter. So third market is like an alternative trading system where stuff that trades on the stock exchange trades over the counter in addition to that. And then the fourth market is like ECNs and dark pools, and it's where institutions can trade with each other. So that's the secondary market. Now, a secondary offering is when, like, say Bill Gates owns a bunch of shares. Now, we know what a primary offering is, Microsoft issuing shares. A secondary is where a shareholder, like a big shareholder, instead of selling under 144 rules and following those restrictions, they do a secondary where they make an offering. So a secondary offering is where an actual shareholder gets the money, not the company. The company will be a primary offering. When a shareholder, a big shareholder, sells their shares in the offering, that would be a secondary offering. Okay, a Section 457 plan is a non-qualified plan for like government-y kind of things, for like if you work at a hospital or a charitable union, stuff like that. I guess not churches, but the point is it's non-qualified, which means the money can come out before you're 59 and a half. So that's what it is. It's a Section 457 plan. Since we're on these things, let's talk about a Section 529. A Section 529 is that college savings plan, right? So it's basically a municipal fund security covered by MSRB where you can put money aside for college and it goes in after tax. It grows tax deferred. And if you take it out for college, it's tax free. Now, remember this, it's sponsored by the state. So if you're in Jersey and you buy a Pennsylvania one, you might actually pay state taxes on it because you bought it in another state. So the point is, if you buy one in your own state, you're probably pretty cool. But if you're going to buy one invest in one in a different state, or I shouldn't say buy one, invest in one or use one in a different state, there might be tax complications. So 529 is a state-sponsored college savings plan. You can use a little bit for high school, but it's mostly for after high school college savings. That's if you open it up, you're the owner, you have your kids' names on it. And if you decide to take it away from your kids, you can, because you are the owner of the plan. The key is, just like a covered up, the money goes in after tax, grows tax deferred, and if you use it for education, it's tax-free withdrawal. A 529 ABLE plan is to support individuals with disabilities. You need to know that they must be disabled by the time they're 26 years old. The Securities Act of 1933 is all about issuing shares, non-exempt securities, and they have exemptions like Reg A, Reg D, stuff like that. That's what that's about. SEC, the Securities Act of 1934 is about secondary market trading, manipulation, insiders, created the SEC, short selling, proxy rules, voting by mail, the exchanges and broker dealers how to register, reports, manipulation, and stabilization. Those are all things under the Securities Act of 1934. The Act of 1933 is for primary and new issues. The SEC, the Securities and Exchange Commission, I couldn't think of the fucking word. The Securities and Exchange Commission is a government entity. FINRA is not. FINRA is not a government entity. The NFA is not. That's the CFTC. So SEC is a government that regulates broker-dealers, agents, IAs, IIRs, and securities and exchanges. Anything to do with securities, maybe crypto at some point, but they regulate it. They're the ones who regulate it, and they use FINRA and CBOE and all these other DEAs to actually be their watchdogs for them, and then they come in at the end. So the SEC is the actual government overseeing anything to do with securities, agents, IIRs, broker-dealers, IAs, securities, and exchanges. So this one's a little out of order, but it's SIPC, SIPC, Securities Investor Protection Corporation. It's there in case broker-dealers or the broker-dealers go bankrupt. Every broker-dealer pretty much has to be a member. So what they do is they reimburse if a broker-dealer goes bankrupt, not fraud, that'd be Fidelity. If a broker-dealer goes bankrupt, they will cover up to $500,000 total per account. Up to $250 can be cash. Okay. So again, here's what happens just per account. So per person, I guess. So if I have a cash and a margin account, they combine them for the 500 grand. If I also have a joint account with my wife, that's an account. So if I have an account, I have a joint account, and my wife has an account. That's 500 each, not 1.5 total. That's 500 for my accounts, 500 for the joints, and 500 for her accounts or joint account. A Roth IRA is considered a fourth account. Another one. Keep that in mind. So they will cover up to $500,000 of security, $500,000 of which, not in addition, of which $250 can be cash. So you have $300 cash in your account. It's only getting covered on $250. Sector rotation. That's a strategy. It's active. Remember, if I die right now, sector rotation is active. By the way, if I die, what do? Yes, we share the shit out of this. So I go viral as a last thing. So now, sector rotation, okay, is when you think certain sectors of the economy will do better or worse depending on the business cycle. So maybe during economic boom, you would buy like retailers and stuff like that. And during maybe during a contraction, you'd buy more like pharmaceutical, healthcare, stuff like that. I guess healthcare, but like alcohol, food, stuff like that. Those are defensive securities. You would move it up and down based on what's happening in the economy. That's sector rotation. Now, a sector fund is a mutual fund whose investment objectives is focused on a specific sector. So they're riskier because they're less diversified. So what's a security? Well, literally anything the SEC says it is. But a security by the Howey definition, which is the Howey test, is an investment of money in a common enterprise with other people with risk or for profit managed by a third party. All four parts, I can't do this, all four parts, they're not shipbuilding in a ship, it's a part, are going to be part of, you have to have all four parts, I'm stuttering like a fool, to become a security. And they are regulated by the SEC unless they're exempt. And even then, even if they're exempt, if it's a security, it may be exempt, but it's still subject to anti-fraud rules. SRO or DEAs. SRO is self-regulatory organization. DEA is designated an examining authority. They're literally the same thing. That's like FINRA, MSRB, CBOE, NFA. They are regulating the members of broker-dealers and stuff like that under their charge on behalf of the SEC. The SEC will come in too, but they will send reports to the SEC. So they're not, remember, they're non-governmental. SEC is government. FINRA, SROs are not. FINRA, CBOE, NFA are not government. Seller's option. So let's say I want to sell my stock, but I don't actually know when I'm going to have it to deliver. I can do a seller's option trade where I have up to pretty much 35 days. So I can't do it in T+2. So I can deliver anytime between T+3 and T+35 at my discretion. I have to give the buyer a warning, a day's warning, but it's basically you're going to buy that knowing that I don't know when I'm actually going to sell it to deliver it. Okay. So I'm selling it now based on a price. You full well know that it's a seller's option, that you're not getting it on T+2, but it can be anywhere from T+3 to T+35 as long as I give you 1 day's warning. A secured bond is a bond that is backed by some sort of property or asset or something, so that if it defaults, the trustee who's named on this will sell the asset to pay off the creditors. So like a mortgage bond is backed by property. It's not a mortgage-backed security. It's a mortgage bond backed by property. They will sell the property if we default. A equipment bond is backed by equipment, trains, planes, shit like that, tractors. If I default, they will sell the tractors, trains, planes to pay the default, the creditors. And then we have, what's the other one? I can't think of the other one. I know you're screaming it. I can't think of it. Collateral. A collateral trust certificate is another type of secured bond that's backed by a portfolio of securities of other companies, right? Like if I issued a bond that was backed by securities and I use my own securities, that'd be dumb because bankrupt means it'd be at zero. So it's securities of another company. So that's a secured bond. It's backed by something else that they will sell if I default. Okay, selling away. What the hell is selling away? Selling away is when you work for a broker-dealer and you either have an account somewhere else and you don't tell them and get written permission, or you do securities transactions off the books and records of the broker-dealer. So the one is if you have a brokerage account not with your broker-dealer and you don't get permission, okay, that's one. And the other one is if say you're just starting out and one of your buddies comes up and said, hey, I got this new thing I want to do and I want you to help me get investors and I'll pay you for it. And you go, sure. If you do it without permission from the firm, that's called selling away and it's a violation. If you do it with permission of the firm, it's just a private securities transaction and we're good to go. So selling away is when you do securities transactions off the records, off the books and records of the broker-dealer without permission. If you get permission, it's a private securities transaction. Selling a dividend. Okay, so selling a dividend goes like this. We should know by now, and I'll try to put a video here if I don't lose all my logs. You know that if we buy the stock before the X day, we get the dividend. So representatives or agents or even IARs, depending what test you're taking, will try to get you to buy the stock before the X day to get the dividend. We're selling the dividend to you. We're using that as an advantage. That's a violation because there's no advantage to it. Because think about it. If you buy it before the X day, you pay a price and you're going to get like a 50-cent dividend. If you buy it on the X day, the price drops or the base price drops by the 50 cents. They actually take the dividend out of it. So it's literally like no difference. It's almost like when you go to buy a car and they go, oh, hey, there's a $2,000 rebate. You can either buy the car and then we'll give you a check for $2,000, or we'll just take $2,000 off the price of the car. It's the same thing. But the reason it's wrong is because you're actually trying on this dividend side, you're trying to sell them a thing that's not real. The other part of it is if they get the dividend, they pay taxes, remember? So if you get money, you're always paying taxes. So if you buy it on the X day, you're actually just paying a cheaper price and you're not paying taxes till way down the road. And hopefully it's a capital gains rate and not ordinary income, which would be a dividend. So again, selling a dividend is trying to convince a person to buy the shares before the X day to get the dividend. It is a violation. Okay, what's a sellout? It's like when Taylor Swift went from country to bubblegum pop. No, I'm kidding. So a sellout is when a customer fails to pay for a security in time and the broker-dealer just sells the securities to pay for it. And then what happens a lot of times with that, you get your account frozen, which is not a big deal. It just means you have to pay for everything up front. Don't come at me for the Taylor Swift shit. What's a senior security? It's usually a security that's above common, okay? So a senior security has priority in liquidation and pay it than the other one. So most of the time, like preferreds, bonds, unsecured bonds, secured bonds are senior securities over common. So common is like the lowest one. It's the one we all like, but it's the lowest one. So anything above that is considered a senior security as opposed to a junior security, which is below. Like senior debt is high on the payout scale. It's going to be paid really early in the process. What's a separate account, or I guess we can call it a sub account, right? A separate account is for variable annuities. It's where the money or the investments are held where it's actually at risk, okay? It's separate from the life insurance's general account. So because this has risk. So when you hear the word separate account or sub account, always think that it's for a variable annuity or variable life product. And it has market risk. So what's a settler? Well, that's the ones who went out west in the 1800s. Like, go west, young man. No, a settler is someone who kind of puts the money into a trust. Like think grantor, think trustor, settler, all the same thing. Okay, serial bond is a bond that has one issue, multiple maturity dates. A lot of GOs do that. And they're usually, if they're that way, they're quoted on a basis like a yield to maturity method. Series is multiple issue dates instead of multiple maturity dates. Series K preferred, what they do is they start with a fixed rate and then they go variable after like a certain amount of years, whether it's 5 or 7 or 10 years. So it starts off as a fixed preferred, and then at some point in the future it becomes variable and it loses its interest rate risk. Okay, Sharpe ratio. It determines whether you're getting enough reward for the risk you're taking. That's literally, am I getting enough reward for the risk I'm taking? But the way we figure it out is we take the return minus the risk-free rate, which is the 91-day T-bill, divided by standard deviation, which is risk or volatility. So we take the X, it's called risk premium, right? So we take the X, whatever you want to call over the risk-free rate. So we take the return minus the risk-free rate divided by standard deviation. That will tell us whether we're getting enough return for the actual risk we're taking. Okay. You will not have to do the math on it. Just know that that's what it's about. What's a sharing arrangement? Basically how partners will share the revenues and costs in a partnership. It's simple. Short sales. Now, we should know this by now, but a short sale is when you sell shares you don't own, which sounds weird, right? So basically what you're going to do is, you're going to hear the word basically a million times. I knew that, right? So short sale is when you go, say you don't like IBM, and I have it. So you come to me and say, Ken, can I borrow 100 shares of IBM? So I lend it to you. I lend it to you. You then go sell it in the market at $50. You have your $5,000. You hope it drops in price to like 40. You buy it back for the 4,000. You leave 1,000 in profit, and you give them my shares back. So short selling is when you borrow shares. You have to borrow them, and then you have to sell them, and then hopefully buy them back at a lower price. The risk is that it goes up. Like if you watch GameStop or the new movie Dumb Money, I think they talk about that. You have almost unlimited risk. You have unlimited risk, but that's not really a thing. It's just in theory. So there's no limit to how high the stock can go, and you will eventually have to buy it back. On that note, short interest is twice a month, all the broker dealers report to all of their short positions, whether theirs or the customers, every time. Twice a month, I think on the 15th and the 30th. That was me. Who knows? It could be the 12th and the 18th. I have no idea. So they report it to FINRA, and then FINRA puts out what they call a short interest report, showing the percentages of short positions in each security, not who has it, but the total positions. And if you see a lot of short positions, it could be a bad thing. But if you see a very high short interest or really fast rising, that's actually bullish, because the more people are shorting it, the more people have to buy it. Okay. So eventually you're gonna have to buy it back. So what's going to happen is it might drive the price up. So short interest is the amount of shares short. It's percentage of the outstanding that's held, that's short. I don't say held short, it's short, of a stock. If you see a very short interest theory is the theory that if the shorts go up too high, the short percentage is too high, then it's actually a bullish thing. Like with GameStop again, think about it. It was 136% short. That means that 136% of all the outstanding shares were short, which again means that more shares were short than were actually outstanding, which is not supposed to happen. And that's why the stock ran to like $600. Okay, short-term capital gain or loss is a short-term gain or loss that's 12 months or less. If you hold the security for 12 months or less, it's a short-term capital gain. Also, remember, short sales are always short-term. So if you have a short position, no matter how long that thing sits open, even if it's 2 years, it is going to be a short-term capital loss or gain, because short sales are always short-term. A simple trust is a trust that is called simple. I'm a dumbass. The reason it's called simple is that it must distribute all its earnings every year. So every year it distributes the earnings to its beneficiaries, as opposed to a complex trust, which can actually be allowed to build up and they don't have to distribute every year. So simple distributes every year, complex does not have to. Small cap securities, you won't have to know the numbers, but I'm going to tell it anyway. It's a security that has a market capitalization, which means shares times out the share versus the number of outstanding shares times the stock price of between 300 million and 2 billion. That's small. That's fucking crazy that up to 2 billion is small, but that is a small cap. So a short straddle is when you sell a put and sell a call at the same time. You take the premium in, you're looking for stability, you're looking for neutral, and you're hoping that the stock closes right at the strike prices, so the options expire and you keep the premium, as opposed to a long straddle where you buy a call, buy a put, and you're hoping it moves more than the cost of the premium so you can make it back. Short swing profit rule is that if you're an insider and you buy shares of your company, if you buy shares of your company, you can sell it anytime you want. There's no holding period. But if you sell it for a profit in 6 months or less, you have to disgorge your profits back to the company. That's all it is. You're not in trouble. You just have to give your profits back. Well, you would be in trouble if you don't do it. But if you wait 6 months in a day, you can keep your profits. If you do 6 months or less, you have to give your profits back to the company. What's a sinking fund? So a sinking fund is when an issuer of a bond sets money aside on a monthly or quarterly basis. So that happens, they use that money to buy back or redeem or call their bonds or debentures or preferred stock. So a sinking fund is when a company, an issuer, puts money aside into like an escrow account, and that money is used to pay back or redeem or call the bonds at a future date. Soft dollar, I told you I would get to this. So soft dollar is when a broker dealer provides a service for a customer, an investment advisor, or something like that. Now remember, broker dealers can only get paid for transactions, commissions, markups, fees, only if they do a transaction. So this is kind of a loophole around that. I provide you advice or research, or I provide you software, or I provide you access to a seminar, and now you owe me. Hey, you owe me, okay? When I come for a favor, you have to pay me. That's a bad godfather. Now, I'm going to stop it now. Hopefully I'll delete that. Who knows if I will. If I do that for you, you now owe me money. In my mind, you owe me 15, 20 grand. So what I'm going to do is if I normally charge you a penny a share to execute trades, I will jack it up to 2 cents a share. And then as you give me transactions or reports, I'm going to charge you 2 cents a share. 1 penny of that goes to what you owe me. The other penny goes into my pocket as profit. So that's soft dollar. It's like a way around the not paying me for advice stuff and research. Because as a broker dealer, I actually can't sell research to you. I have to give it to you and then hope you give me business. So this is how we find our way around it. What's a solicitor? A solicitor is a person or a human being, whatever, that's job, it's either an employee or contracted by the advisor to find clients for the advisor. If it's a firm, they have to create an IA, they register on the state level, they create an IA, they have their own brochure, and when they go to a customer, they have to give their brochure and the investment advisor's brochure that they're doing. If it's an employee, like an individual, it's an IAR who just finds clients. I definitely had a few of them where they didn't work full time. Remember, the regulators do not care how you're employed. Remember that. They can try to trick you. They don't care how you're employed, as long as you're registered, if you're doing registered activities. They don't care if you're 1099, W-2 intern. If you're doing activities that require registration, they just want you registered. So this way you know the rules and they have jurisdiction. So again, a solicitor is someone who finds clients for an investment advisor. And they would register on the state level only, not the SEC, because the SEC does not believe soliciting is giving personal securities advice. So solvency and insolvency. Solvency is you have enough money to stay around, right? You have enough money. Insolvency, you don't, and you're pretty much bankrupt. Sole proprietorship, it's hard to explain this one. It's when you kind of incorporate yourself, but there's no protections. You're just creating your own business. You don't even have to fill anything out. It's free, it's cheap, and it kind of just makes it so you can take deductions and stuff, but you have no limited, there's no corporate protection for you. If they come after you, they can come after you personally. So it's the great that you have no bosses, you don't have to share the commissions or profits or anything, but again, it's only you and it dies when you die. What's sovereign debt? That's literally just bonds issued by other countries other than the US. A specialized or sector fund is literally just a bond that is focused mostly on a specific industry or sector or something like that. Specially designated nationals, the SDN list. Every customer that comes in, every person that works for you has to be run through that system to make sure that they're not a terrorist or they're criminals, basically, or they're in charge of other countries where we're not okay with them. Okay. So that's what would be a special designated nationals list. And that's where it's all, we report their names on OFAC and they tell us whether they're a problem or not. I literally, every time we had a customer or somebody come in, I had to run their list on OFAC. It's fun. It's interesting. A special situation fund is like a fund that only invests when like takeovers, bankruptcies, mergers, stuff like that, like one-off things. They just to get a quick buck. Special memorandum account, or other one known as an SMA, is like your excess equity. It's not exact. It's when it starts that way, but when the stock drops, you lose some of your excess equity, but your SMA stays the same. Don't worry about it. You should know this by now. SMA is basically what you can borrow from the firm as your excess equity. It's the amount of equity you have pretty much over the Reg T minimum, and you can borrow that and withdraw it. You can either borrow it and you can take it out like a credit line, or you can use it to buy more shares. A special tax bond is literally just a bond that is specific, it's limited to a specific tax source where they get the money from. That's it. It's not that hard. Speculation is when you take on risky behavior. You're taking on above average risk. Like when you buy a call or buy a put, or you buy small caps or penny stocks, that's considered speculation. It's high risk. How about a spousal IRA? That's an IRA. So if you have a job and your husband or wife doesn't work, as long as you have enough income, you can open an IRA for your husband or wife, your spouse, and put money into it as long as you have enough income for both. So if you're both under 50, you can put in $6,500 for you and $6,500 for them. Now it's in her name or his name, so that's fine. It says you're putting it in for them because you have enough income. What's the spread? Okay, the spread is the difference between the bid and the ask, right? So if I'm bidding 42 and I'm offering at 42.50, the spread is 50 cents, not brain surgery. The S&P 500 is one of the more broad indexes. It covers a wide variety of like industrials, financials, utilities, transportation. It's 500 securities, and it's the index most people use. The VIX is based on it, and usually when people talk about what's going on, they look at the S&P 500. Yeah, people look at the Dow on TV. They mark it's up 50 points or whatever, but the Dow is really just 30 stocks, right? The Dow 30, it's 30 of the biggest companies in the world pretty much. So it's not a true indicator. The S&P 500 is a better indicator. Now, the Wilshire is like the whole market. It's like the broadest, but the S&P 500 is the one most people use. So what's a standby underwriting? Well, you have to go back a little bit. So if I do not a secondary, but an additional offering, I'm issuing more shares. I'm going to issue rights to my current shareholders so they have a chance to not be diluted. Well, they have to subscribe to the rights if they want to buy the shares. But if they don't, I have a standby underwriter who's on a firm commitment basis, will buy all the unsubscribed shares or rights to then sell them to the public for me. But that's a firm commitment. So if I have a standby underwriter and I do a secondary, not a secondary, an additional offering, I make that up, I'm guaranteed to sell the shares because that standby underwriter will buy them and then take them to the public. Standard deviation, literally just risk. It's volatility. High standard deviation is very risky, very volatile. Low standard deviation is not. So what does it mean when it's a standardized contract or standardized option, right? So that means they're traded on exchange. They have specific things like the strike price, the delivery month, the amount of contracts in each, amount of either commodities or shares in each contract, delivery month, stuff like that. Everything standardized other than the cost and the premium. Statement that's literally a list of all your securities in your account, and it's quarterly. This is where people get screwed up. The only rule that the FINRA has for statements is quarterly. Everyone thinks if there's activity, it's monthly, but that's not a FINRA thing. That's a firm thing. All the firms do it, but the firms, there's no requirement other than penny stocks for them to do monthly statements. But all the firms do it. If there's activity, they do monthly. If there's not, they do quarterly. But FINRA doesn't care. They say as long as it's quarterly, you're fine. Statutory disqualification, SD. That's if you can't work for a certain amount of years. So if you are convicted with a felony in the previous 10 years, you are statutory disqualified. You cannot work for 10 years. If you're convicted, remember, convicted, adjudicated, pled guilty, nolo contendere, all those things, if you are guilty and convicted, you are of either any felony or any ethics or taking of money or bribery misdemeanor or securities misdemeanor, you are out for 10 years. Now you can ask for a eligibility hearing and have them let you back in, and then the firm just agrees to pay a fee every year and watch you harder, but you can get in somehow. But statutory disqualification pretty much means you can't work during that time. And it's only 10 years unless you're really an asshole. Statutory voting. Okay, so we can vote two ways. We can do cumulative or statutory. Statutory means if there's 3 board seats, okay, if there's 3 board seats and you have 100 chairs, you have 100 votes per board seat and you can't fuck with it, okay? That's statutory, okay? Cumulative means the same thing. 3 board seats, you have 100 chairs, you have 300 votes to use any way you want. You can put 300 on this person, none on these. So that's cumulative. Actually doesn't give you more votes, but it gives you more voting power because you're going to load it up onto one person, okay? So 1 seat or whatever it is. So statutory, it's basically 100, 100, 100. Cumulative, you can use 200 here and 100 here. You can do whatever you want. Static content is when you post something as an advertising or something on social media, and it really can only be changed by the author, okay? Now, the other one is, static and, I couldn't think of the word, interactive, okay? Static means it's only going to be, it can only be changed by the author, and it doesn't really get changed. Interactive means it can actually be changed by third party. So static needs written pre-approval. Interactive does not. A stock dividend is when a company issues shares of the company versus cash. So if you get say you have 100 shares at 50 and they announce a 10% stock dividend, it's not taxable. You actually get 10% more. So now you have 110 shares and the price is now 45.45. So there's no advantage. It's a zero-sum game. You're not getting your total value doesn't change. But now you have 110 shares versus 100, but it's a little cheaper. So stock dividend is when they pay out in stock versus cash. So a very large stock dividend. So if a stock dividend is more than 25%, it's considered a stock split. And so we all know when we read about, you see a stock split, you have 100 shares at 50, they just cut it in half, and now you have 200 shares at 25. You should know this. I have videos for this. So stock split is like a marketing tool to make the stock look more attractive. So if it's a $2,000 stock, maybe they go, God, nobody's going to buy it. So they're going to do a 5-for-1 split. So now for everyone who owned 100 shares, They're now a 500, but it's only $400. But again, the value doesn't change. Stop order is when the administrator or the SEC effectively stop the sale of a security because there's something wrong. Street name. So street name is basically just, God, I say that word, is when you buy shares and it's held in the name of the broker dealer. You're the beneficial owner, but it's held in the name of the broker dealer to make it easier to settle and stuff like that. They're starting to move more toward the DRS, the direct registration system, which is still electronic, but allows for freely transfer securities, but it's in your name. A subordinated debenture is a bond. Debenture means unsecured. Subordinate means it's after the other debt. It's like the last thing paid before preferred. Now, I don't know if mezzanine, I think mezzanine actually falls below that. Mezzanine debt, it's not an S, but I'm throwing it out there, is debt that's right. Basically, it turns into equity when they go bankrupt. So it's the last thing paid before preferred. A successor firm, a successor firm is when one firm takes over another. It's what's left over after. That's a successor. Shareholders or stockholders' equity is net worth. It's total assets minus total liabilities. That's really what it is. Probably not tested a lot, but stopping stock is when if you put a customer order down to the stock exchange, the DMM or the specialist can tell the customer, listen, I'm going to guarantee you a price. You can say it's trading at 50 and the customer wanted to buy it at 51. The specialist doesn't want to trade at 51 yet. So they'll say to you, listen, we'll guarantee you 50. Go try to do better. And if you can't, then I'll just sell it to you at 50. So stopping stock is when a specialist guarantees a price to a customer, and then the customer can actually try to get a better price. And if they can't, they're guaranteed to get that price from the specialist. So there's no harm, no foul on that. So straight life annuity, different types of annuity. Straight life is literally, you know what an annuity is. You should know that you're going to get paid out for life. So what happens, straight life means it's only going to pay you until you die, okay? It's not joint with a survivor, which pays when you and your spouse die, or joint or period certain where it pays for a certain number of years. It's literally the highest payout choice. So you start annuitizing, if you trip and you hit your head on the brick wall or you hit by a safe as you walk out of the office, they literally make one payment and keep the rest. That's the highest payout choice, the highest monthly payout, because it's the most risky for you. Although you're dead, so you don't really care. But the point is, again, it only pays until you die and then it stops. Straight line amortization or accretion is basic depreciation, amortization, accretion, all that stuff is where you're taking, let's go through this. So let's say let's talk about depreciation instead of amortization and accretion. So if you have like a truck, say a $50,000 truck, and it's for your business, you get to depreciate it each year and write off that taxes, but you're going to do it in a straight line manner, meaning that let's say it's worth 50 grand and the IRS says it has a 10-year lifespan. So you're going to take 50 grand divided by 10, that gives you 5 grand. That means you get to reduce the price of the truck on your assets by 5 grand a year, and you get to write off that 5 grand. So it's like a loss without losing anything. It's an awesome write-off, okay? So again, straight line is using the same amount of money every year. There's accelerated where they take out more in the beginning, like maybe you take out 8 grand in the first 5 years, and then the last 5, they'll just spread the 4 grand left, the 5 grand, whatever is left. So the point is, straight line depreciation means you're taking the same amount every year as a depreciation. Accelerated, which is not straight line, means you're taking more each year. So maybe, again, you take out 8 grand a year for 5 years, that's 40 grand. And then the last 5 years, you just do 2,000 a year because that's all you have left is a 50 grand. It's a way of writing off the cost of a asset. Okay, strip is where you're going after you pass, right? I'm just going to get canceled for that. A strip is a long-term zero coupon by the government, okay? So it's like up to 30 years, you buy it at like $200-300, and in 15, 18, 20 years, you get you will get, what do you call it? You'll get the par value of 1,000. You get nothing during the life of it. Part of the problem is, since it's an OID, you must accrete every year, which means if it's not in a retirement account or some sort of account that's tax deferred, you're going to be paying taxes, what they call phantom income, on that money every year, even though you're not getting it yet. Okay, that's a strip. Long-term zero coupon, and by the way, FINRA and the regulators love it for college savings. Keep that in mind. So supply in economic theory is the available goods or products to be bought. Demand is the demand to buy them. Okay, so now supply side theory is an economic, I think it was Friedman who did it, believes that you give advantages to the corporations, tax breaks and stuff like that to the corporations, and then what happen is they will be more willing to invest in in corporations and facilities and equipment, and hopefully that'll create more jobs. So again, supply side theory believes that if you give tax breaks and incentives to corporations, they will hire more people. Then there's also support and resistance. Support, if you have a chart, like if you're a technical trader, say a stock trades between a range, like, hold on. Let's say the stock is trading in a range between 50 and 60. So what happens? Let's do it. It's down, it goes up, down, it keeps bouncing off these things. So I'm going to do both. Support is like the floor where it keeps bouncing off. It's not a rule. It can break through, but it's likely not to. So this is support right here at the bottom, and then resistance is the top. That's kind of what it is. So support is for a technical term where it's at the bottom where it keep dropping off. And it can go through support. Trust me, it happens. Okay, strike price or exercise price is the price on an option that you either buy or even a right or a warrant or a derivative. It's where you buy or sell. So if you have a call, if you have a strike price of 50 on a call, that's where you get to buy it at 50. It's also called an exercise price, okay? If you have a 50 put, that's right where you get to sell it. Structured products. Okay, structured products are like debt that have derivatives attached to them to replicate equity, okay? So in reality, ETN is a structured product. It's a debt that replicates equity. Okay, there's different types of quotes, like a firm quote. Always assume quotes are firm, right? But then they have subject, nominal. So subject quote means, hey, I'm going to buy stock at 42 subject to conditions, which means if you come at me with a bunch of bonds, I might be willing to buy it. If you have, not a lot of bonds, I may be required to buy less or more or whatever it is. So subject quote is not a legally binding quote. I'm going to say, listen, I'll bid you 50 for, 200 bonds subject. That means if shit changes, I may change my mind, but you can kind of count on that being around where we're going to buy it. I think I touched on this already. Subordinate means it's below, so it gets paid less. I think I did this already, but it's good to hear it a second time. A subordinate means it's below the senior. Subscription agreement is when you join a limited partnership. As a limited partner, you will sign a subscription agreement, and the GP overnight has to approve it to let you. SARS or suspicious activity report. God, I just can't see. The list is coming back. All these S's. Suspicious activity report is a report filed by a financial institution when you think there's some sort of fraud or something going on of more than $5,000. There are other exceptions, but more than $5,000. Insider trading does it. Any kind of monetary fraud you think is happening over $5,000, and you file the SARS, and you have 30 days to do it. There's a couple of rules on this. One, you have to have a clear chain of command who can know, who cannot know. You can't tell everyone about it. And unlike a CTR, so a SARS, you're basically putting this person's face in the crosshairs of the federal government, maybe. As opposed to a CTR, country transaction report, is when you have cash or cash equivalents of 10 grand or more going in or out, you just report it. Those 100,000, probably thousands and thousands every day. Like a swap, like a bond swap is like when you sell one bond to buy another and you switch out of it, you're swapping out one for the other. And you're looking for a better maturity, a more secure, better income, stuff like that. What's a syndicate? A syndicate is a group of investment bankers that will help underwrite and distribute a security through an IPO or an additional offering. Okay, last one. Systematic risk is a risk that, it's a market risk. You can't diversify it away. It's like there's nothing you can do about it, really. I mean, you can hedge, but you can't diversify it away. It's like market risk, okay? So if the whole market crashes, it's like, think of this system. Systematic as a system, the whole system crashing. As opposed to non-systematic risk, which is like business risk, you can diversify that away. So systematic risk is non-diversifiable. Non-systematic is diversifiable. Yeesh, okay. There we go. Guys, that's it. All the S's. I thought it would take a lot longer, but I guess it didn't. Next up is the T's, baby. Don't forget to check me out every Tuesday and Thursday night live on YouTube. Letter T, baby. We're doing letter T. Big T. P for tennis. T for the Jets win. They beat the Eagles this weekend, which is awesome. Okay. Or T for Travis Kelce, whatever. T for Taylor Swift, whatever you want to say. We're doing the letter T's today. We've gone through A through S. We're on to the T's. How many left? Who knows? Well, I guess we do know because there's a limited alphabet. Okay, so we probably have a few left. I can't do the math, but let's get into it. Letter T, baby. If you want to pass the Series 7 or the 65 or the 66, this is the channel to stay on, okay? This, my podcast, my Blue Collar Finance podcast. My voice is gone from the game, so I don't know why I'm doing a video like this. But I have a live every Tuesday and Thursday night, a live Q&A answering all your questions. I've been doing it since for the COVID. I'm the original. I've been doing it forever, okay? I'm Crazy Eddie, okay? So actually, we're going to get into the T's before I go nuts, okay? Before you guys call the cops on me and go, this guy has to go away in a rubber room in a straitjacket. Let's get into it. Letter T. Okay, so let's talk about tax deduction versus tax credit. So tax deduction is it reduces the income that's being taxed. A tax credit is a direct reduction of your taxes. So let's look on the left side. You make 100 grand a year, you take a $5,000 deduction, maybe from donating for your IRA or for charity or something like that, a deduction. Then it reduces your income to 95,000. You pay 10% on that, and then you pay 9,500 in taxes. If you didn't take the deduction, you pay 10 grand on the 10% of 100 grand. But you reduce it by $500 because you took a $5,000 deduction. Let's jump over to the credit, the manna, right? So make 100 grand, you pay 10% taxes, that's going to be 10 grand. The credit goes directly against the taxes you owe. So that's 10,000 minus a $5,000 credit. You only owe 5 grand in taxes. That's the magic of this, is that if you do a tax credit, it reduces exactly what you pay in taxes, where tax deduction reduces the income that's going to be taxed. They're both great, but you always want a tax credit. And try my voice, it's going to be bad all week. Okay, how about a targeted amortization class as opposed to a planned amortization class? A targeted amortization class is what they added onto a CMO to protect against prepayment risk only, not prepay and extension. A planned amortization class, a PAC, protects against both prepayment risk and extension risk. A targeted only protects against prepayment risk, not extension risk. So the return is going to be a little bit higher, a little more risky. Tax equivalent yield is when you take a tax-free bond and you divide it by 100 minus the tax bracket to find out what corporate bond would be equal in pay after taxes as the muni, tax exempt or muni. So again, you take the tax-free bond, then tax-exempt bond, divide it by 100 minus the tax bracket. I have a brand new video. My math video is like almost an hour and a half long, crazy. And you divide that by the yield, and that gives you the corporate yield that you need to equal the same as like a muni. So if I get I'm not going to do the math right, but say you had a 4% muni, and you go, okay, what's a tax equivalent yield? And you say you're in the 80% bracket, you do 4 divided by 80%. And whatever number that is, that's how high a corporate bond you need to get the same return as your muni. That's it. The tax exempt bond fund is a mutual fund that pretty much invests in only munis and short-term debt to maximize your tax-free return. That's what they're there for. What's a TAN? A TAN, or a tax anticipation note, is a short-term debt. Okay, short-term debt issued by cities and states and stuff like that, along with RANs, to meet budget shortflows. So what they do is they issue it now, and then they know, oh, people are paying their taxes in April or June or quarterly, and they can issue it now. And when people pay their taxes, it pays it off. It's very short term, and it's usually to fix your budget, a budget outflow. That's it. I have a feeling a lot of the T's are going to be taxes. Okay. So what's tax liability? That's literally what you owe in taxes. If you make 10 grand and you're in the marginal tax bracket of 15%, your tax liabilities, you make 10 grand, you pay 15%, you owe 1,500. That's basically what it is. Your tax liability is what you owe in taxes. Yes, in real world, you take deductions and stuff like that. But let's just say if you make 10 grand and you're in the 15% marginal tax bracket, you will owe $1,500. That's your tax liability. A tax preference item is basically something that, like an excessive deduction or something on a private activity bond, where the deduction is probably going to be subject to AMT. So these deductions, whenever you take them, and then if you are subject to AMT, you have to add them back, and it's taxable. So if you're a normal person, like us poor people, then what happens is maybe that doesn't matter. But if certain tax preference items, if you see excessive deductions or accelerated, usually those might be tax preference items. And then if they're calculating AMT, which we don't have to do in the test, just understand that those would be added back into your income to be taxed, because the IRS doesn't miss a penny. So what's a tax shelter? A tax shelter is some sort of product or process that avoids or lowers your taxes. Think of like muni bonds or DPPs, limited partnerships. That's where they put like real estate limited partnership, cattle, stuff like that. Equipment leasing, all these things that are tax sheltered is like a DPP, a limited partnership. They're created to lower your tax burden. Again, taxes, a tax sheltered annuity or a tax deferred annuity is an annuity that grows tax deferred. So all that income is not taxed while you're doing it, right? So you put in the annuity, like think of a 403B or something like that. The teacher puts the money in, it's pre-tax, it grows tax deferred. They owe zero taxes until it's withdrawn. That's really what a tax sheltered annuity is, a TSA. Technical analysis. Technical analysis is just when a person is looking at person or male, female, whatever the hell it is a trader. Should have said that instead of causing trouble, right? It's a person that trades based on charts, trends, patterns, support, resistance, moving averages. They don't actually look at the stock. They don't look at the actual makings of the stock. They look at how it trades and the trading momentum and the patterns, and they look for patterns that they can replicate. Head and shoulders, saucer, double top, double bottom, shit like that. All has nothing to do with earnings per share, PE ratio. They do not look at the inner workings of the company, the competitors, or anything. They literally look at where it's trading. A lot of times, a fundamental analysis, if you hear the dogs, a fundamental analyst will use the technical trading information to find out when to go enter and exit. So fundamental looks at the whole company. So they may not know pricing, but a technical does. So kind of pairing that up together is like a good match. The Telephone Consumer Protection Act. Every time I think of that, I think of AT&T, but I don't know why. But the point is, it's limiting who you can call. Like if you call someone soliciting, you have to give your name and the firm and all that stuff. And you can only call during certain times, like between 8 a.m. and 9 p.m. at night. And if they get asked to be put on a do not call list, guess what? You can't call them anymore. Tenants in common. It's really joint tenants in common. But tenants in common is a joint ownership where each person has a specific percentage. Here's the big thing. If one of the account holder dies, their money goes to their estate, their will, the beneficiaries, their heirs, as opposed to joint rights or survivorship, it goes across. Probably used to be in the J's, but whatever. Tenants in common is an account where we both have kind of specific percentages. We can both place trades, but when I kick it, my money goes down to my estate, my heirs, my beneficiaries, and my will. Tenants in entirety is only for married couples. And if both people, if any kind of transaction has to be consented by both, but also means the thing why people do tenants in entirety is if you have a property and one of you gets sued or they put a lien on it, they can't put a lien on that property unless both names are creditors. And tenants in entirety is only for married couples. Tender offer is when an entity, whether it's Elon Musk, he didn't do this, but Elon Musk or somewhere management or somebody, or Boski, all these people would offer to buy a company. I guess the best one is Eisner, Carl Icahn. Think of the word. Carl Icahn. See, I'm getting old. Carl Icahn would make tender offers for the company. Here's what happens. Say a stock's trading at $40. You make a tender offer to buy it at 45, and now you make the tender offer. It has to be open for at least 20 days, okay? And then after that, you can cancel it. But you can have rules on it, like I want to buy 1 million shares, but I don't want to buy less than 900 grand, stuff like that. Or here's a price, and there's a lot of different ways to structure it. But it has to be open for at least 20 days. And anyone who wants to tender their shares, so tender offer is the offer to buy. Tendering your shares means you're giving your shares to the company to have them buy them from you, okay? So you can only tender what you're long. So if you're a long stock and short calls against it, you can't tender it unless you own more shares than you short stock. So if you own 1,000 shares and you sold 5 calls against it, you can only tender the 5 shares until you get rid of the calls, 500 shares until you get rid of the calls. 1035 exchange, that's how you can move. It's an IRS thing that allows you to move from insurance to insurance, insurance to annuity, or annuity to annuity without causing a tax event. But remember, you're not supposed to do it on a period, anything less than 36 months, because the cost of doing it would outweigh the tax benefits. Term bond, that's a bond that has a specific issue date and a specific maturity date. Pretty sure it's like a normal one. That's the one where you see where it's quoted like 98, 99, 101, something like that. They won't usually quote it by the yield. Testamentary trust is a trust that said after someone dies, the will says, hey, put the money in a trust for whatever. That's a testamentary trust. Now, let's move over to the Totten Trust, which a Totten Trust is a bank account that is literally named to go to a certain person on death. That's all it is. So a Totten Trust is I set it up, and if I die, the money goes to this person. That's what a Totten Trust is. So testamentary is a trust set up after somebody dies, last will and testament, right? And then a Totten Trust is set up, same thing, but it's like a bank account that would turn into it goes to a person right away once a person dies. Clarify, the person who died doesn't get the money, the beneficiary does. Just making sure. Here's one that always shows up in Kaplan, but they'll never fucking use it. I swear to God, this word they put in there, literally just because the person writing the questions must have been pissed at his wife, okay? Progressive oration. It is literally that you're going to change your mind 1 million times. Betrayal, saying like a politician would say one word to one person and another to another, deliberately hiding the truth. Why the hell would that be on the exam? Testimonial. I'm giving a testimonial. A testimonial is when a third party endorses an investment advisor or some other party, but it's really for investment advisors that it matters, that you cannot do them. If you're a state level advisor, that's not okay. The SEC now allows testimonials with certain disclosures, and I have videos for that, but on the state level, testimonials are strictly verboten. Third market. The third market is where listed securities trade over the counter, right? So we have the first market, the exchanges, New York Stock Exchange, NASDAQ. Second market is over the counter, unlisted. These are securities that can't trade on the exchanges. Third market is where stocks that do trade on the exchange also trade over the counter as an alternative. And the fourth market is institution to institution, dark pools, ECNs. It allows for non-member firms to trade with each other. They're really doing it through broker dealers and exchanges, but as a way. That's the fourth market. So again, the third market allows listed securities that trade on stock exchange to trade over the counter in an alternative manner. Tight money is what the Fed has been trying to do now. When the tight raise it, they're tightening. During expansion, they try to tighten the screws to stop the businesses from doing as much, to lending as much, borrowing as much, and slowing everything down. It's not fucking working, but whatever. A time deposit is when somebody puts money in there for a specific amount of time, I guess like a CD or banker's acceptance. It's promised to be in there for a specific amount of time and not be withdrawn, as opposed to demand deposit, which is more like savings or checking account, where you put it in and you can take it out anytime you demand. What's a time horizon? How long we want to invest for? It's basically the amount of time that we're giving you to that we need the money for, or some version of time horizon is when we need the money back, or what our goal is, or what our target is. The longer it is, the more risk you can take. The longer it is, the more equity you can take. The shorter it is, the less equity you can. So I have a rule that if your time horizon is 5 years or left, don't do equity. Now, real world, no, but this is test world, okay? Anything under 5 years, you don't do equity. And the other side, on mutual fund side, if it's under 5 years, you only do C shares. You don't do B or A because the costs are too much. Time value of money. Okay, time value on an option and time value of money. So first of all, time value of money is always that money now is worth more than money later. And that's why people take the lottery money up front, because I'd rather get it now than later. That's just a thing. Time value on an option. So let's say the option, say you have a 50 call and it's trading at 52. Well, the intrinsic is $2. Okay. 50 call, stock's trading at 52. You have $2 of in the money intrinsic. If the premium is 5, you have $3 of time value. Time value is what you pay over what the option is worth. Time value is what you pay over what the intrinsic or the in the money amount is. Okay. You could have no time value. It doesn't happen a lot. But like say your option is out of the money, no intrinsic. The premium is all time value. And also, the longer I'm going to say bond a million times, the longer the option is till maturity or to expiration. See, I went with the bond thing. The more time value it has. Also, the more volatile the company is, the more time value they have. So if you have Gillette and Tesla both trading at $50, whatever, Tesla would have more time value because people are willing to pay more for that ability to make a lot of money. And what is Gillette going to do? Make a fifth blade? Doubt. I think they may do a fifth blade now. A tip, just a tip piece. Okay, no, a tip is in this test. A tip is in somebody giving somebody else insider information, alleged, but whatever. So in this test, if you get a tip from someone, you assume that it's inside information and don't act on it. Tombstone ad. That's a tombstone ad is what you put in the newspaper during the cooling off period. It allows the underwriters to kind of generate some interest. It's like a non-advertising advertising. It's one of the things you're allowed to do during the 20-day cooling off period. So it's a new issue. We put up a tombstone. It says the name of the underwriters, how much money we're raising, maybe a range for the price, maybe. And that's kind of it. It's just saying, hey, guys, you interested? If you give us a call. Okay, top heavy. Literally half of these things get a double entendres, whatever. Top heavy is when a 401k or retirement plan has too many key employees in it. Like if so many of the key employees are in it that it outweighs what the normal people have, then there's an issue. What's a transfer agent? A transfer agent is either a person or a corporation that they're responsible for keeping track of all the names of all the names and who holds the shares and all the names on the securities. And anytime somebody buys from other, they make sure the names get switched over. So they always have a list of all the names of all the shareholders. And they make sure that the new person gets credited with it. The old person gets it taken off. Top down versus bottom up. Again, see, top down is where you look at the economy as a whole, then you narrow it down to the sector, to the industry, blah, 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 all the way down to the stock to make a decision. Bottom up, it's like a Queen song, right? Bottom up, girls. Okay. Bottom up is you start at the stock and you go out to the industry, then the sector, and then the market to make your decision. So top down, you start at the economy, work down, and bottom up, you look at the stock and go up. Okay, trade date is literally T. That's the day the transaction actually happened. Trace, that's how it's called trace, trade reporting and compliance engine. Nobody gives a shit. Trace is when you report corporate and treasury bond transactions. And usually that's within 15 minutes. Okay. So trace is how you report corporate and treasury bond transactions. And it's always within 15 minutes. Treasuries, treasury bill, that's under a year, right? Under a year, it's a zero coupon, most liquid. Treasury note, 2 to 10 years, pays a coupon every year, every 6 months, trades in 30 seconds. Treasury note, treasury bond, up to 30 years, again, pays every 6 months, trades in 30 seconds. And tips, treasury inflation protection securities, they pay a coupon every 6 months, but the par value adjusts for inflation, CPI, and then you should keep pace with inflation. Strips, where you're going after your pass. I say that all the time. This, again, I'm only putting it in there because we're talking about treasuries. It's a long-term zero coupon, very volatile. FINRA loves it for college education savings. Okay, how about a trough? TROUGH. So we have 4 business cycles that we worry about. A lot of the books try to do a lot of other crazy shit, but here's it is. So we have expansion, peak, contraction, trough. Trough is the bottom of the declining business activity, and hopefully it's going to head back up into expansion. That's it. Okay, what's a trustee? A trustee is a person who's in charge of a trust. Okay, they have to act on the beneficiary's on their behalf, and they are considered a fiduciary, which means they have to put the needs of the beneficiary ahead of theirs. Kind of like a good husband, I guess. Then we have a transfer initiation form. That's a TIF. That's like an ACAT. It's where you're transferring your assets for your securities from one broker deal to another. That's called the TIF. There's the trustee, and then we have the trustor. Trustee is the one who manages it. Trustor is the one who puts the money in, also known as a grantor or a settler. How about a trusted contact person? This is the person for specialized adults. So anyone over the age 18 who's mentally challenged or whatever, and then anyone over 65, you're invited to bring in a trusted contact person who then you can speak to them when there's something going on. They have no discretionary power unless it's set up that way. They're not actually able to make trades and stuff. They're just like a third party who can talk to you and talk to the client when there's an issue. The whole point of that trusted contact person is to prevent exploitation of people who are vulnerable. The Trust Indenture Act of 1939, all non-exempt, which means corporate bonds over, I think, 50 or 75 million, doesn't matter the number, have to use this thing where they create a trust indenture. They have to create a trust indenture, which is a legal agreement between the issuer and the trustee. I think my voice is getting worse. Go Jets. How about a 12B1 fee? That's an annual fee or even quarterly, I guess, that's charged against the mutual fund's assets to each investor to pay for marketing and advertising. Well, let's throw it in here, 2 and 20. 2 and 20, if you hear that, that's the way a lot of hedge funds are set up. They take 2% of the assets and 20% of the gains. While we're here, well, let's head into the U's. You and me and you and me. Okay. Underwriter. The underwriter is basically an investment banker who helps help companies go public. Underwriting is the actual process of bringing a security to the public, selling the shares. Uncovered or naked option is if you sell a call by itself with no stock covering it, or you sell a put with no short position covering it. That's an uncovered or naked option. Underwriting spread, that's the difference between what the issuer gets and what they sell to the public. That's the spread. The spread is the difference between the issuer, when they issue a bond, what they get, and what it's offered to the public, which is usually par. Uniform gift to minors, UGMA. Remember, this is an act. It's UTMA and UGMA. So some states have UGMA, most states are switching to UTMA. UGMA is if you want to set up an account for a child, under 18, you have to have one custodian, one child, and when the kid becomes 18, the kid gets the money. Now remember, as it earns money, the kid pays the taxes. They don't write the check. The custodian does, and they're both the same on that as far as that goes. One custodian, one child. The child pays the taxes and any earned income that they get. And remember, it's a custodial account, which means they have certain rules they have to follow to make sure they don't rip them off. No shorting, no margin, stuff like that. And UGMA at 18, it becomes the kids, and UTMA at 21 to 25, depending on the state, age of majority, it becomes the persons, the beneficiaries. Uniform Securities Act, it's literally just the model law for all the states to follow. NASA created it. And the state, it's not like every state follows all the laws. They just pick and choose which ones they want, and they can make up their own, but it's like a template so they can follow it. Unfunded pension liabilities is the opposite of overfunded. Overfunded means they're putting money in quicker than they need and they have more than they need. Unfunded means they don't have enough and the company has to make up the difference, unfunded or underfunded. It's usually with a defined benefit because they know what they need at the end, but they're putting money in and then maybe the actuary comes in and says, listen, you don't have enough in here to get to the number you wanted. That's underfunded. And if the actuary comes in and said, wow, you're ahead of the game, that's overfunded. It's an overfunded pension. And actually that could be, that's considered cash. The company can take that money out. UPC, Uniform Practice Code, that's literally the code that dictates how, that's like settlement code delivery, how member firms, FINRA firms deal with each other with transactions. UPC, Uniform Practice Code. UIT, Unit Investment Trust. That is a type of investment company. That's the U of the FUM, but it has a fixed portfolio, very low fees, because it's not really managed. It's like supervised. They never change the portfolio. I mean, I guess they could, but they don't change the portfolio. So if you have a bunch of bonds and they mature or stock and they get called, the fund actually self-liquidates over time. Unlisted stock, that security that's not eligible to be listed on an exchange, is considered over the counter. And if it's under $5 and not on an exchange, it's a penny stock, which has other rules. An unrealized gain is when the stock rises, but you didn't realize it by selling it. You buy stock at 50, it goes to 60. You didn't sell it, so it's an unrealized gain, and you cannot be taxed on it. Pay attention to that. They will probably have to say you sell it and you have proceeds for you to have a taxable event. Unsystematic or non-systematic risk is like business risk is on one either tiny sector or one company, and you can get rid of that by diversifying it away. That's like business risk. Basically, if it's like one company and they do something bad, like I like Elon Musk, but when he went to buy X or Twitter, that put pressure on Tesla. That's business risk. And you would diversify that away by buying multiple securities, by mutual funds, ETFs, stuff like that. So non-systematic risk is diversifiable risk. This one may not show up a lot, but it's good to know. An uptick is when the stock has traded higher than the previous trade. So there are certain things like corporate buybacks and syndicates where they can't buy on a straight plus tick, which means stocks at 21, you can't buy it at 2101. I can't stutter because it's 2:30 in the morning, 2:45 really. It's straight up like it's higher than the last sell. That's a plus tick or an uptick. Well, we're on a roll. We might as well roll into V. V for volatility. It's how much the stock moves. Volatility or vol is how much the stock moves. That's like interest rate risk on bonds or stocks. The more, I guess, the more volatile it is, it has a higher beta, stuff like that. Riskier. Vesting schedule. That's a risk. If any ERISA plan has to have a vesting schedule, because look, if you put money in, that's always yours. That's 100% vested. But if a company puts money in for you, then you might not be able to walk away with it right away. So they say, like maybe they make a 20% of it after the first year, 20% the second year, 20% the third year, all the way out until after 5 years you get it. Or they could say, listen, you get none of it until the third year and then you get all of it. It's called cliff vesting. So vesting is the time period where the money that the company put in slowly becomes yours and you can do what you want with it. Now, remember, you can't withdraw it under 59.5 without a penalty, but if you leave, you can roll it out with you. Like, for example, I worked at Westpac for like 9 months. It was just not a fit. I was there. They had about 10 grand in the account for me that they put in for me. I left after 9 months. I got to walk away with 1,200. That was it. Value stock or value style investing. Value stock is a stock that's like under pressure, maybe a little distressed, but it's solidly fundamental, most likely has a low beta, a low PE ratio, and it pays dividends. But that's a value stock. It's kind of undervalued, maybe out of favor right now, but it is a solid company. A variable annuity is an annuity, right? You put money, it's a non-qualified plan most of the time, unless they say qualified, okay? You put money in after tax, normally it grows tax deferred, but it's invested in a separate account or a sub account, and the growth varies, right? As opposed to a fixed annuity where it's set rate. Then when you get paid out, when you do the payout, the annuity phase, you choose your method, and then it's also invested in a separate or sub account, and the value goes up or down, and that affects your payment. And there's air. So if your return in your sub account does better than air, your payment goes up the next month. If it does worse, it goes down. That's a variable annuity, very high level. I have a bunch of videos on it. Variable life insurance is like normal life insurance. You put money in, it grows at a set rate, fine. But a variable life insurance, you put the money in. Remember, it's not term, it's whole. Where you put the money in, it's in a separate account or sub account. And based on the investments, it goes up and down. Your cash value can rise faster or slower than you expected. Now, you have a guaranteed death benefit. So if you buy $1 million policy, if you die, your family's getting $1 million. But your cash value may grow up and down. It could actually be zero. Okay, or not negative, but could be zero, but you still have the death benefit. But it can grow faster. It avoids inflation risk because it's invested in the market. And over time, it should likely outpace the fixed or the universal. But you are taking more risk. So again, variable life insurance has a growth rate that's variable based on the investments, and it is considered a security. VRDO, or variable rate demand obligation, that is a bond that has a fixed rate, okay? But and at every certain period, if the rates go up, it goes up. So the coupon moves with it. It starts out fixed, and then every period when the interest rates move, it'll move with it. So it really doesn't have interest rate risk. And the second part of it, the demand part, means you can demand the company pay you par, which is called an embedded put option. So at any time in a VRDO, you can sell it back to the issuer for par. So you have no interest rate risk. Pretty cool, but it's a little coupon. You would not want to buy that when rates are high because they're probably going to drop and you're going to make less. I mean, we're really so close. You might have just finish out the fucking alphabet. The W, baby. Okay. A warrant. Let's start with that. A warrant. Okay. A warrant is a security that you usually get attached to a bond or preferred to make it more attractive. This warrant gives you the right to buy stock at a set price, usually pretty far out. Okay. Usually 5-10 years out. So say the stock's trading at 30, it'll say you can buy it at 45 or high, 45 or so. Maybe it'll be set high or whatever it is. So it's no good now. But over the long haul, eventually, hopefully over 5 or 10 years, the price will go above that. And now you have a valuable thing. It is a sweetener on a deal because if I attach a warrant to my preferred or common, it makes it more attractive. So my initial coupon can be lower because remember, it's always trade-off. Anything I add for the customer or the investor is going to lower what I have to pay them. Okay, a wash sale. A wash sale is when you sell a security for a loss, which you usually get to write off your taxes, right? Up to, whatever. But if you buy the stock back or anything like the stock, so if you sell a stock for a loss and then you buy back the stock, a right, a warrant, a call, or a convertible security, that would violate it. And all they say is you're disallowed the loss. It's not like you get punished. You just can't take the loss and deduct it against your taxes or against your income until you actually sell the security for full and stay out of it for 31 days. That can't be confused with a wash trade, which is a violation. That's when you actually move trade shares without any beneficial ownership. Say you have an account at JP Morgan and at Goldman, and you place an order to buy and to sell at the same time. So you're trading it to create a volume to make it look better without actually changing ownership. That's fraud. That's manipulation. When issued, which is really when and as if issued. So this is when trading happens, when a security has been basically not approved, but effective, but they haven't issued the shares yet. It's been authorized, but not issued. Wildcatting. It's the limited partnership. It's the drilling where you're drilling for oil or gas, where it's an unproven area where there's no oil already. That's as opposed to development, which you're going to drill where there's already oil. Copycatting. But wildcatting is where you're drilling where there's no proven oil already. So it's a high risk, high reward venture. Wells notice. You're not well when you get one. It's when a regulator, usually the SEC, sends you a letter stating all the charges they're going to charge you, that they're referring you to enforcement and they're going to charge your ass. Not a good thing to get. You're not well when you get a Wells notice. Wilshire 5000, it's called the total market. So if you ever see referring to the widest or the most diverse or whatever it is, the broadest market, it shows you the Wilshire 5000, even though it has like 3,700 stocks in it. Withholding, like withholding affection, no. Withholding is when a company get paid, the company holds back some money to pay taxes. So like if you invest in a foreign company, a lot of times they'll withhold their portion of the taxes to hold it to pay the foreign taxes. That's one way of withholding. And then you'll get a credit or a deduction on our end, but they're still withholding the taxes. Or like your paycheck, you say you're making $5,000 a month. You say, wait, why am I only bringing $3,000 home? Because there's some of it's withholding taxes that they're going to use to send to the IRS. And if you overpaid, you get it back, but they're withholding it so that there's some taxes paid. Working capital is sort of a liquidity thing. It's literally just kind of how much kind of capital we have. So it's current assets, which are within a year, minus current liabilities, which are within a year. So that current assets minus current liabilities is working capital. A workout, okay, no, a workout is like a nominal or a subject quote where it's like, oh, I'm going to make a bid or offer to you, but it's subject to conditions. But we'll work it out. We'll work the deal out. I'll pay you, 80 for bonds workout, which means it'll be somewhere around 80. We'll figure it out. Don't worry. Wrap fee program is done by investment advisors, only investment advisors, where all of your charges, your commissions, and everything are under one set fee. Now, remember, you need a disclosure doc, and it's not supposed to be for someone who doesn't trade a lot. It's much more for someone who either wants you doing everything and knowing what the costs are, or someone who trades a lot and it works. And if a broker dealer starts offering a wrap fee, they're an investment advisor. A writer, WRITER, writer of an option is someone who's shorted an option. You sell a call, you take an obligation. You sell a put, you take on an obligation. Okay, now why? Why? Because we love you. If you're old, you would get that connection. It'll be followed by MICKEYMOUSE. What's a Yankee bond? A Yankee bond is when a foreign company issues a bond in the US paid for in dollars. Okay. What's a yield? It's the annual dividends or interest rate that you're getting based against your market price. The current yield is annual of a market price, AMP, annual divided by the market price. That gives you your current yield, what you're earning. Okay, so the yield spread is, I've done this chart. We have a chart where there's, well, let me do it. Okay, so I'm going to do yield spread, yield curve first. So the yield curve is, let me just find this thing here. Oh, there we go. Is like the shorter return, like down here's the years, this is the rate. So the shorter yield, the years, we're gonna have a lower rate. But as we go up farther and farther, we're gonna have a higher rate, higher and higher. That is just horrible, but that's what it is. So that's the yield curve. That it's like that's a normal curve. Okay, so it's fucking horrible, but it's normal. You know what? Let me see if I can do better than this. Oh yeah, that still sucks. But so the farther you're out, the more you have to pay. So what happens sometimes is that this is a normal yield curve, but when the Fed starts tightening, the lower rates, we have a flat curve, and then we have an inverted where the shorter yields are higher than the longer ones, which is going on right now in middle of 2023 since about January or so, because it's a sign of a recession, but it's not happening, right? So this is a normal yield curve. This is an inverted. That means the Fed has been raising rates. This usually means the Fed has been lowering rates. Now, another thing we have is the yield spread, where we're comparing. We'll say this is the treasuries, okay? And then we have another one above it, which is the corporates, okay? That's the corporates. Yield spread analysis is defining the difference between the two. Again, double entendres all over the place. So now, they're between the two. If it's narrowing, that means the economy is getting stronger because you're buying the corporates and selling the treasuries. If it's getting wider, God, I could get in trouble with this. If it's getting wider, that means people are buying the treasuries and selling the corporates. So that means the economy is not doing as strong. Okay, yield to call is your yield based on to the first call date. So if you have a discount bond, that's you're going to get called at par. It's assuming it's going to get called, which means your yield will be higher than if it was yield to maturity or current yield or coupon. So yield to call is the yield, assuming that to the first call date. I'll put it that way. So yield to call is the yield calculated to the first call date, as opposed to yield to maturity, which is the yield calculated to maturity date. Again, there's math on it. I have tons of videos on that. Yield-based or interest rate options are actually options on the interest rate. They're not on the bonds. They're on the interest rate. So if you own a bond, let me do it this way. If you think calls are rising, you buy yield-based calls. If you think yields are going down, you buy yield-based puts. I can't speak because it's 3 a.m. Now, that's okay, 18 minutes since my last mention. So now, if you have a bond portfolio, your word rates will go up. So you'd buy yield-based calls to hedge. Sometimes when you hear about, this is back to the yield to maturity stuff. Sometimes when it's quoted, you'll see the word yield to worst. That just means if it's a discount bond, you quote yield to maturity or basis. And if it's a premium bond, you quote yield to call, because that's the worst of the two. Z for Zippo, zero coupon bonds are bonds sold at a discount, and they don't pay during the life of it. They're also called OIDs, original issue discounts. And you remember my thing? OID, you must accrete. Okay, OID, you must accrete. So a bond sold at a discount and you get and when it matures, you get this at interest. Okay, this discount amount. So if you buy a bond at 800 and it matures at 1,000, that 200 you get is considered interest income. And if it's a muni, it's not taxable. If it's a corporate or treasury, it is. So a zero coupon bond is a long-term bond that, or it could be short-term. So I don't know what I'm talking about. It's a bond that pays interest at maturity, like a T-bill, commercial paper, strips, treasury receipts, all that stuff. And then we have Z tranche. Z tranche is a type of CMO tranche where you get paid at the end. It's again, I think it's a zero coupon, but you're paid at the end. You're the last one paid in a CMO. Okay, and the last but not least, Z end. This is the end of the letters. I am so glad we made it through this. I can't believe how many hours I spent doing this, but I'm so happy. I'm like, I love the feedback I get from people thinking this helps, going through the glossary and hearing some idiot explain it in a different way. I thank you guys so much for lasting through this whole thing. Don't forget to check me out on Tuesdays and Thursdays. Every Tuesday and Thursday, I do a live free Q&A that some people don't know about. And ask any question on there. Tuesday, Thursdays, 8:30 p.m. Have a great night. Wash your hands. May the force be with you.